I think for us, we literally just spent the weekend trying to figure out which of our customers had primary accounts or paid us from their Silicon Valley bank account. And as a Series A company, that revenue is critical for us to be able to manage our cash flows and think about what kind of sort of... I think for us, we literally just spent the week. And so at the end of the day, we realized it was a relatively short list, but it still gave us some pretty sleepless nights until sort of early Monday in Asia. We knew that
Hello. You're on mute, Shibi.
Hi, David. How are you?
Good. How was yesterday?
It was amazing. We missed you.
Yeah, I got to get on a train to get home.
Yeah.
I got a big weekend of grading papers.
Oh. Where do you
Papers and
live?
quizzes. Sorry?
Where do you live?
Connecticut.
Okay.
Sarah was there though. Sarah Hammer.
Yes, Sarah was there.
Good. Cool. So you can hear me okay, all that stuff?
Yes, I can hear you fine.
Cool. And if I remember from Sonal, there's no questions from the audience or anything like that. We're just going to go through my questions. Okay. And we have an hour. Yeah.
So ideally, we'll give you a reminder around 9:45. So, I mean, we would try to close it before 1 hour. So like in 55 minutes or so, so that because the next panel starts right after that. So try to wrap it up in 55 minutes.
55. Okay. Yeah, that's fine. I just want to know.
Yeah.
I'm coachable. Just make sure you tell me what I'm supposed to do. And can I share a screen or not if I wanted
to? You want to?
I'm not sure. I just want.
Let me check.
I just want to make sure if I tried to, because one of the topics we're going to talk about, I have a slide that might be helpful for the audience because everybody else is zoomed.
So I've given you permission. Can you?
It's not required. I just want to make sure. Otherwise, I can just kind of talk to what's in the slide.
No, so I just gave you the permission to share your screen so we can test right now.
Okay, cool. All right, let's try that. Boom. Share my screen. Where do I want? I want this one. Can you see? What does it say on your end?
Global Fintech activity volume.
Yeah. Okay. Cool. That's what I wanted. Because there's one question on that. I just wanted to put it in context for people that may not know what the hell I'm talking about.
Perfect. Sonal will join here shortly, and Bill will as well.
Yep.
Start then.
So you got a lot of panels today, yeah?
Yes. Full day of panel.
So hey, how are you?
Good, how are you?
So the audience yesterday was mostly students, or there were also investors?
It was a mix. I would say the majority were definitely students, but we also got some folks from industry because we had some like regular tickets, and then and then a couple of students from other schools as well.
So as a reminder, I want to have a conversation with you guys after this for potentially next year. I know you guys are all graduating and stuff. One of the ideas, and this is just me trial ballooning with you guys. So we had for the Cypher Accelerator, we had our demo day last week in New York. Hypothetically, if let's say we moved it to Philadelphia for next year and did it before the FinTech conference. So let's say you guys start at what time? 4 o'clock, 5 o'clock? So we do it earlier than that day. Would that be helpful, interesting? Because it's going to be broader. The other part of it, that assumes that we would have it be a FinTech accelerator. It's not going to be just crypto and blockchain. Would that be interesting? I'm just trial ballooning it because we're trying to figure out, do we come back to Philly? Do we stay in New York? All that stuff too. Lots of questions in there. I'm sorry, I didn't mean to catch you. Probably haven't had your cup of coffee yet.
No, I have. I think that's definitely promising and something we wanted to do even last year, but it didn't materialize. And I think the next year's class can do that.
Because one of the things that we're talking about at this point is potentially wrapping a class around the accelerator next year. So students would there'd be groups of students that would work with each of the companies on things like building a business plan and things like that. So but we can talk about that next. I can't hear you, Sonal. You're on mute.
Yes, no, we are trying to figure out some like last minute logistics. So it's totally fine.
So are people in the waiting room and Bill comes in here? Is that the way we're doing this?
Yes. So once he joins, I will admit him
Connect to everybody else. Okay, gotcha.
waiting room to here, but nobody else is here. So all the
No,
participants.
that's fine. I just was curious.
Yeah. So all the participants are basically watching it on a different platform.
Yep.
Yeah.
We're just waiting for Bill to join. And then I will do a brief introduction and we'll hand it over to you.
And we're recording, yes?
Yes.
Okay, and he knows that?
Yes.
Okay. I interviewed Scott Schleifer from Tiger Global on Wednesday for a fireside chat for the Venture Capital Club. And he was making sure that nobody was like taking pictures or tweeting stuff or. And Shuby wants us to wrap at 50-55 after.
Yes.
Okay. Do you want to say that up front or do you want me to just, you don't have to, I can touch it.
Yeah, I think you can, yeah. And
Okay.
this is also being live streamed right now, so.
Oh, gotcha.
Okay, Bill is here.
Hello, sir.
Just, hey, how are you?
Good. How about yourself?
Good, thanks. Just making sure all the connections work here.
Yeah,
Great.
thank you so much, Bill, for joining.
Oh, no, happy to do it. This has been a Wharton week for me. I was down at the People Analytics Conference on Wednesday, which was just breathtakingly good.
It's great.
Amazing. I will start things off and then I will hand it over to the two of you.
Okay.
Good morning, everyone. For those of you joining right now, I'm Sonal, one of the chairs of the Wharton Fintech Conference, and I'm absolutely thrilled to be welcoming Bill McNabb and David Erickson on our first fireside chat of the day. In the world of finance, few names carry the same weight as that of Bill. As the former CEO and chairman of Vanguard, he transformed the investment management industry by championing low-cost index funds and innovative technology solutions. His leadership and vision helped Vanguard become one of the largest asset managers in the world, with over $7 trillion in AUM. His influence, however, extends beyond the world of finance. He's on the board of United Health Group, IBM, Axiom, Vanilla, and Alteryst, and also serves as the vice chair of the board of Nexi. Bill received his MBA from our very own Wharton and has been an avid supporter of the school. serving as Senior Fellow of the Wharton Center for Leadership and Change Management. He will be interviewed by David Erickson, Senior Fellow in Finance at Wharton and co-director of the Stevens Center for Innovation in Finance. Prior to joining Wharton, David was the global head of equity capital markets at Barclays and Lehman Brothers. He was also an operating partner at Bessemer Venture Partners. Over to the both of you.
Thanks, Sonal. So I understand, Bill, that given the how this conference lays out, we have about 50 to 55 minutes in terms of questions. So I'm gonna start big picture, and then we can go in more detail in terms of fintech, especially given obviously some of the challenges that the market's had over the last few weeks in terms of whether you talk about Silicon Valley Bank or Credit Suisse, or really you got the challenges of the banking system, and then you have the challenges with the Fed trying to fight inflation. Where do you think we sit today? And as you look forward, how are you thinking about the markets, the economy, kind of for the rest of the year and maybe here in the near term?
Yeah, so thanks, and it's great to be here. And I love this forum and this group. I think some of the really cool work being done is in this space. So, and I look forward to talking about some of that. Look, it's always tricky to make predictions, right? Because as soon as you do, you're going to be wrong, at least most of the time. But let me at least give you a sense. I had the privilege earlier this week, actually, of being at an event where we had some former central bankers talking to us, giving us a little bit deeper insight, especially into what's going on in Europe with Credit Suisse and Deutsche, and some of the fallout from Silicon Valley Bank there. Plus, my former colleagues at Vanguard, with whom I'm still very close, we have, again, in my humble opinion, maybe the best economics team in the industry, and they've done a ton of work about the future. So my comments are going to be kind of framed by those two inputs. So one, there's no question that the banking system has been challenged by the Silicon Valley situation, and that really, I got to confess, I started out life after Wharton doing distressed situations, and I got to work on Crocker National Bank in the early 80s. I'm a little bit flabbergasted that Silicon Valley unfolded the way it did. This was more than predictable, and frankly, I don't think the regulators on the West Coast handled it very well. I will say that very directly. Right. A rise in interest rates will drive bond prices down, and if you looked at their balance sheet, you could see this coming. And despite what the politicians say, no amount of capital would have stopped this. So all the heart wringing about, if they'd only been a SIFI, or if we'd only had higher capital level constraints, none of this would have happened. That's just not true. This was a classic case of using short-term deposits and investing in long maturity assets, and you got caught in an unanticipated interest rate change, which again, how people couldn't anticipate what was going on based on the Fed's forward commentary is a little bit beyond me. So I say that as background because this was an avoidable situation. Anyway, it has roiled the banking markets. I do not think it's a systemic issue in the sense of what we saw in the GFC of 2008, 2009, where the very integrity of the bond markets and the credit system, if you will, were really at risk.
I was at Lehman Brothers at the time, so I completely understand. I ran global equity capital markets back then.
And I remember some of my interactions with you guys and Barclays later and so forth. So all kinds of war stories we could tell. So look, I expect there to be some continued fallout there. We'll see how the UBS Credit Suisse thing works out. I think the German central bank will keep Deutsche on the straight and narrow. I think the regulators here have signaled that they're going to continue to be very supportive of especially the regional banks. At the end of the day, this is going to make the big banks bigger and stronger than they were. But I don't see it as an existential risk to the system.
Do you worry about the next thing that everybody seems to be talking about is the office real estate market and the lending market, and the amount of loans that have to roll over in the office market? Is that something that concerns you?
Yeah, short answer is yes. I think you will see some dislocations there. I actually think, again, this is just going to accelerate that. That was already underway. If you look at post-COVID, again, just do the simple math. Like, most companies are requiring people to come back 3 days a week, and then, they're giving their employees flexibility on either end. And as a result of that, one of the things they're doing is they're finding they have to bring people together for training and, collaborative efforts more, more kind of group meetings and so forth. So there's some added expense there, and they're going to get that expense paid for by shrinking the real estate footprint. And, that's going to continue, as long as this return to work issue is out there. So short answer is yes, I expect there to be some real dislocation. And then let me just, again, I don't want to sound like a complete Debbie Downer here, but I don't think we're done with the economic challenges. The Vanguard team puts the probability of a recession in the US and the UK at about 90%, probably manifesting itself somewhere around the fourth quarter. If there's good news, is we don't see it as being super deep and super prolonged. Again, my meetings with some of the central bankers on Monday and Tuesday reinforce that. Parts of the Eurozone will probably be likely hit similarly. I think it will vary country to country. A lot of it will actually come down to energy, energy prices and access to energy. So Germany may have a different outcome than France and so forth. But you're looking at very low growth, if not recession, in a lot of the Eurozone. US, UK, probably some level of recession. And again, I think for all the students in particular out there and entrepreneurs, technical definition of a recession, 2 quarters in a row of contraction. I don't think that's very hard to see coming. The last thing I would say is the markets I don't think the markets fully reflect this yet, by the way. The markets really are looking for improvement. If you look at what the equity markets are kind of pricing in right now, you could interpret that as things kind of, getting a little bit more to normal by the fourth quarter. Interest rates definitely dropping. I'm not sure I see that. We'll see, but I think Powell is going to stay very true to beating down inflation. I think this last rise, where, they only increased to 25 basis points, I think that was a compromise. They wanted to do 50. I think the fact that they did 25 was an indication that they're not done. And I think that's going to continue.
So given that view, or given your view with regards to recession and some of the things we've seen, what fintech sectors do you think will benefit, and what sectors do you think will face obstacles?
Yeah, so this is one of those where I wish I had the whole audience in front of me, and I could be asking them, because you guys are all playing in these spaces. I think it's going to be negative for most of the fintech sectors. If I had to pick a couple who might do better, healthcare is certainly one. Again, I'm on the United board, so I have a little bit of a bias around healthcare, and maybe some blinders on because of that. But we don't see our business necessarily being negatively impacted by all of the volatility out there. In fact, given our size and scope, it may actually be an opportunity for us to further differentiate ourselves. And there, companies like us are going to continue pushing into more tech-based solutions, especially around payments and consumerization, if you will, of healthcare. And I think if you're in that kind of space from a fintech standpoint, there may be some opportunities for continued growth and maybe consolidation, and maybe some interesting buyers or exit strategies for some companies who are ready to do that. That's a guess, but I would say that would be one I would be more optimistic. Insurance, maybe a little bit similar story. When I look at what's gone on in wealth management, and where so much of their willingness to do new things is based on revenue growth, and with there being downward pressure on equities, equity valuation, equities in general, which drive a lot of revenue, hard to see them being super aggressive in this space. One of the things we're seeing, and you're starting to see the layoffs, run through the tech sector, beginning in financial services. In every boardroom I'm in, cash is king. And, how do we extend, if it's a startup company, how do we extend our runway? Because we're just not sure about the next 18 months. And if it's even in the established companies, it's, do we have a plan for if this recession hits? And if it's actually worse than what I'm saying, what are we going to do? And there's a lot of contingency planning, scenario planning along those dimensions. I don't think any of that is good for, newer companies per se. We'll get back to maybe later in the conversation, where I do think there might be a couple of opportunities down the road.
So since you stepped away from Vanguard as chairman and CEO, I guess it's about 5 years ago now.
Yep.
What has surprised you the most, positive and negatively, in terms of the fintech landscape?
Yeah, such a great question. So I'd say a couple things. One, the breadth, absolutely staggering. I got to admit, if I had done a better job at Vanguard, I would have been more in tune with what was emerging there. I remember going to an event sponsored by Tiburon, which is a sort of consulting think tank kind of group. I think it was my last year as CEO, and I went to be a keynote speaker at an event, and I met all these really cool fintech companies and some of the funders and so forth. And I came back to my Vanguard colleagues. I said, hey, you guys are the next generation of leadership. You need to get plugged into this. And we had actually started Vanguard Ventures 2016, sort of here in Philly, a group dedicated to this. So we were trying to get more immersed, and we've actually got quite a little team, actually at 2300 Chestnut Street in Philly, so right down the road from Wharton. And we're actually, we're investing in some startups. We're certainly monitoring what's going on. We've assembled an amazing team of people, some ex-fintech executives, along with some, quite a few folks from Silicon Valley on the funding side. But the breadth and opportunity set really was a big surprise to me. And one of the things that's been fun is, I spend a fair amount of time on Wharton in the leadership department, and getting to meet all the students who are going off to start up companies, and a lot of them in the fintech space, so different than my era. So that's been one surprise. And then, within fintech, as Sonal mentioned in the introduction, I'm on the board of two pure fintechs, and then, sort of a human resources platform that has some connection to the fintech world. I'm a senior advisor at a little company called Valence. So the boards of Vanilla and Altruist, these were startups in the last 4 years. What's been so much fun for me is to see how fast they're moving, the quality of work that's being done, and in particular, the quality of work being done on the engineering side. When I was at Vanguard, and this may surprise some of the folks listening in here, 35 to 40% of our budget was around technology. We had 5,000, of our 15,000 crew members, employees. When I retired, more than 5,000 were software engineers. So, we had a massive technology group. We spent a ton of money, but again, a lot of it was legacy systems. We actually have probably one of the deepest COBOL programming groups in the country. I mean, I'm sure most of the audience is like, what's that? And, but back in the day, a lot of your financial systems were written in COBOL using DB2 for relational databases and so forth. And these systems are still very much part of the landscape. So, we had huge groups doing that, along with, obviously engineers doing a lot of newer work, to make Vanguard.com, synonymous with Vanguard. But, I'm going to use Altruist as an example. So Altruist is a company that launched literally 4 years ago. And our whole thing is to create the new platform for investment advisors, sort of the first purely digital platform. You'll be able to do everything in terms of managing your book, including, very importantly, custody going forward. And so not be beholden to the legacy systems of a Schwab or a Fidelity or a Pershing, and the big existing custodians for most investment advisors. We've gotten a lot of press, a lot of positive things. But the thing that surprised me, we just announced that we were moving to self-clearing. We're the first firm to do that probably in 20 years. The speed with which we were able to go from a standing start to being a self-clearing broker, extraordinary. And the quality of the software, just amazing. And I'd actually lived through Vanguard going through self-clearing. We probably spent, again, different scale, different set of legacy issues, but it took us a lot longer and cost us, multiples, tens of multiples more to do it. And it's just so much fun to see it. And it gives you great hope and, great enthusiasm for what can be done going forward.
Right. So I'm going to kind of dive down into kind of the robo-investing space, given your background at Vanguard. So there seemed like there was a lot of enthusiasm for robo-investing, the wealth fronts, the betterments, 5, 6, 7 years ago. And UBS announced they were going to buy Wealthfront, and obviously a few years ago, and then that went away. And it seems like some of the, bloom has come off the rose a little bit in that space. How do you think about the robo-investing space?
Yeah. So I actually think there should be some case studies written about the two firms that you actually described, and one in particular, Wealthfront. So I'll probably be controversial here in some of what I'm going to say, but I actually know both those companies incredibly well. Wealthfront in particular. And by the way, I have great admiration for what they initially created and what Betterment initially created in a lot of ways. I think, so again, for the audience, for people who don't know Wealthfront really well, it was funded by Benchmark and a big push. What they basically did, it was a whole new approach to investing. So Wealthfront basically said, instead of, the traditional investment firm sort of incrementally making, progress around technology and, service and so forth, what if we took, Silicon Valley's best engineers who knew nothing about financial services, but we assemble a great team of software engineers and we feed them with content expertise from some of the leading thinkers about investment management. And the two people actually that Wealthfront tapped were former Vanguard board members, Charlie Ellis and Burton Malkiel, who between the two of them had written probably the most influential books on investment management in my era. Random Walk Down Wall Street, which is Burt Malkiel's magnus opus, still in print, millions of copies at this point. Charlie Ellis wrote a book called Winning the Loser's Game. Again, latest edition just came out, magnus opus. Those two books alone actually, as drove a lot of the development of the investment management business that, Vanguard actually benefited from greatly. So what Wealthfront did was they actually took these guys and said, give us a complete download about how should investors actually invest. And then they took that content and then they built, their models around, the software engineers, built their algorithms, their models, and created this, incredible, and I would say incredible, investment platform. It was really breathtakingly powerful when I first saw it. I was really impressed. We actually, got to know them very well. We actually had them come in and talk to our board about the future of investment management. What they didn't get right, and I think this is a great lesson for the entrepreneurs in the audience, is they didn't get the business model right. And Wealthfront in particular, it was originally like their target audience were, high-paid software engineers in Silicon Valley who don't want to have any kind of human interaction. They just want to use technology to solve their problems. And they built the service all around that. And again, I wasn't in their boardroom, I wasn't in their management meeting, so I don't know exactly how, what determinations they made, but it appeared to the marketplace that like, this is the way that software engineers invest is the way the world's going to invest. I think there was an arrogance there, to be blunt, that was the only way. So people like Vanguard, Schwab, Fidelity, we're watching this. And again, I think they looked at us as the old guys and, the legacy incumbents. But what they didn't, I don't think what they really understood as in the competitive landscape is, and I say this with great admiration for Fidelity and Schwab, two of Vanguard's toughest competitors. If you looked at three of us, we were creative destroyers in our era. Like, we rewrote the book. Schwab created this whole idea of discount brokerage, which was, absolutely innovation with a capital I. Fidelity created the first real money market fund with check writing, which was the thing that led to the disintermediation of the banks in the 80s, which actually propelled the mutual fund industry for 25 years after. And Vanguard, invented indexing for the retail investor, and actually, and I would say probably more than anybody, what a virtual experience could be. We never had offices, we never sold through brokers and so forth. So if you take the three of us together, we were very, very powerful innovators. And I would say the great thing about, and I can't speak for Schwab and Fidelity's cultures as much as I can for Vanguard, in deeply, deeply embedded in our DNA was our founder's favorite economist, Joseph Schumpeter, who, for those of you who don't know Schumpeter, Austrian economist, early 20th century, who coined the phrase creative destruction. And creative destruction being, he believed, one of the most powerful parts of capitalism. Creative destruction is really nothing more than innovation. And, people who, when the book, The Innovator's Dilemma came out, it was essentially taking Joseph Schumpeter's ideas and applying it in a more practical way. So this is a long-winded answer to your question, but it's a really important one. We looked at Wealthfront and we said, this is really cool technology, but they don't have the business model right. And so we basically challenged our team to create a technology as powerful as Wealthfront's, but let's do it our way from a business model standpoint, which meant we were going to actually tie humans with the technology to the end client. And what we found is way more people wanted that ability to touch a human, but also have the really cool, powerful technology driving the solutions.
Right.
So Wealthfront goes from a couple billion under management to, when UBS was going to buy them, they 15 billion or something like that. In that same period of time, we started our personal advisor service. We launched it in 2016. 25 years later, it was a $500 billion business. That's a billion, 500, serving almost a million investors. We had completely taken the industry by storm. And basically, this could have been, I won't say they could have been that big, but had they approached the business model a little bit differently, it would have been harder for us to make that much progress. Fidelity and Schwab are trying to do the same thing. They've been slower to catch up, but it's a classic example of underestimating the ability of a legacy competitor to pivot and reinvent itself. And,
Right.
If you were to go inside Vanguard's walls today, my successor, Tim Buckley, basically says to the now 18,000 people working at Vanguard, our whole future is around advice, and we are going to be best in class at it. And he's driving the company, much like, we drove the company around ETFs and the beginnings of advice, and my predecessor drove the company around, we got to get Vanguard.com right. Jack Bogle drove the company around, we're going to blow up the industry with indexing and low-cost investing as being the mantra. So the point is, great legacy companies can reinvent themselves if they're going to be sustainably good. Apple has done it for decades. There are a handful of companies that you well know. So again, long answer to the question, but it was the response from the legacy players. And I think the real lesson for entrepreneurs is really think through when you're, the cool technology is one thing, you got to get the business model right. And then very importantly, you got to expect a competitive response, and you got to figure out, what am I going to do about that? And how am I going to respond more quickly? And again, my humble opinion, they did not do that. I'm sure if you put them in the room, they'd say something different, but I mean, the track record is the track record.
Yeah. I want to dovetail in with one of the things you just said, which was the three disruptors, the Fidelity, the Schwab, the Vanguard of the time, right? I don't know, I'm going back probably 20, 30 years now. So if you look today in the fintech landscape, are there 3, 4, 5 potential disruptors that you see in the landscape today, in terms of whether it's a type of business model or a specific company that you kind of think about and say, wow, they're on the right track?
So I have a bias on this one. I think Altruist has an opportunity, and again, I'm talking my own book here, so take that, take that into consideration. But I think if you go and people go Google it and they look at the press and they look at what we're trying to do, I think we have the opportunity to be one of these redefining companies, but we got to stay on our game. Like, we got to be really good at what we do. We cannot disappoint people in what we deliver. I think in the payment space, there's still opportunity. I mean, there's been some great progress there, but this gets to something you and I had chatted that we might talk about later. But there's going to be consolidation there. But I think there's some there's still work to be done there. And I'm not smart enough to figure that out. Between Stripe and Venmo and, Apple Card now on the phone, and, there's all this activity going on, and Visa and MasterCard aren't going to sit there and just say, oh, we're yesterday's technology, I guess we'll just fade into the sunset here. They're going to fight. So there's
what I think of, honestly, back to legacy for a second, is I wonder if the banks are going to do anything with Zelle, kind of like what they did with Visa, because they own Zelle, right? So just like they used to own Visa and took it public.
So I think it's a great point. And, again, if I were in that space, starting something that even remotely touched that, I'd be scenario planning or using game theory to figure out all the different potential moves that could occur there. And how am I, as a little tiny company, trying to make it in part of that space? How am I going to react to that? So it's exactly right.
So I guess since the record year of venture funding from fintech in 2021, obviously with the market coming down, both publicly and privately, there's been a significant gap, I should say, in terms of financing. How do you think that's going to regain its the focus? And I guess maybe even looking from the lens of, I guess, the Vanguard Ventures. What is Vanguard Ventures, for example, the types of things they're looking at today in this kind of current environment? If you can get into that.
So again, a couple of high level comments. So look, it's going to be a while before we see 2021 levels of funding. And I'm not sure, by the way, 2021 was all that healthy either.
Yeah, I agree. I don't think that's the baseline we want to shoot for.
Yeah, there was so much money available. I think people on the margins at least lost their minds in terms of value, like the way things were being valued and so forth. And, it sort of had to come back to earth. It's just come back to earth a little bit harsher than anybody would have wanted. So I think it's going to be a while before we see levels even approaching that. And that's not, I don't have a good sense of time frame, but it's got to be a couple of years out at a minimum. I also think, though, that the really smart VCs and are kind of, they're going to make probably fewer bets, but I think they're going to be bigger winners who emerge from this kind of environment. One of my favorite statistics, and I haven't tested it in the last 6 months, but the Vanguard economics team used to do the work for us on a regular basis. If you look at the S&P 500's market cap, more than 80% of it's represented by companies started during either a recession or a bear market, or both.
Wow.
Great companies emerge from really difficult scenarios, and it's really hard at the time to see it. It's really hard to even understand how that happens. But this has been true for, I want to say, 80 years. Like it is pretty consistent. And so I think actually I think the best investors actually get that. So there's a lot of scouring around right now in terms of what might be game changing. And I do think people will put money into that. And they'll do it, when it feels maybe too early. The best investors will do it when it feels too early. I've been having this discussion with a couple of the firms with whom I work, because I keep teasing them, because everybody's like, nobody's deploying capital right now. And
right.
I think the problem is you guys were all trained at Harvard, not at Wharton. And they look at me kind of cross-eyed, and I say, at Harvard, you must have learned buy high and hope that you're going to sell higher. At Wharton, we learned buy low and sell high is the winning strategy in investing.
Right.
And they just all sort of roll their eyes at me. But there's a little bit of that going on right now, right?
Yeah.
Like you saw the kind of deals that were being done in 21. Some of those same companies are out there right now, and their valuation down by 50% or more. Like, if it was really worth 2x in 2021, why wouldn't you pay X today? So I don't know. I think we'll start to see some of that. In terms of what areas, I'm not sure. I'm not deep enough to really have as good a sense of that. I do, when I sort of look at the opportunity set there, so in wealth, for example, one of the things that we look at, we talk about a lot in that space, and again, full disclosure, I do some work with a private equity firm, a growth-oriented private equity firm, so much later stage. And when we look at wealth management companies as an example, one of the things we can't figure out is what's the winning tech stack going to look like. Because when you look at like the big independent advisors in particular, so these are somebody like a Carson Wealth or Mariner, and these are big RIAs and really successful businesses. They all have different tech stacks, and they all have their views on what the winning stack's going to be. And so I think there's a lot of opportunity there, because that's the TAM there is so extraordinarily large. Somebody's going to figure that out. We talked about payments, and again, somebody's going to figure that out. Whether it's Zelle or whether it's some them and two other people, I don't know, but seems to me like this may be a period where consolidation and funding consolidation could be a really interesting play if you're an investor. So anyway, those are a couple of thoughts.
Yeah, the one thing when we talk about the private markets, at least in my class, I just talked about it in my class, and this isn't fintech specific stat. This is broad across the private markets. There's $3.7 trillion of dry powder in the buyout venture capital, space globally, and it's hard for them to deploy it in the context of they have, off of what happened in 2021, they have significant marks down, number one, and number two, with interest rates moving up 500, 400 basis points in a year, obviously the math has changed. And so it's become much more complicated than it was.
Yeah. So Absolutely correct. I see those same numbers, and a couple of thoughts on that, though. For whatever they're worth, and we'll see how this, whether other people buy into it. So I think the tailwinds behind the private markets are extraordinary, and I say that as a former, somebody who made a living in the public markets, right, owning every company in the public market through our index funds, and I actually believe very strongly from I'll call it a societal, macroeconomic perspective, how important public markets are. But, with that amount of capital floating around, there's a lot less pressure for companies to go public. And, given the regulatory challenges, the shareholder litigation challenges, I'll give you a stat, and you probably know the numbers even better than I do. But, in 1999, there were just under 10,000 public companies. That number is down to under 4,500 today. Some of that's natural, but some of that is just there's more opportunity in private markets. 6 or 7 years ago, there were 13 unicorns, so 13 private companies worth $1 billion globally. That number is approaching 2,000 today. It's probably down a little bit because of the valuation downward pressure, but it's still a staggering number. You're up from at mid-teens to almost 2,000. And why is that? It's because you don't need to go public to monetize. The growth private equity guys are willing to write bigger and bigger checks, and they've got bigger and bigger pools to do it. So there's a lot of tailwinds there. I would say the big thing that's going to happen, I think, and I could be completely wrong about this. You've studied this more deeply than I have, so I'm interested in your views. Over the next decade, the midpoint return in our capital markets model at Vanguard for U.S. equities is between 5 and 6%, which is 300 basis points lower than 300 to 400 basis points lower than 100-year average. Again, for Wharton students, that over the last 100 years, public equity markets have returned, depending exactly on the time frame, between 9 and 10%. 6 real, if you will, during that period. We think, and again, we run a very complex capital markets model at Vanguard, but in the US, that number is going to be between 5 and 6. Globally, maybe 7 to 8. Because I think there's some non-US sectors that are more attractively valued today. So the point is, if you use that as your jumping off point, I think some of the private equity guys in particular, who've historically earned 400 basis point premium for illiquidity versus the public markets. So that's been 14, 15%. And that's what endowments, pension funds, and, big private investors have gotten used to. You scale that back down to 10 or 11, it begins to change their math in terms of when they deploy and so forth, which could be counter to, sort of conventional wisdom today. So I think eventually people got to figure this out.
Right.
And we may start seeing this money get deployed. And, so the tailwinds in the long run, I think, are still very, very strong for the private markets. There's one other factor too, is I think we're going to see a much broader group of investors in private markets, and the pressure again to deploy because of that's going to be great. So again, I'll use Vanguard as an example, but this is true in many, many places. We now have a private equity offering for small endowments and foundations, for institutions that could not get access to private equity or venture before, and we're starting to roll it out to high net worth individuals. And high net worth is not, we're not talking like Goldman Sachs high net worth where you got to have 50 million or 100 million to qualify. We're talking in the single digit millions. Like if you want to have 10% exposure, we can actually do that for you.
Wow.
So, and Blackstone, Carlyle, KKR have been pushing that notion for a long time. Everybody is working on this. So I expect that BlackRock certainly has the same view we do. So I think you're going to see that. So anyway, very long way of saying there's a lot of tailwinds for the private markets.
No question about it. Let's flip back to the M&A conversation and the potential, where do you see the consolidation, right? The biggest opportunities? Because again, M&A's come down as just like the public markets and financing markets have come down. But there's clearly some sectors in fintech that you think are ripe for consolidation. Besides, I guess we talked about payments a little bit already. How do you think?
Yeah, we talked about payments. So, I think the wealth side, there's still quite a bit of opportunity. I mean, there's been, we've talked about a couple of the robos who are out there trying to figure out, their future. But I think there's also quite a few plays in terms of supporting the wealth management business. And again, as I said, there's got to be a simplified tech stack at the end of the day, that makes its way into especially advisors' infrastructure. And I just think you're going to see like some interesting potential combinations there. So again, I don't want to over talk about Altruist, but this is all public. We just announced our first acquisition. We bought a group called SSG, which allows us to scale our platform more quickly than the original business plan. And I think it's it's maybe the little canary in the coal mine about the kind of consolidation in that infrastructure space that could occur. So we'll see if other players in other parts of the wealth management infrastructure world begin to take note. But I would be surprised if that did not happen. How you define health fintech, but there's a lot of stuff going on in health right now. And
yeah, I was gonna lead to that because you talked about it before, and obviously you're on the board of United Healthcare, so I don't want you obviously to share any non-public information, but obviously I know United Healthcare has been a big acquirer in the healthcare payment space of different businesses and models and things like that. So
yeah, and again, I think, and not saying anything inappropriate, that's not going to stop. That's not likely to stop. And if we're doing it, our competitors are going to eventually start thinking about doing it. And and you can see investors a couple levels below starting to put different assets together because they see the attraction to the bigger players. And this again goes back to will there be a couple of standalone companies out of all this? Probably. But
I'm just wondering if you think so. And legacy is the wrong term, right? I guess the question is, do you think in the fintech space broadly, do you think if you look, let's say if we put our crystal ball or put our hats on and try to figure out where it's going to be in the next 5 years, do you think most of the consolidation is going to be the legacy players coming in to buy companies in the fintech space? Or do you think there's going to be the betterments and the wealth fronts and so on trying to get together and try to get some scale so they can compete more aggressively?
Yeah. So great question. Short answer is, I don't know, but if I were predicting, I would say in each of those spaces, there's probably room for one or two new entrants who, if they combine the right way and scale the right way, could become a competitor to the smart existing firms. But I don't think there are going to be a lot of them. And so if you look at it, there's going to be kind of like two things going on. Legacy players will be buying interesting, cool technologies because the best players, I mean, the people who want to continue to be sustainable industry leaders, the very best of those guys in those boardrooms, and I can say this, they're talking about this stuff all the time. Like they acknowledge that there are people out there who are really smart, creating really cool new things. And rather than saying, change is bad, they actually, it's just the opposite. It's like, we're gonna cannibalize ourselves before somebody else does it to us. And so that'll drive, I think, probably the majority of the transactions. But will there be a chance for somebody to assemble something that emerges as like a true competitor to some of that? Yeah, absolutely.
I'm going to switch gears a little bit in terms of talk a little bit about blockchain, because there's been a lot of discussion about the evolution of blockchain in the financial space for the last 10 plus years. And you've got a unique position given your role at Vanguard or previous role at Vanguard, given your role on the boards of United Healthcare and on the boards of IBM. Where have you seen the most beneficial use cases or opportunities of innovation in the blockchain arena?
Yeah. So, again, caveat, I'm not an expert on blockchain. Like I've been interested in it, but it actually hasn't moved quite the way I thought it would. So I've been pretty wrong about it. So I say that with all humility. Where I thought blockchain would be really interesting would in the capital markets, for example, would be in the custody space. But I think the big banks actually saw that and they're thinking about it. And but and again, for those who maybe not as familiar with asset management, so if you take a Fidelity or a Vanguard who run, let's say take our total stock market fund, almost $1 trillion mutual fund, right? We're not the custodian of those securities. We have either a JP Morgan or a State Street as the custodian, and those big institutions custody the assets separately so that they're protected for the investor's benefit and so forth. If you think about blockchain, what a perfect application, right? Like, why do you need those guys? Create a ledger and
right.
You're done. Well, it hasn't quite worked that way. And, so much of what's been done has been much more in sort of supply chain logistics and things like that. So, and I think the JP Morgans and the State Streets of the world, BNY Mellon, they've kind of, they see this, and so how they're going to deploy blockchain in their own businesses, I'm not clear on, but I think that's probably how that's going to play out in that space. The bond market, another place where, again, way more about the bond market than I do. You could make hey, there could be a really cool way to apply blockchain and make bond trading more efficient.
I always talk about the equity market. It's been T+3 in terms of trade plus 3-day settlement forever.
Yeah.
Right.
Yeah.
And
it should be T+0.
Yeah.
It should be T+0.
I just can't figure out why that hasn't evolved in 50 years or thereabouts. So.
Yeah, it's so those are places where I think so equity infrastructure, and this again gets to the custody issue. I think the bond market, there's maybe some potential there. Obviously the whole how payments evolves with blockchain, without blockchain. I mean, there's a lot of speculation on that, but again, you would think down the road that the ultimate sort of end game would be in the payments world, you'd have a couple of massive quote unquote ledgers that actually that's where everything goes back and forth, right?
Right.
In a safe, secure way. For the companies I'm involved in, at United, we just sort of watch. We're not really going to be a driver there, I don't think. There may be some work going on that I'm not even aware of as a board member, which is different there. IBM, for us, it's much more, more likely to manifest itself in what kind of infrastructure do you need, what kind of security, very importantly. Our big push from a security standpoint has been in the cloud security recently, and this whole concept of a hybrid cloud where providers aren't going to use just AWS or just Google or just Azure. They're going to have multiple clouds, public, private, and all. How do you make that a really secure thing? That's going to be that's where IBM's winning space is, if you will. Mm-hmm. And again, you can see how that could apply to blockchain from an infrastructure standpoint, but we're not driving the actual usage cases as much, except maybe through our consulting groups. And then, of course, there's the whole crypto thing, right? Which I'm the first one to say, I don't understand. I should come back to Wharton and just sit in some classes. I have never understood crypto as a store of value, except it's really a great store of value if you want to do illegal things.
Right.
So for me, the legitimate uses of crypto, it's just another currency, and takes me back to when I came out of Wharton. One of the really cool jobs that everybody was gunning for was to be a currency trader.
Yeah, that was my first job out of college. So I completely appreciate it. Yeah.
It was before the euro, and so
Yeah.
you know, you take sort of purchasing power parity theory and then macro factors. You build really simple models, and you trade. You trade dollars versus Deutschmarks versus Swiss francs, and try to capture a little bit of value for your clients. And the markets weren't perfectly, purchasing power parity, is great in theory, but it doesn't always manifest itself the way you think. And
Right.
I mean, you live that life. I actually thought about doing it before I ended up in the banking and then investment world. But to me, crypto is just another currency at the end of the day. And what I actually think is going to happen there, and this is where blockchain may have its ultimate use case. And I'm not sure what the entrepreneurial opportunity will be, but I believe digital currency is coming. China is pushing this very aggressively. China can't stand that the dollar is the world's reserve currency. So, they made a push around the yuan and didn't go anywhere. So I think they're going to really, they're going to be the most aggressive developers of a digital currency. Europe is probably next, and the US is just watching. I mean, the US has work going on, but I think you will see global digital currencies certainly before the end of this decade that are meaningful. I'm not sure I want to be a crypto player in that world.
Yeah, I get you. One last question, because I know we're running out of time, and I've enjoyed our conversation, but it's a Wharton event, so I always end with a student question, which is, given all the seats and the experience that you have and all the opportunities you have, if you were a Wharton student today interested in going into the fintech space, where do you see the biggest opportunities, say, over the next 4 or 5 years?
Yeah, and I've probably kind of given my, shown my hand here. I think tech stacks and wealth, like there's so much opportunity there. And again, I'm playing at 2 levels there with altruist and vanilla, but I think there's a lot of work to be done there. Lifetime financial planning, nobody's really nailed that yet. Figuring out the real needs in wealth and investment. Let's put it this way: broader investment capabilities. Things you could do on the phone to make yourself a better investor. There's still a lot of opportunity there, as well as the wealth infrastructure stuff. And then, I think the health side of payments in particular, we are at a very, very early innings of the consumerization of healthcare. And so there's a whole financial, there's a lot of health apps that need to be developed. And I think integration with that, with a financial part of it, how you pay for it, how you create value around it, there's still a ton of work to be done there. I don't even know what that looks like going forward, but we are so early in this consumer health push.
Right.
But in a decade, it's going to be much more apparent how important it is. And I just think there's a lot of tech, a lot of fintech and tech in general in that space that could be really helpful.
Bill, thank you so much for the time.
You're welcome. Thank you, guys.
Thank you so much. So great to have both of you.
I
Thank you.
appreciate it. Good luck with everything today, guys, and have fun.
Thanks.
Thanks, Bill.
Hi, Isabella. How are you?
Hey there, Trevor. I am very well. How are you?
All doing well. Thanks for joining. Looks like we're just getting the panelists coming on. Hello, Jesse. How are you?
Good morning, everyone. I'm great. Hi, it's nice to meet you. And Isabella, hi.
Hi, Jesse. So nice to meet
Been
you.
on so many of the same emails at this point.
I know. I'm sorry not to get to meet you when you were here last.
That's okay, but I love London, so I will.
Did you have a good trip?
Yeah, for sure.
Did it rain the whole time you were here?
The whole time.
Yeah,
Honestly,
I heard it was really
the
bad
entire
that week. I
time.
was so glad to escape it.
I was like, I love it here, and I still love it despite the fact that it's raining every day. So
Yeah.
Hi, John.
Hello. How are we doing?
Hi, John.
Hi.
Good. Saw Kevin join and drop off, so I think he should be coming on here shortly. Get started at the top of the hour. How's everyone doing this morning?
How many sort of viewers is it looking like you guys have got?
To be determined. We have two separate channels. Not 100% sure necessarily where the view information.
Hey everyone,
but,
welcome to the panel. Thank you very much.
Hey.
I think we have another 3 minutes.
Sorry, Rhea. I
to
think
kick off, right, Sona?
Turn your umbrella streaming off, Trevor. I think that's where you're getting.
Daniel, thank you for the notes on banking as a service. It was a great read. In fact, I'm actually going to steal it and share a bit for an upcoming meeting.
Are others hearing that? Sorry, I just got a message from Kevin. I think he's trying to join here.
Hello.
Hey, Professor Warbach, how are you?
Okay, yeah, there was a Zoom update that I activated this morning, and it just keeps crashing every time I try and open, but I can do it this way on my phone.
Lovely. Well, I guess it looks like we've got quorum, so I think I'll get started here. Hello, everyone. Thank you for joining. My name is Trevor from Wharton Fintech. The honor of introducing our next panel, Crypto Compliance, Charting a Regulatory Path Forward. Today's conversation will be moderated by Kevin Warbach, Professor and Department Chair of Wharton's Legal Studies and Business Ethics Department. Panelists will include Jesse Brooks, Regulatory and Compliance Counsel at Ribbit Capital, John Bessia, co-founder and CEO of FS Vector, Isabella Chase, Senior Policy Advisor at TRM Labs, and Caroline Hill, Director of Global Policy and Regulatory Strategy at Circle. Looking forward to a great discussion. And with that, I will hand it over to Professor Warbach.
Terrific. Thank you so much. And thank you all for joining. We've got an exciting panel here today on a critically important topic. Anyone who has been following recent developments in the crypto space will know that regulation and policy and compliance are issues of great interest in Washington and in other capitals around the world. And there have been a number of significant developments. And we've got a terrific group of folks bringing different perspectives to bear on these issues. So you've heard all of their names. Rather than reading detailed bios, I'm going to invite each of them to just briefly introduce themselves with the first question. As you heard, I'm Kevin Warbach. I am a professor here at Wharton and the director of our blockchain and digital asset project. I've been working increasingly on issues in this area at the intersection of law and policy and business opportunity with blockchain and digital assets for a number of years, and excited about the group that we have together. So let me call them each and briefly just say a little bit about who you are and say, what got you interested in this area? Why are you in the space now focused on digital assets and crypto? So Jesse, why don't you go first?
Hi, everyone. It's so nice to be here. Thank you for having me. I'm Jessie Brooks. I'm the Chief Compliance Officer and Regulatory Counsel at Ribbit Capital, which is based in Palo Alto, but we're a global investment firm that invests and supports financial inclusion through fintech and crypto. I've been here now, it's 2 years actually this week. But before that, I was at the Department of Justice for about 10 years, doing a variety of cases, which ranged from sex offenses, homicides, and then ended up in national security, where I was prosecuting crypto cases before anyone really cared or knew what crypto cases were. And in that capacity, I prosecuted a bunch of terrorism cases, the Bitfinex hack case, some child pornography cases. And, you know, despite seeing how crypto was used in the worst possible ways, I began to learn a lot about the technology and see the possibilities for it and the availability of financial inclusion and compliance embedded within it in a way that had not really existed before. And it tied in my brain, you know, to get to your point of how I got invested in this space, it tied in my brain to something that could support a lot of the victims that I worked with when I was doing sex offense cases. I'm happy to, you know, go more into detail on that, but I could talk about that for hours and hours. So essentially, the more I learned about the technology, the more I realized that as a prosecutor, I would rather have had a crypto case than a fiat case any day, for a variety of reasons I'm happy to speak about if we touch on illicit finance issues here. And I knew I just wanted to be a part of building it and building something new and special and making it as compliant as possible. And so in my role at Ribbit, I focus on investing in reg tech solutions and also thinking about creative ways to talk to regulators and policymakers about the future of this technology and thinking forward about what are the things that it can do to help solve their problems and their pain points.
Terrific. John, you're up next.
Great, thanks. Thanks for having me. Appreciate it. John Batcho, so I'm the CEO of a firm called FS Vector. We're an advisory firm based out of DC. I have a pretty broad background in financial services, had spent most of my career in the banking, consumer finance space, a variety of roles, legal and compliance, and also did some government relations work for larger banks. And I really got pulled into crypto back in 2013. I was one of the earlier hires for Circle. I was a general counsel and chief compliance officer. And it was interesting that I was, as a legal compliance person, one of the early hires, but I think that really underscored the need and the interest, the need to engage policymakers early and often in this space. And that's what intrigued me, is just, you know, one, the need to create a whole new framework here, but two, the technology and the ability to do so many different things, even beyond financial services, but within the financial services space, really seeing the ability to reach and offer capital to new sources, reach the underbanked, underserved communities, to be able to do a lot of different things in payments, which are locked in the legacy system. And with the ability here to offer things that can be cheaper and faster, more secure, and done over the internet and done over with the use of technology, I think was really, really appealing to me. And then, you know, seeing that, but also seeing the pain points over the last 10 years, you know, was one of the reasons why I started FS Vector, was really to help a number of companies build and scale and really work through these multiple shades of gray within the regulatory space. And we made a lot of progress in some aspects, no. But so day to day, we work with companies trying to build and scale, both on the advisory side, and we also do lobbying and government relations work. And certainly there's a lot of conversations happening on those levels.
Awesome. Isabella.
Thanks so much, Kevin, and thank you to Wharton for inviting us to take part in this event. Sorry, I have a feeling I'm going to sneeze as well. My name is Isabella Chase. I'm a senior policy advisor at TRM Labs. TRM is a blockchain intelligence company. So we help financial institutions, crypto businesses, and also public sector agencies better detect, investigate, and mitigate financial crime and fraud across 27 different blockchains. In terms of getting into this space, you're going to see a bit of a theme emerge here, I feel. I've always worked in anti-financial crime policy and previously was at a think tank, and very much like Jessie and John, really saw a huge opportunity in digital assets and blockchain to do things very differently when it comes to both opening up access, but more importantly, usage of financial services, but also having a sort of real fundamental step change in how we think about effectiveness in combating financial crime. And it was that particular factor that got me very excited and gave me the impetus to jump from the work I'd previously been doing in traditional finance and move into digital assets.
Okay, finally, Carolyn.
Thanks so much, Kevin. And likewise, thanks to Wharton and Trevor for inviting me here today. My name is Caroline Hill. I'm the Senior Director for Regulatory Strategy and Global Policy at Circle. And I actually feel like I have a unique relationship with each one of my panelists. We work very closely with TRM Labs. John is, of course, a very prominent Circle alum. And Jesse, many of the things that you said when you were at DOJ was exactly what I was experiencing at Treasury. So rather than belabor the points that my fellow panelists have already made, I'll just keep it high and brief. I was at the Department of Treasury for about 8 years, combating illicit finance. And through that saw of course, as again, my panelists said, the innovation that was coming out of digital assets. But I also grew very disillusioned by traditional finance and their ability to reach these hard to reach places. And sometimes that was because of illicit finance risk, but sometimes illicit finance risk were used to really shield the profitability. And so when I saw this technology come alive, which was about sending money more securely and safely and faster, that was something that I really saw the potential for, and was immediately drawn to a company like Circle that issues the stablecoin USDC, that's trying to make payments as easy as sending an email from your Gmail to your Hotmail, nothing that takes multiple days or weeks or a big upfront fee. And so I made the transition about a year ago, and happy to chat more about the regulatory environment in which we see ourselves today.
Okay, so tremendous expertise on this panel for this topic. So we're going to have a terrific conversation. First question, let me ask each of you, how would you describe currently the regulatory environment for digital assets in the United States? Let's go in the same order. Jesse, you first.
Okay, I'm happy to go first. Yeah, I think the best way for me to describe what it feels like to be in the crypto space in the United States right now is just to reference a bunch of our companies. And we invest in companies throughout the world, ones that are trying to expand in the US, ones that are thinking that it might not be a good idea. And over again, you're just seeing companies consider how to avoid the US. So how to avoid making sure that US customers are not getting access to the token that they're issuing or the services that they want to offer. And at the end of the day, that's bad for US customers in a lot of ways, particularly for the companies that we try to invest in that are trying to do it in a compliant manner. And it really just comes down to the fact that there's a lack of clarity. I think that it's very easy in this space to dunk on regulators, but the truth is, I don't want to sit here and do that. I think that's sort of an easy win sometimes, but there is an utter lack of clarity. I mean, you can just look at the Binance action that came out of the CFTC recently, earlier this week, talking about how Ethereum is a commodity. At the same time, the New York Attorney General is saying Ethereum is a security. So the fact that regulators themselves and different entities within the United States can't agree themselves is making it very, very difficult. Now, contrast that with what's happening in other countries, which, look, no one's doing it perfectly. Everyone's just trying their best. But I just spent a few weeks in the European Union and the UK talking to regulators there. I engaged a few months ago in Singapore and other APAC countries and learned a lot about what they're doing and engaged with them as well. And there's just a general mentality that is different of this is an opportunity to learn. This is an opportunity to think really deeply about how to regulate this space in a new, innovative way, or to think about when laws exist already on the books that might apply versus ones that need to be created anew. And right now in the United States, it has just become so political. And, in many ways, the crypto ecosystem has not helped itself because there's just like hit after hit happening. But those hits are allowing the conversation to become completely political and just not nuanced. So all the crypto ecosystem is looked at as the same, whether you have the word crypto in your name, but you don't transact in crypto versus a DeFi entity. And, it's becoming political through debanking. It's becoming political through different agencies thinking different things. And I think just that lack of clarity and that sense of like, this is bad. There's an anti-crypto mentality that is perpetuating is just causing more and more companies to move offshore. And, I could give you a bazillion anecdotes.
Okay, well, we'll see how many anecdotes we have time to get through on the panel. Probably not a bazillion, but some fraction thereof. John, what's your take?
Yeah, there's a lot to unpack here. I mean, obviously, I agree with Jesse. I mean, it's easy to criticize the regulators, but it's really tough to regulate technology that's moving so quickly, to really understand where the risks and where the guideposts should be. I do applaud, there's been some efforts, there's been some, offices of innovation, there's been discussions, there's been, thoughtful, some potential legislation floated around regulatory frameworks and things like that. But the key is, how do we regulate in a smart fashion, in a reasonable fashion, allows innovation to prosper? I think that is always the age-old question. Regulators tend to be reactive versus proactive. And so it takes, either a good crisis or a good level of industry growing and maturing to make them act. And I do think, the FTX situation was a bit of a tipping point, obviously a self-inflicted wound and a way where we had a fraudulent situation, but there was a lot of attention drawn to the space. And, now we are in a period of really, some call it a choke point 2.0, but we are in a tough period as an industry in terms of, a regulatory by enforcement, the type of environment you have in the banking system. It's very challenging for crypto firms to get bank partnerships. Obviously, you saw 3 of the larger banks that have worked with crypto companies fail over the last month or so. And you also have a lot of, stress, both at the federal to state level. You're seeing a lot of stress through the supervisory process as well. You see FinCEN through the IRS doing more and more examinations of crypto-related firms. And so, all that creates this recipe and this situation where you have a very difficult regulatory environment. I would say there's some themes, though, in terms of the enforcement actions that are taking place. One, you see enforcement actions which you deal with, I guess take a step back, regulators themselves, what they care about is what are the underlying activities and what are the associated risks to determine how to regulate a space. The enforcement actions, like I said, there's 2 pieces here. One is the classification of the assets and classification of the conduct. And that's what's really troubling here because, cryptocurrency has been classified as a commodity, a security, a type of currency, or in the money transmission aspect. We see a lot of the firms being licensed at the state level as money transmitters or property in terms of the IRS. If you can't get that question answered and you don't know what it is, and there's conflicting answers among regulators and turf battles between the SEC and the CFTC and the states, that becomes very challenging to run your business. The second piece of the enforcement that you're seeing are around the risks, AML, security issues, things like that, that I think is normal course of business for any financial institution. You see it in the banking system, legacy financial services. If you have bad actors, if you have fraud, if you have people who aren't complying with the rules, there should be those enforcement actions. And I think that is really an emphasis, and that will weed out some of the bad actors. But I think, at the end of the day, we do need, to go to Jesse's point, we do need some certainty, and we do need to work closely. There needs to be more education. There needs to be more collaboration, both among the agencies as well as from the industry perspective. And so, hopefully we'll get that going forward.
Isabella.
Thanks. Yeah, I just would probably build on the points that have already been made. And as you can tell from my accent, as someone not based in the US, I think, we do see the last 6 months have been really, really busy around the world. The US seems to be sort of stuck in a bit of in these various conversations that John has outlined. But outside of the US, the UK and the EU, we've seen a huge amount of progress over the last 6 months. Also in Australia, both the UK and Australia published very significant consultations over the 6-month period. And what I would say is that's not to say that the EU and the UK and Australia don't have their own problems. They absolutely do. I just don't think they're as political, as Jesse pointed to. You know, we do have issues also with a de-risking of the industry, and that's a twofold issue, both in terms of making it difficult for crypto businesses themselves to have bank accounts, but also a de-risking in introducing transaction limits for retail customers to move funds into crypto. So that's an interesting developing issue. But I would just say, sort of, when we look at the last 6 months outside of the US, it's been quite pragmatic. We've seen slow but steady steps to create regulatory frameworks. And a lot of that has been based on constructive conversations, or at least being open to conversations with the industry.
Okay, Caroline.
And to round things out, I'd like to add on to something that John said about regulators being reactive. And I completely agree. And I think even more so than reactive, regulators are defensive. And so what we're seeing now is a response to the number of crypto challenges we've had over the last year. I mean, we're almost about exactly a year from the infamous Terra Luna collapse, to just outright fraud with FTX. And we're seeing a lot of those responses now. But also, if you take even a further step back, the departments and agencies in the US government that are looking at digital assets are looking at it in a defensive manner. How does it affect market stability? How does it affect the US financial system? And it's not in a way that's saying, well, how does this actually help the US economy here? How does this help our economic competitiveness? How does it help if we lead on regulation and the regulatory frameworks here in the United States? How does that help internationally? And so I think that's really lost from the conversation. And in the meantime, because we don't have these regulatory frameworks, we have regulation by enforcement, and that's what the enforcement agencies are doing. Now, in a different jurisdiction in the EU, what we've seen with MiCA, I think is reactionary, but it was reactionary to Facebook's launch and then announcement and then subsequent actions of the Libra project. And the EU was really galvanized by that and said, well, we need a comprehensive framework. And like Jesse and like Isabella said, there are good things in there, and there are things that I think the industry doesn't agree with, but ultimately they are moving and they are setting the standards. And frankly, now they're setting the standards internationally because other countries say, well, that works and it's in MiCA and we can import it here. So not only is the United States losing out on how can we promote this technology for the problems that we have in the US financial system, but they're losing out on that international edge as well. Jesse also mentioned companies leaving the US. I mean, that's something that I can't speak about as much of because Circle is a proud US company, but we are looking at expansion, and MiCA's regulatory clarity is incredibly, whether you agree with MiCA, you don't agree with MiCA, or you're somewhere in the middle, that regulatory clarity is incredibly important and will attract businesses and innovators and developers there.
Okay, a lot to follow up on there, a lot of different issues. Let me start with one that I think John mentioned, the banking panic of a few weeks ago. Caroline, Circle had $3 billion that were tied up in Silicon Valley Bank, which caused a great deal of consternation and temporary depegging of stablecoin. And subsequently, as a couple of you mentioned, regulators shut down Silvergate and Signature, apparently about concerns related to their crypto exposure. So should we be worried that crypto is a threat to the banking system?
Circle saw firsthand, if no one minds me jumping in first, Circle saw firsthand actually that the banking system was a threat to digital assets in the industry. That was what happened to us. We had, as you said, about $3 billion in cash reserves. With SVB, Circle has always had a tremendous commitment. One of the reasons that I joined Circle about being clear where our reserves are held, because we feel that the only way you can actually be a stable coin is one-to-one fiat to stablecoin backing. And that's what we do. We hold all of our reserves within the US financial system in high quality liquid assets. And so when SVB went into receivership mode, we were again transparent about that. But it was a bank causing a stablecoin to depeg and not the other way around. And I think that regulators are publicly and privately reflecting on that fact now. But certainly there are a lot of lessons learned around how do we prevent that from happening again. And I think there are broader Dodd-Frank regulatory reforms that are being looked at. I am not going to comment on those. I'm not a banking regulatory expert, but certainly the industry needs to look at what the right relationship is with traditional finance to ensure that we are properly insulated as well. But it is certainly not a phenomenon that I think I heard any public official state. The rhetoric has always been, well, crypto is a threat to the financial system, and we saw firsthand that it was actually the other way around.
Does anyone else have a comment on the debanking efforts by regulators?
Yeah, I mean, I think certainly, the crypto space and banks have had an uneasy relationship for a long time, since the beginning of crypto, I would say. And it's been very difficult for crypto companies to get banking relationships. I think what happened here, though, is a broader issue around risk. You mentioned Dodd-Frank. I think both the regulators and the banking industry got caught a little flat-footed in terms of some of the things. They spent a lot of time, and me personally, spent a lot of time through the Dodd-Frank years thinking about these things around, the need to understand treasury management and balance sheet management and understand the assets that you have on the books and actually do the testing or stress testing around that, understand liquidity sources and things. And it's a message not only for banks, but for the broader industry as well. When you look at a lot of these, not only crypto, but fintech firms holding all their deposits at one bank, for example. So, but I think, I don't think that the crypto industry, certainly there are risks that are flowing through the banking system. There is a necessity to have banks, and there would be on and off ramps for crypto firms with banks, but that's not dissimilar to any other type of, non-bank provider of financial products and services. And then it comes really to the risk management component. And that's what, we tell our clients, or we tell banks that are looking to onboard crypto firms, is that, it's just, you just need to understand the risk. And for crypto firms, it's really doing a good job in terms of having a strong compliance program and doing the things that you need to do as whether you're regulated or not. And for banks, it's understanding, what is the exposure there? What are the business activities happening? Where are they happening? And to be able to build a fence around that. So there should not be this uneasy relationship, but for, a lot of emphasis from a regulatory perspective. And, again, that goes back to some of the underlying uncertainty for crypto firms in terms of how they're regulated or what actually the activities are.
If I could also jump here as well, because I'm seeing a lot of this and talking to a lot of our companies as well. I don't think SVB was a crypto problem, but the story has sort of perpetuated from there. And both traditional finance and regulators are seeing it as a crypto problem across the world. And that is sort of the heart of the issue here. There are many traditional financial institutions that are refusing to bank with crypto companies, and they see crypto companies as a homogenous group. So there are trade associations that have crypto in the name, but don't hold any crypto, that are unable to get bank accounts. And there are companies that are startups that have good reserves that have sort of USDC or some sort of crypto in the background, and they can't get banking relationships because the bank is telling them they're involved with crypto, whatever that means. And look, I'm a CCO. I appreciate the importance of assessing risk and thinking about it that way. And I don't think that traditional financial institutions have an easy path here, and they really know what to do, particularly with the messaging coming out of particularly US regulators, but regulators all over the world about the risks associated with crypto. I've had multiple conversations with banking regulators across the world, and a message that I've heard at least twice is, FTX to them, although it, was a kick in the butt to like start doing something different, it showed them that contagion wasn't widespread when it came to crypto. But this banking situation they're seeing as a real contagion problem for crypto with the larger traditional financial institutions. And it would be very helpful, and something that we're pushing a lot of regulators and policymakers to encourage banking regulators to come out and say, not only is crypto risky and maybe you should reconsider whether you want to bank with them or think about the risks associated, but rather how they should be thinking about it. And, something came out this week from Hong Kong regulators where they're going to put banking regulators and also traditional private sector financial institutions in a room to talk about the right ways to bank this sector. And just that process of the public-private sector collaboration that I think John was speaking about earlier can make a really big difference in this space.
Let me ask more broadly than banking. As several have mentioned, the last year there was this series of scandals and collapses around crypto, including FTX, but also Terra Luna and Celsius and various other companies. Jesse, let me start with you, since you work with a variety of startups in this area. How can companies that are in the crypto sector in some way convince regulators that they're taking appropriate steps, whether it's protecting investors, illicit finance, that they're able to be compliant entities and meet those needs?
It's a really great question, and it's something that I have been working with these companies to try and perpetuate. And I guess my answer comes back to depends on which regulator and where and what the messaging is. And, I think that Caroline and I can both understand how regulators sort of wake up every day, essentially hearing the worst things that are happening and trying to think, could have I prevented that? How do I prevent the next thing from happening? And so I think just entering the room with a regulator, understanding that they always have worst case scenario on their mind. And so they want to make sure that you are not banking sanctions or working with sanction actors, that you are thinking about illicit finance, that you are making sure that those are priorities for you, because that is their priority. And so I think coming into the room, not on the defensive of you or guys are attacking crypto or you don't really understand the value here, but instead thinking about what their priorities are and addressing it, and then showing also how this technology can improve and address their priorities is sort of the number one goal here. But in a lot of ways, right now is not the best time to be engaging in the United States that much. Instead, like the crypto community should take this as an opportunity to not only build, but also build their sort of compliance, regulatory, forward foot thinking in this space. And sort of one thing that we are really pushing is figuring out a public-private sector collaboration when it comes to cybersecurity. And the reason that we're focusing on that is because not everyone, as I've said many times in the crypto community, is the same, and everyone has different opinions on how it should be regulated, whether it should be regulated. But one thing that most people can agree on is we want the space to be safe. We don't want there to be hacks. We don't want smart contracts to not be audited. We want to figure out a way to make cybersecurity a priority. And the government can agree on that too. So it's like one sort of space that everyone can get behind and that we can start working on. And so there's a variety of things that we can learn from Fintech and from traditional finance on how public-private sector collaboration here has been successful.
I was going to call on you next.
Oh, awesome. Thank you. No, and just also to Jesse's point, I think, and also to the previous conversation, I think one of the problems has been is that the firms haven't always had the tools that they need to properly understand the risks and to be able to control them. I would say from a financial crime perspective, that is one of the most developed areas where we have a number of providers, including TRM, but a number of others who have the tooling to help businesses really robustly protect against financial crime and to understand the risk and crucially feed that back to regulators and supervisors, so we all have a much better understanding of actually what is the nature of illicit finance in this space. we have that developed tooling because we have a developed regulatory framework in that area, which is given to us by the Financial Action Task Force, or FATF. When we think about banking stability, investor protection, and consumer protection, we don't have international standards in crypto for that yet. Fingers crossed will happen by the end of the year through IOSCO and the Financial Stability Board. But because we don't have sort of clear regulations or regulatory drivers around that, we haven't seen the tools develop to the same extent. And thus, firms and regulators don't have what they need to be able to establish what the risks are. So that all sort of perpetuates the issue. And then we see many more weaknesses for investors and retail consumers.
I think also having sat, thanks, John. I think also having sat on the other side of the table as a policy official, we need to be realistic in the industry about what is happening today and what is the art of the possible. And the reason I think we've all joined this space, if I could speak for my panelists and then when we introduced ourselves, is because we do see the art of the possible, and it's really exciting. And there are really exciting things going on today. But I think when we have these conversations with government officials around what is happening today, we need to be realistic around here are the use cases, here are the populations we're affecting, and how, regulatory clarity or how, increased private-public collaboration can help see those future goals without sort of overpromising that this is what the technology can do today. And I think that that's where a lot of conversations lie today, which is, well, blockchain has been around, or Bitcoin has been around now for a long time. And I thought by this point we were supposed to solve all the financial inclusion and underbanked and unbanked issues, and that's not happening. Well, it takes time. The internet wasn't built in a day, right? As we like to say, we're still in the dial-up phase. But I think there's really exciting innovation that's happening, but we just have to be precise and realistic about what that is.
Yeah, and I would just add, I think industry should continue to do a good job with the things that we can control. And in terms of on the compliance and risk management side, certainly, I think if you'd ask law enforcement officials, they really like the transparency and the compliance, especially around the AML piece, around how companies manage the risk in this space. Certainly, it's head and shoulders above anything I used to do in the banking space as a bank CCO. You really would have systems that wouldn't tell you anything, that would generate alerts just for the sake of getting alerts and red flags. Here, you really understand customer behavior, you understand transactions, using products like TRM Labs and other things like that. And there's a real ability to, manage risk and manage things and utilize the technology. And so really, again, it goes back to that point of educating, policymakers around how are these risks. Yes, we understand that you have a mission to protect against certain risks, and this is how we are mitigating those risks from an industry perspective. I think the other issue that needs more work, perhaps, obviously, is this issue around really understanding the frameworks and the classification of assets. As I said earlier, I think there's no real good process around doing so right now. The regulators do have no action letter process. They have things, you can go meet with regulators, but I think it's interesting if you read like the Coinbase's recent blog post around there when they just received the Wells notice and what they went through, and really engaging the regulators and saying, we want to be registered, we want to do these things, but that falling on deaf ears, and perhaps it's an issue of, well, there's still it's difficult also from the regulatory perspective of really understanding of being able to take that leap. So whether it's there's a need for legislative action here, who knows? There has been some legislation that has been proposed. There was a Lummis bill that came out last year that's expected to drop again here in April with an updated and approach to the regulatory framework, perhaps providing more clarity there. There's some legislation around stablecoins that I feel has probably a better chance of going through, but obviously this Congress is really challenging for a number of reasons. But we shall see. That it might take that to kind of force the hand on those larger issues.
Okay, I want to get back in a second to this question about what we might hope for going forward in the U.S. But let me just drill down more on one more substantive topic. Isabella, you mentioned a couple times money laundering, illicit finance, and some of the tools that are available. What's the response to those who say, well, look at, we've seen the North Korean Lazarus Group laundering hundreds of millions of dollars through the Tornado Cash Mixer after a crypto hack. The Commodity Futures Trading Commission just brought an action against Binance, which is the biggest crypto exchange in the world, with quotes from direct messaging about people saying, we know this is someone who should not have access, and we just get them to use another account, or we close our eyes when we think it's terrorist financing. So this seems like it's a big problem. So how can the industry be compliant and convince regulators that they're able to take on this challenge?
Yeah, it's a great question. Yes, I mean, so financial crime in crypto asset space, there is a very hyped conversation. At TRM, we ingest data from about 27 different blockchains. And when we analyze that for illicit activity, we find that it's around 2% of all transactions or have some connection to illicit activity. Now, that is not wildly different to the fiat space, where actually we have no good estimate for how much money is related to illicit finance. So I think it's really important to remember that illicit finance is in no way unique to the crypto or digital asset space. And to go back to previous points that John has made, with the inherent characteristics of the blockchain, the transparency, the immutability, we do have a much better ability to really monitor for these types of crimes. When you point to things like the Lazarus Group, this actually speaks to Jesse's point around cybersecurity. What we see there is the sort of a twofold exploitation of digital assets, both exploiting the infrastructure to hack and steal funds, mostly as we saw in 2022 from hacking bridges between blockchains. North Korea made off with around $3 billion from that last year, but then using the digital asset ecosystem to launder those funds with the hope of being able to off-ramp them into fiat. Now, if we can stop that first phase in terms of the exploitation of the actual infrastructure, and we do that through improving cybersecurity, better public-private partnerships, launching things a bit more slowly so that they can be really robustly tested, then we sort of tick that first box. Then when we look at the laundering within the system, it's about using tools like TRM, where we can increase the friction in moving illicit assets between parts of the ecosystem to try and slow that down. But another sort of really exciting thing for the geeks on this panel about the digital asset space is that we have a real opportunity to recover more assets than we do in traditional finance. So very recently, we saw I think a quantity of assets returned from the Harmony Bridge hack. And that's because we can share information much more quickly. We have off-ramps still in the intermediated space to freeze funds and then return them to victims or to law enforcement. So yes, there is an illicit finance problem. People will always exploit new technologies for their personal gain, but we have to be capitalizing on those opportunities from the characteristics of the technology that will help us stop this problem.
Caroline, how do stablecoins like USDC protect against those financial crime risks on blockchain?
Great question. Circle has a robust compliance program that we work with TRM to implement. Actually, we're big TRM fans here. Isabella didn't pay me to say that, I swear. But I think again, it's this theme of that you can see not only Circle is not the only company that can see USDC moving on chain. Anyone can see how stablecoins, USDC, and others move on chain and can then track those assets. And I think what's really exciting right now in the illicit finance space is this conversation around what are and how can we implement privacy standards while still getting the benefits of the pseudo-anonymity that blockchains provide. And I use the word pseudo-anonymity quite purposely. I think there's this misconceived perspective still from the early days of Bitcoin that everything is anonymous, and there's no know your customer due diligence being done. Those on and off ramps very much do those robust due diligence. But blockchain has the ability to kind of sit on top of some innovative technology like zero knowledge proofs to ensure that people do have some semblance of privacy when they're transacting. In addition to capitalizing on the transparency that blockchains can provide. So, for instance, we recently implemented a program with UNHCR to provide internally displaced persons in Eastern Europe from Ukraine cash via USDC. So they will receive USDC and they can cash out anywhere. Well, why is this better than simply providing cash? Is because now we can trace where those USDC flows are going and ensure that they're not going to anyone who A, isn't an internally displaced person, but B, might have ties to illicit finance. But there's also then the privacy angle on top of that to ensure that people then can privately send and save and store that money, where some governments may want insight and access to that. This technology can shield that from kind of the prying eyes of authoritarian governments and others. So an exciting place where I think the fundamentals of anti-money laundering are the same, whether you're in traditional finance or you're using digital assets on chain. But digital assets on chain have so many added benefits of insight that can really make tracing and recovery faster and more effective.
Okay, we've got only about 6 or 7 minutes left on the panel. There's so much more that we could dig into here, but let me ask each of you to answer just one final question, which I think will take us to the end, which is there any hope going forward? As you've all described, we're somewhat at an impasse in the U.S. in terms of not having a comprehensive framework and all of this tension around the banking sector, tension between regulators. How do we go forward here in the U.S.? How do you see that happening? Jesse, let me start with you.
I am always going to be hopeful and optimistic. So hopefully I can start this off that way, particularly because there is a lot of pessimism right now in the space. I guess I will take it a few different ways. First, although there is a lot of enforcement actions and although there is a lot of negative publicity and politics around this space, there's first a lot to learn from these enforcement actions on what to focus on, where to be building, where to make sure that you are plugging the holes for anything that you are building. And then also on the political side, like although the news is and politics are sort of jumping into the bad news, there are a lot of amazing minds in government and working with government to understand this technology, to promote this technology, to focus on innovation. And although they're not the loudest voices right now, they are there and they want to understand this. So let's just start from that hopeful place. I also think, and just to go back to some of the messaging that I was talking about before, this is a time to be a little bit quieter in the ecosystem and prove that we are ready to be a mature space. And by working on cybersecurity, by promoting the different technological innovations that leverage the blockchain technology and the programmability that Caroline was talking about of digital assets to address what regulators are focusing on is like absolutely key. I just don't think there's enough conversation sometimes when you're in the policy room and the regulator room, because we're always on the defensive saying, no, we're not all scary, we're not all risky, we're not all these bad actors, but there is a lot of building to be done. You can think about a new way to do SAR reporting. You can think about a new way to wrap digital tokens to make sure that you're not interacting with a sanction actor. There's just immense possibility here. So if we just keep building and we keep focusing on cybersecurity, there will come a time when this will turn, and we also will need to keep engaging internationally, because we have to remember that there's a big world out there and there's a lot of really thoughtful leaders in this space.
John, what's your take?
I'm also still very bullish and very optimistic. I think, as Carolyn mentioned, we're still very much in the dial-up phase. I mean, just from a industry perspective, a use case perspective around the technology, and I think it's really exciting to see. We're still seeing a lot of startups, a lot of early stage companies come into the space, as well as some companies that have been in the space for a long time grow and mature. I do think this, this is a bit of a reset, right? We're going through this stage where there's enforcement actions. It's, weeding out bad actors. It's also establishing some of the frameworks or the roadmap, as Jesse mentioned, in terms of, what you can or should not be looking at. I think there's been a lot of encouragement in terms of some of the bigger areas. We mentioned financial crimes and AML. A lot has happened there. A lot has been kind of regulated in that space, dating back to when FinCEN first issued regulations, and some of the work globally from a FATF perspective. I think more and more that we can get these global bodies working towards at least some minimum standards. That's a great thing. AML is one area that you're always going to see enforcement actions, whether it's big banks or crypto firms and the like. But I think with the industry, we just need to see a maturation here, and we're seeing it. I think a lot of the companies in the space are starting to dedicate more resources to things like engaging governments, working on compliance issues and the like. And I think where we need to really focus now is around some of these things around establishing what the framework is, especially in the US, where we have so many regulatory agencies and so many people who could have a hand in the pot here. Like what really should be the framework, and get some certainty there. And then what is the interplay between the traditional finance and these other firms, whether it's especially the banking space. A lot of these firms do rely on banks, and will we ever get to a point where we get some bank charters or fully reserved banks, as Circle has said, and things like that. I think just working through those issues now, we have as I mentioned, it's reactive. Now we have a lot of discussions happening, which are good. The more and more discussions happening, you tend to lead to answers. So
I just want to make sure we get to the other two speakers. Wrap up. Sorry, Isabella.
Thanks. Yes, no, I'll be quick. I think we've got to be positive because it can only get clearer, right? And I think one of the places that some of that clarity might come from is, to John's point, some of the international conversations that are happening at the moment. G7, G20. There's some interesting conversations happening that has to help continue to improve the thinking at the international level. One other area I would say that there could be some interesting opportunities around is in DeFi. Not saying that we necessarily need regulation for it, but we will have the executive branch risk assessment coming out on that at some point. And that will give a really good sense of where the administration is thinking about risks, looking at the opportunities of that technology, and give the industry hopefully a good opportunity to respond to that.
Caroline.
And I think with about 30 seconds, I'll say I'm also feeling optimistic. The technology is here to stay, and the excitement and developers are continuing to innovate. And so we'll see regulation come, I think, because we have to see regulation come. But kind of broadly, I think that this is, again, akin to the early 2000s, but we'll see Amazon's and other tech companies that made it, and pets.com that didn't. But ultimately, the technology is here to stay, and governments around the world are looking into it and incorporating it at times and into their own payment systems.
Thank you all for a terrific conversation. Again, we could go on for a while longer, but you've given everyone here a lot of specifics and material and insights on this topic. So thank you all. Turn it back over to Trevor.
Thank you, everyone, for your time. It's been an incredibly illuminating conversation, and we really appreciate the dialogue and the perspective that you've shared. To everyone else on the line watching, we got a jam-packed day full of content and further information. So I guess we'll be transferring over to the fireside chat shortly. Thanks, everybody.
Thank you.
Hi, Vanessa. Good morning.
Good morning. How are you?
I'm good. How are you?
I'm good, thanks. Are you East Coast or West Coast this morning?
I am East Coast, Philadelphia. What about you?
West Coast.
Okay, well, it's early for you, so thank you for joining.
No problem. No problem.
We'll just wait for Marianne, and then I will get started with introductions.
Sounds good. Anything you need?
I think we're all set. Just
Terrific.
excited to have you on.
Did we get lots of people signed up?
Yeah, a good number. So there's a lot of people watching right now as we speak.
Excellent.
Great, I see Marianne just joined. Hi, Marianne.
Hello, how are you?
Good, good. Thank you so much for joining. We don't see your video yet, but hopefully it'll come on.
Yes, I'm going to turn on camera in just a moment. I just realized I have a lot of stuff in the background. Let me just scoot it out of the way real quick. Also, my lighting is so poor. I really need to work on a better lighting in this room of mine. Just a moment.
No worries. I'm sure you'll look great.
Well, it's just the lighting is very, very bad. Yeah. I think that's a little bit better. I close the curtains and okay. Hi.
Oh, great.
Hi.
Good morning. How are you?
I'm good. How are you? Lovely to see you.
Likewise.
Is that your true background? It's not a virtual background?
That's my actual background.
I love it. Is that artwork behind you?
Yeah, it's an artist from Brooklyn actually, and you can't tell on Zoom, but it's super three-dimensional. It's like 6 inches thick, and he paints all these layers and then he gouges them out. So it's very tactile.
It's so cool. I love it. I have the most boring office background. I should probably do a virtual one, but that's okay. Is my lighting too terrible?
No, you look great.
Okay. It just feels like I don't know, pale. Maybe I can adjust within Zoom. I'm not sure, but anyway, I'm otherwise quite ready if you are.
Perfect. We'll just get started. So good morning, everyone. For those of you who are joining right now, I am Sanjana, one of the co-chairs of the Wharton Fintech Conference, and I'm thrilled to be introducing Vanessa Colella and Marianne Azevedo for our next fireside chat. Vanessa is currently the head of innovation and digital partnerships at Visa. In this role, Vanessa leads the development and commercialization of Visa's products and solutions for big tech, fintech, and platform partners. She also leads Visa's global network of innovation centers. Before joining Visa, she served as the Chief Innovation Officer at Citi and as the lead for Citi Ventures and Citi Productivity. Vanessa has been consistently recognized as a leader in innovation, fintech, and venture capital investing. She was named a Big Innovation Award winner in 2021 and 2022 by the Business Intelligence Group and one of the most influential innovators in 2021 by Innovation Leader. In 2020, Colella received a Silver Stevie Award for her work as a champion of innovation. Marianne is currently a senior reporter covering fintech at TechCrunch. She has more than 20 years of business reporting and editing experience for publications such as FinLedger, Crunchbase News, Crane, Forbes, and Silicon Valley Business Journal. Prior to joining TechCrunch in 2021, she earned numerous awards, including the New York Times Chairman's Award and others for breaking news coverage. Once again, we're super humbled to have you both joining us. And now over to you, Marianne.
Thank you so much for having me. I'm very excited. Let's just jump in. Vanessa, it's great to see you. You have an illustrious career. It's very impressive. And I think I would love to hear more details from you about this journey. You started, you didn't start, but you were at McKinsey, then you were at Citi, and now you're at Visa. What were some of the biggest inflection points? How did you get to where you are today?
First of all, good morning. So nice to see you, Marianne, and thank you all for inviting us to the Wharton Fintech podcast video, I guess. Career early in the morning. So I actually started out my career as a teacher. I was part of the Charter Corps of Teach for America. I taught junior high and high school science. I ended up staying in teaching for about 6 years before I went back to grad school. And when I got out of grad school, I realized I'd been in education my entire life, and I didn't really know that much about business. And I was lucky enough to get into consulting, which really was my entree into the business world. I spent a little bit over 6 years at McKinsey, working mostly in technology and media companies. And like many people after consulting, decided that I wanted to try my hand at operating something as opposed to advising people about operating something. And I went and worked for Yahoo. I was head of marketing and then head of insights and data for the company. Post Yahoo, got into venture capital, and really got into venture capital because I was very interested in running a small company. It was during the financial crisis, and I got a call from Citi. And, it was obviously not a company that was small and not a company I was ever going to run. But I became really intrigued with how entrenched financial services is in the lives of, individuals, businesses, communities, and what we might be able to do to, at that point, improve that, since the financial crisis was obviously a huge, problem for so many people. So joined Citi, had learned amazing things there, and came to Visa almost exactly a year ago. And where, as was said a minute ago, I'm really privileged to have a view and lead not only our fintech clients, but those fintechs who have grown into big techs over the years. So really getting a window into, the players, I think, who will have, outsized influence on our ecosystem. And I think, if there's one kind of thread throughout all of that, what I love doing more than anything is participating in institutions that are trying to drive positive change in the world. And, there's not so much in common between, teaching junior high school science and what I do today. But for me, it's all about can we, what can all of our institutions do to uplift people? And it's something that drew me to Visa when I joined a little while ago.
First of all, you are not the first person who I have met who was a teacher and then ended up somehow in this world of VC and venture. So I think it's a fascinating, progression, but I can see where the skill set that a teacher has would serve you well in what you do. But and I also love why you're so drawn to this, because I feel much the same way as a fintech reporter. Like I'm most excited about companies that really have potential to make a positive impact, changing lives literally, which sounds cliche, but I mean, what good is technology if it's not really doing things to improve lives or improve the world? So tell us a little bit more specifically about your role at Visa. Like what is the exact role? What are your responsibilities? What do you do? And what excited you about joining the company to begin with?
Yeah, absolutely. I think, during the pandemic, my young son said, I think what you do, Mom, is talk on Zoom and answer email, which does, of course, describe what a lot of us do. But more specifically, so I care for all of our digital clients. So imagine everything from Amazon, Apple, PayPal, Square, Grab, Klarna, the large digital platform companies around the world, all the way to, very market specific fintechs. So we really see the whole gamut of clients, from the largest digital players to the players who are just starting out but have aspirations to really change some aspect of how people pay and get paid. Within that, I also care for all of our crypto clients, and my team is responsible for crypto product development at Visa as well. And then I run all of our innovation for the company. So we've got, I don't know, about 17 innovation centers and studios around the world. Probably 6 or 7 of them are really at a quite decent scale. And so through that, we work with both our digital partners and our more traditional clients to tackle, the questions that they're grappling with. How do they want to redefine loyalty? How should a company that has been maybe a more traditional merchant think about embedding finance or embedding payments in their offering? So through all of that, we end up getting a really privileged position to interact with these companies, from the largest companies on the planet to the startups with a handful of women and an idea, who are trying to think about how do we all use technology to drive that next generation of financial services.
Yeah, I've been covering fintech now for about 3 years. And one of the things that it has come up quite a lot is, of course, this tension that exists between like existing players and incumbents and the fintechs. So you're in a unique position, I think. And I feel like, at least from my perspective, that tension exists, but it's not as, I guess, heightened as it once was. I feel like there's become more of this acceptance on both sides, that you're not really, it really should be so much this competition as so much as how can we work together to make things better, to improve financial services for people across the globe. So I feel like I'm seeing more and more of this, like, I guess, cooperation, collaboration between fintechs and incumbents such as Visa. And when you talk about innovation centers, one thing I'm curious about is what does innovation mean for a big payments network like Visa?
Yeah, so someone there. So first of all, I completely agree with you, Marianne, that the narrative and the posture has shifted quite a bit, I would say, over the past maybe 5 to 7 years, in terms of, is fintech out to kind of destroy all the incumbent companies, or is there an opportunity to work together? And I think that's actually pretty natural in the evolution of startups, where at the very, very beginning, it's like we want to come in and we want to change everything, and then there comes this realization that that there are a lot of things that work well today, but there still are very many things that don't work well. So if you think about the number of people around the planet who are still unbanked or underbanked, who don't have access to paying or getting paid, and so what ends up happening over time is all of the parties sort of start to talk a little bit as they're competing with one another, and then they realize, wow, we have this great idea about how to do something different in a startup, but maybe we don't have the distribution, or we aren't large enough to be global. So how do we think about working with a company like Visa, who operates in close to 200 countries around the world, and already has relationships with tens of millions of merchants and hundreds of millions of individuals. Like, how do we leverage that in order to take whatever our interesting new ideas and get it to have much broader reach? So I do agree with you that that narrative has changed. Of course, there are still areas of competition. That's natural. But my view, maybe as a former biologist, is like competition is actually a good thing, right? Because competition at the end of the day is what moves the frontier forward, right? As much as there's collaboration and cooperation today, that initial competition from the fintech startups around the world caused the incumbents to kind of be a little bit more alert and say, like, hey, we should really, move forward. We should think about whether this is something we want to offer or partner with. And so I'm actually a firm believer in both the potential of collaboration and the importance of competition as we think about sort of raising all boats, if you will. On the innovation topic. No, sorry, go ahead.
I was going to say, well, it's human nature, right, to be competitive. Like, that's just kind of like, I think, ingrained in most of us, is that we can't help it but be competitive. And like you said, maybe in many ways that's a good thing, so that we're not complacent. By the way, I love your cat back there crawling on the shelves. It's awesome. It's awesome.
Yes, it's kind of a constant here. This is the cat who comes in the morning. If we were doing this in the afternoon, it would be the other one.
Oh my gosh, love it. But anyway, yeah, I mean, I do think it is clear that competition can be healthy, because otherwise companies can get too comfortable, too complacent, and then innovation stalls, right? So we kind of sometimes need to have a lot of fires lit under us to move a little bit faster, right?
Yeah, and by the way, just on that, I think another thing that fintech has really done for the industry is take a look at where the gaps are, right? So we were talking a minute ago about sort of underbanked and unbanked, right? How do you think about the people who, and the businesses who weren't traditionally as well served by maybe the large banks around the world, and how do we think about shifting that? And I think what that's done is really opened up the opportunity, not only for fintechs, but for incumbents as well, to think about, in Visa's case, right, how do we help uplift everyone everywhere, right? How, not everyone has a card. So how do we think about moving beyond that construct, so that we can include more people in being able to sort of seamlessly exchange value, seamlessly transfer money, because that's, at the end of the day, that's the lifeblood of economies around the world. And so I think that's really shifted. If we were to rewind 10 or 15 years ago, it was a very different dialogue. And I think one thing that the fintech industry in kind of mass throughout the whole portfolio has done is help shift that notion of access and inclusion across the industry.
Yeah, I love that. That actually makes me happy. But as an organization, one as large as Visa, you have so many choices, right, of fintech that you could choose to work with or partner with. How do you decide? Like, do you have a specific, framework in place to evaluate fintechs, or how do you screen them? I guess, is there any kind of criteria that you use specifically when evaluating fintechs as potential partners?
I mean, obviously, an organization, as you say, that has the scale and distribution of Visa, if it's a fintech that's at the idea and PowerPoint stage, it's probably a little bit too early for us. But we have a philosophy that we are in many ways as the network of networks, right? We're in many ways like the curator of an ecosystem. And those of you who've spent a lot of time in payments will be familiar with like the 4-party system. I sometimes explain this to my son as like, if you had a terrarium, you'd have like a frog, a cricket, a bowl of water, and a rock. And like, that's how things work in the 4-party system until the frog eats the cricket, then you've got to throw another one in. But we don't work in that ecosystem anymore, right? It's much more complicated than that. It's almost like someone took an entire rainforest and shoved it in the terrarium, and now you've got, literally thousands of different types of players in there. And as curators of that ecosystem, as caretakers of that, we want to make sure, access isn't just about individuals getting access to the financial system. It's actually about companies getting access to the financial system as well, right? How do we enable fintechs to bring their idea into the financial system and get connected and be able to facilitate money movement, et cetera? And so we have a very strong philosophy, both at Visa and in my team specifically, that it is our job to work with the largest players on the digital side, all the way through to the players who are just starting out. Now, of course, we have a lot of programs at Visa, because if you're just starting out, you're not going to have, a dedicated account team. It's going to feel a lot more self-service. It's, but I think that notion of, it's not our job as a network to choose winners and losers. It is our job to create an accessible playing field for everyone, and to help those fintechs who are starting out get that access and get that distribution. And then, my view has always been, people think about startups as like things that happen fast. It actually takes quite a long time to build a startup. For all the entrepreneurs who are watching, right? People are like, oh, you were successful overnight, and you're thinking, yeah, 7 years plus one overnight. Like, it's a really long road. And our view at Visa is that we stick with our companies over time. And then over time, we, together assess, gee, as you're maturing, are there things that we could do together that are more in depth now than maybe what we could have done at the beginning when you were just starting out? And the last thing I would say is it's really important as the network. Part of the reason that we're so passionate about the fintech space is that the value of any network is kind of directly proportional to the participants on that network. And obviously, Visa has a massive reach and set of participants around the world, from merchants to banks to individual consumers. We think it's very important that we make it straightforward and seamless for fintechs to participate in the network as well, because it helps them scale efficiently and effectively, and it helps us deliver value to the ecosystem. So we try to keep a really open mind and grow with fintechs as they grow.
Yeah, I mean, I think it's clear that even very large players such as Visa might recognize sometimes too that, hey, it makes more sense to use another company's technology, or rather than try to like build it on our own, right? It's just that, it just makes more sense. It's more efficient. But we've talked a bit about the past, but I'd like to shift a little bit more towards the future. Where do you see the larger networks, Visa in particular? What kind of role do you see these networks playing in the disruption of financial services over the next, say, 5 to 10 years?
Yeah, I mean, I think, what's most interesting about disruption, it's a little bit like we were saying about startups a moment ago. We live in an era right now with, clickbait titles and all this stuff, that everything feels like it happens incredibly quickly. But actually change is slow. Change, in general, takes quite a lot of time. And I think, you see the networks, we've got 60 years of experience, connecting people around the world, making it possible for all the things that we just take for granted today. Like, when I was a kid, you didn't take for granted that if you were you were lucky enough to travel overseas, you could automatically pay for something, right? There's a lot involved in that, including you had to like get traveler's checks and sign them, and plan out.
I forgot about those.
Yeah, well, pays to be old sometimes. So I think there's been already so much innovation that's gone on in the payment space, from just connecting people, allowing people to pay, to coming out with prepaid and debit, and more recently, working with, wallet companies, thinking about how do we make it safer for all the participants in the ecosystem through tokenization, so that you actually end up with credentials that are much more difficult to be, used in some sort of nefarious way. So I think as we look forward, that pace of innovation will just continue to push on. So things I'm particularly interested in and watching, I'm particularly interested in identity. I think that, and data obviously right along with that, but how do we think about that marriage of value exchange and identity? Because obviously you can't pull them apart in some ways, right? In order for things to be safe and secure, if I want to send you money, I have to have trust and confidence that on the other end of that transaction is actually you.
Right.
Otherwise, I'm much less likely to make that transaction. So I think, digital identity and data are a large space that occupy a lot of my mind. I've been sort of fascinated with embedded finance for probably at least the last 5 years, because I think the ability to, there are very few times in your life when you wake up in the morning and say, like, I'm so excited today to make a payment. Right? It's just not. I mean, I would say maybe the two exceptions to that might be, and this is a bit of a US-centric view probably, but the two exceptions to that might be the first time you buy a house, and if you're someone who's buying a wedding ring or an engagement ring. Outside of that, it's very hard to conjure up the moment when you say, like, I'm so excited to make this payment.
Right.
But actually, my last student loan payment, that would be my third.
I get that. Maybe first, even actually.
Exactly. But I think that by making value exchange and the payments that go with that sort of seamlessly embedded, will open up all sorts of things that we aren't even thinking about right now. And then last but not least, I think everyone, no matter whether you're in fintech, whether you just joined us this morning because it seemed tangentially interesting, and you're in another industry, have to be paying extremely close attention to AI. And I think, while it's been around, I think the term was coined in 1965. AI has been around in many ways for a long time. The pace of change and development of that technology is frankly mind-boggling. And hang on just one second. Thank you. There's no school today, so there's lots going on in my apartment. My apologies.
No worries.
I think, if nothing else, ChatGPT has given us all not just an intellectual understanding of the possibility of AI, but like a gut understanding of, like, wow, it's unbelievable what just got created. And so I think, all of us should be thinking about both the promise of what AI can bring to our industry, and also where we have to guard against bias, there's just so much in there that I know for me, is like, it's hard to stay ahead of or apace with.
Yes, I know all this, I guess this AI explosion. I felt like, as you mentioned, AI it's not new. It's been around for a long time, but like all of a sudden, I feel like the ChatGPT introduction, it just kind of, everything went nuts. It kind of just fueled, as you had mentioned earlier, a lot of competition in the space too. So everyone's like scrambling to build something smarter and more intelligent. But you're right. This is something that I feel like we have to be very careful with too, because you can't, there are certain things you just cannot rush. And, if you do rush, there could be big problems. So I can imagine that would present for a network like Visa, both opportunity and challenges. So I am curious to see how that plays out over time. But what would you say are other areas that are opportunities or challenges for Visa? And also, what do you think about regulation? Do you feel like there needs to be greater amounts of it in the industry?
Wow. Great, very good question. So first, there's so many. Part of what I love about the space is that there's kind of endless opportunity. So we're constantly thinking about things that might sound mundane but are really important, like how do we continually improve security, safety, soundness, right? We run a network that operates so many transactions every second, and that that ability to to catch fraud, to help people dispute things that they don't think were accurate. I think we take a lot of those things for granted as consumers, right? Like, oh, I see this charge and like that wasn't me. You can there's recourse there, right? There's something that you can do, but the work that goes on the back end to kind of continually push the envelope in those spaces. Again, it's not maybe the shiniest object. It's not the sort of sexiest part of running the network, but it's a critically important part of running the network. And so I think, we try as hard as we try on the consumer and business facing side of what we do. We also spend a huge amount of time on security, on fraud, on identity, on the sort of nuts and bolts that are necessary to make the network function, and to make sure that as people are trying to pay and be paid, money is moving in the right places to the right people. So there's a lot that goes on behind the scenes to make it so seamless, as you well know.
Yeah, no, I can imagine. I'd like to go back in time again. When you were at Citi for, was it 10 years? Is that
12 years?
Okay, yeah, and you led Citi Ventures, right, for some time?
Yep.
Okay, so obviously, of course, I'm really interested in your experience doing that. In fact, I remember I'm pretty sure that we talked when you were in that role, when I covered a raise of one of the startups that you invested in. So thinking back to that time, can you remember some of the investments that you may have led or were involved in that really just stood out in your mind that you were excited about, or are still around and flourishing, or just really kind of living up to your expectations?
Yeah, I mean, as you know, Marianne, someone who is in the fintech space, right? As an investor, I was privileged enough to lead Citi Ventures for about 10 years, and we built that franchise into something that I think helped a lot of startups get connected to the financial services ecosystem and thrive in the process. It's always impossible to pick amongst your investments because it's sort of like picking amongst your children.
Right, I get it.
I think probably, I take the most pride, not just in our investments that did incredibly well, whether you think about Square, Jet, or, I mean, there are lots of investments that ended up being, both financially smart investments and companies that really went on to shift the landscape in payments. But I also think a lot about, sort of smaller investments. We were talking about security a minute ago, right? We spent a huge amount of time in the security space. Lots of times those investments don't necessarily get the headlines. But I'll give you an example where we never found enough investment. So for future entrepreneurs who are listening, the money laundering, anti-money laundering space and kind of, fraud space and KYC, you're starting to see more companies there now, but man, that's stuff that it doesn't get talked about a lot, but is like, it's just massively important for the health and the wellness of the overall ecosystem. And so I probably have as many fond memories of companies that if you went on the Citi website, or now at Visa, I work very closely with our venture group at Visa as well. Companies whose names you might never have heard of, as those who you'd sort of check the box and say, yeah, this company became really huge and is now an important part of the ecosystem.
Yeah, I know 2022 was a little bit of a challenging year for the crypto and blockchain space. But I'm curious as to how a network like Visa is thinking about crypto and blockchain, both in terms of risk and product innovation, because obviously, I mean, it may have had some challenges or may have been this crypto winter, but it's not going anywhere. So how are you thinking about crypto and blockchain in terms of your innovation?
It's so important. I mean, we were talking about AI earlier, whether, when you think about new technologies, my view has always been, you have to play the long game, right? So Visa has never been interested in crypto because of its, sort of speculative nature of cryptocurrency. Hang on just one second.
Sure.
Sorry, that's the dog being trapped by the cat that you all saw earlier.
That's okay.
So I think, in something like blockchain, my view is you have to take the long view, right? Not is it, trending today, or is it crypto winter tomorrow, but how are these technologies going to, enable us to do things in the payments and money movement space that we could never have imagined doing before? And that is not something that I think you can time, right? So you don't just as a company sit back and say, well, we're going to wait and we're not going to do anything until all the stars align, and then we're going to, hire a crypto team and see what they think. It's a muscle that you have to build. It's talent that you have to attract and retain and learn from. So we have a very active crypto team. They work not only in the product side, right, looking at where is blockchain likely to be most impactful. What do we think about the use of stable coins? How might that be accretive to the network overall? They also do a lot of thought leadership. They do a tremendous amount of work with central banks around the world as those central banks explore CBDC and try and think about what would it mean to bring digital into central bank currency. And all of that is not because, Marianne, we have the answer in the crypto space, but because we want to be smart enough to ask the best questions, to work with the leading crypto companies. And you asked about regulation earlier. I mean, I think this is a space where we are going to see, because of crypto winter, because of some of the challenges that the industry has had, we're going to see more extensive regulation. And as someone who's been in financial service for a dozen years, I think that will make this part of the industry stronger, even though you'll see growing pains, right? Anything that's new, you'll see growing pains along the way, but I think ultimately that will make the industry stronger.
Yes, I would agree with you. I mean, I think that had there been, I guess, more regulation in place previously, maybe some of the messes that we're currently seeing could have been avoided, at least in part. I mean, of course, it's easy to say in hindsight, but obviously, one of the things we talk about at TechCrunch, it's like, and as you mentioned, startups and technology want to move quickly, you got to move fast, but at the same time, I think it's historically been difficult for the government to keep up with that pace of innovation. So, there's just, it's obviously very much needed. So hopefully we'll see more of that regulation in place to just kind of help put safeguards in for everyone involved, I think, right?
Absolutely. And I think, it's hard for all of us to keep up with all of the innovation that's happening. And so I think sometimes we say it's hard for the regulators to keep up. Let's be honest, right? It's hard for all of us, right? We're all learning something new every single day. It's one of the things that I love about what I'm able to do. I learn something new every day that I didn't know before. The other thing I think that is a challenge when we think about the regulatory lens is that, like many parts of our economy, the regulators have been set up for an era, excuse me, when businesses sort of stayed in their swim lanes, right? And so, certain regulators regulate certain kinds of businesses, and other regulators regulate other kinds of businesses. And the assumption of that was that industry lines are relatively static. And of course, as we all know in the fintech space, and in the digital space more generally, even if we're talking about big tech, right? Our companies, our entrepreneurs don't come into an idea thinking about what they want to do in an industry. They think about solving client problems, right? And look at Grab, a company that I've been involved with for a really long time, right? Starts as a ride sharing company, then realizes, well, we've got to be able to pay the drivers and people have to get paid. Right? And so I think that is an additional complexity for the regulators because they're architected in a particular way. And the current sort of both the pace of change, but just the heterogeneity of these firms, whether in the crypto space or just more broadly in fintech, makes it difficult to figure out how to bring those two things together. So that will get sorted out over time, but it's just part of the growing pains in the industry.
Yeah, I mean, it's a good point. Clearly, there's that saying that everyone's a fintech because so many companies, as you point out, like Grab, realize that at some point that if they want to be more efficient, better serve their customers, and eventually make more money, even that they kind of, as you had also mentioned, you need to embed this kind of thing like payments into your infrastructure. So that I can see where that does kind of make things a little more complicated for those trying to keep oversight over everything. But yeah, no. So then another question, I know we don't have too much time left, but I want to make sure we touch upon this is globalization, right? We one thing that I love about TechCrunch is we cover companies all over the world. We have reporters in all regions from Asia, Africa, and Europe. And so I think one of obviously Visa's strengths as such a large player is it's the fact that you are so global, right, in nature. So let's talk a little bit about that. I mean, how does globalization, how does that impact what you do in addressing innovation, or how do you think about innovation in the lens of globalization?
It's such an important question. Actually, I was privileged enough. I just had my global team in town for the last 4 days. So, people who are, from Singapore, Dubai, London, all around the world. And I think, at the end of the day, commerce, money movement spans everything from, the largest companies who are thinking about moving money around the world to, at the soccer field tomorrow, I will undoubtedly owe some other mom money and I won't be, have any cash on me, and I'll have to figure out, which network they're on so I can, pay her back. And I at Visa, we believe incredibly strongly in the power of both our global network and what's happening in individual markets. So we think about it as like global plus regional plus markets. Like, how do you bring all that together? Because the way that people exchange value in Kenya is completely different than the way that people exchange value in Peru, even if it's still this farmer wanting to get advanced credit based upon this crop, and so we think it's imperative. It's not just important; it's imperative that innovation is not just because I happen to have lived in Silicon Valley for 25 years, but like this is not the hotbed of all innovation in payments. So we spend enormous amounts of time and energy developing a deep understanding of local markets. Also, obviously, trying to understand where are there similarities, right? Where are similarities in the types of bank-led wallets that you see in much of Europe, and sort of some of the more private wallets that you're seeing spring up in Latin America, right? What are the similarities there, and how can we serve both of those types of clients? But you've got to know the specifics of the use case, and then the magic is if you can marry those specifics to larger solutions that serve more than one market. But I've only been at Visa for a year, but I'm incredibly impressed by the depth of local knowledge. And then it's just always a challenge to like, how do you pull all that stuff together? Because it's many countries around the world.
Right. And every country has, different laws, different networks,
different customs. Right. The customs are different in different places. And so it's both. I often say, like, I think we tend to over rotate on just the technology of it. Like, oh, in this country they use, mobile phone networks. In this country they use, RTP, and in this country the technology is obviously important, but the other thing, excuse me, the other thing that varies market by market is just behavior, right?
Yes.
Culture, customs, and so I think it's that combination of the technology, the regulatory and legal environment, and kind of the cultural and behavior environment. And it's where you can pull all three of those together and say, oh, like, here's something we could do differently. That's where the magic is.
Yes, I agree. And I think it's a very crucial piece that you bring up in terms of cultural. And that's why it's so important to have people on the ground, right? Because trying to understand that, how people operate, how they think, what their expectations are is really, really important. So I think that's a very crucial point. So I know we only have about 2 minutes now, but is there anything we haven't covered you feel is important to know or mention that the audience may just want to hear?
Well, as you know, you're such a pleasure to talk to, so we could probably talk all day.
I know.
I think the probably the most important thing is where we started, especially for people out there who are starting companies or who are scaling companies. There is a lot of change right now. But we talked about AI, we talked about blockchain, we talked about inclusion. There's always moments that feel like kind of the Cambrian explosion, and then like things settle in, and then like a lot of stuff happens and things settle in. I think it's so critical that as an industry, we think broadly about the implications of what we're building, and we think about those implications in the context of, what can we do across the world that will help people, help businesses, help communities thrive. And if as an industry we can do that, it will bring great success to the industry, but it will also bring great success to, the small businesses around the world who have trouble getting funding, to individuals around the world who are looking to pay and be paid, to, farmers around the world, to people involved in logistics. There's a whole swath of the economy that if the combined talent of our audience today is thinking about what they can do to advance, I think we will unlock, percentage points of GDP for countries around the world.
Agreed. Very well said. And perfect timing. Thank you so much. Really enjoyed this.
Thank you. Appreciate you making the time. It's so nice to see you again.
Of course. Yes, likewise.
Thank you both for taking the time to share your insights and perspectives. I think so many of the topics you touched upon are just so important today, especially that intersection of data security and identity, especially in an industry where trust is probably the most important thing that shapes a consumer's choice. So thank you both again. And for all the attendees, we'll be moving back to our panel. So just make sure to join either the FinTech or blockchain track at noon. Thank you both. Bye.
Thank you. Take care.
Bye. Karen.
Hello.
Hey, Rich. How's it going?
Hey, nice to meet you face to face.
Nice to meet you too.
Yep. I know we've been chatting over email. Where are you located at? Just out of curiosity.
Still in Philadelphia, actually.
I'm sorry?
Philadelphia.
Oh, Philadelphia. Okay. I'm over here in Denver myself.
Yeah.
So I always like to know because it's wild, just crypto being so global and it never sleeps and you just meet people you never would have expected to. So
yeah. You said you were at East Denver too, right? Early this month.
Yeah, I've been, it's local to me. It's like a 20-minute train ride to get there. Shapeshift used to be a sponsor. My sister's company is currently a sponsor along with some other buddies. But yeah, I go there every year. It's free. It's great. Don't even have to get a hotel room. So it's been, I don't know, the past 4 or 5 years. They just moved venues this year as well. So, but yeah, it's nice. Crypto is, Denver is like an unsuspected crypto hub. We've got a number of people here, a number of just companies that were born out of the area. So it was nice.
Yeah.
Always a nice place. But I'm excited for this panel. I've got all my notes and questions here. So should go pretty smoothly.
Yeah, no, I'm excited. I saw all the questions you came up with. This, I think we're in for a good session.
Yeah, I just tried to give everybody an opportunity to pick and choose what they thought they wanted to talk about because, I mean, I don't know why they asked me of all people, just because I think so highly of everybody's, all the representation on this panel. I was like, wow, really? I was like, okay, of course I'm honored, but I don't even know how they found me. I have no links to Wharton at all. So
10 years of operating experience is definitely no joke. So,
yeah, I'm still going through the Mt. Gox bankruptcy proceedings.
Which one?
Mt. Gox, the first crypto exchange.
Yeah.
Fall. Japan, the Japanese government is finally about to pay everybody out their Bitcoin after, I don't know, since 2013. So yeah, it's been crazy. But this should be exciting. I was taking a look at just all of the companies and platforms and projects represented, just in that little, I don't know what you call it, where it's just like people that are attending that little website. And, Visa was just speaking a second ago, for example, right? And I was like, wow, okay, that's a tough act to follow. It'll be all right.
I think it's going to be a great learning experience for everyone.
Yeah, I've never moderated a panel before, so I did my homework, of course, but I am very comfortable with DeFi and crypto. So my wife was just telling me, she's like, why would you be nervous about that? It's literally the only thing you think and talk about for the past decade. So I was like, yeah, you're right. Okay, let's do it.
Yeah. No, I'm sure today's going to be really good. So we're very excited to have you.
Yeah, I appreciate the reach out from the conference. So it's great timing for me too, because we're actively trying to raise capital, but just getting to network with some individual is going to be very happy. A very happy coincidence that it happened right now. All right, I'm gonna take a quick walk. I'll be right back.
Hey, man, how's it going? No worries.
Hey, how are you? Nice to meet you. I'll play this. Let's see.
Hey, Stephen, how are you doing today?
I'm very good in yourself.
Yeah, happy to have you join us. Thank you.
No worries. Thank you for the invite.
Yeah.
Hey, Stephen, nice to meet you. This is Rich.
Hey, Rich, how's it going?
Good, not bad. Nice warm day in Denver for once.
In Denver?
Yeah, I'm here in Colorado.
And it's a warm day. That's awesome.
Yeah, it's really nice. I got the window open.
That's awesome.
We had a cold snap, so we're finally thawing out.
Yeah, I made
Where are you located at, Stephen?
I'm in Austin.
Oh, you're in Austin? Okay, I was just down there for consensus.
Yeah.
What's up, guys?
Hey, how are you?
I'm sorry, I don't know.
Yeah, how's it going?
I'm at a cafe.
You're still dialing in from Europe, right? Or are you back in the States?
I'm in Seoul right now.
Seoul, oh, okay. All over the world.
Yeah, it's 1 a.m. I'm at a cafe.
Oh, man. They're open that late?
Yeah, there's a few 24-hour cafes in Seoul, so not bad.
Wait, hang on a second. So, yeah, you're telling me you're in a cafe and it's 1 a.m. in the morning?
Yeah. It's Ramadan right now, so I'm up at night. Can't really do much in the day.
That's proper. Well done, sir.
Hey, everyone. Nice to meet you all.
Hey, man.
Hey, Serena.
Hey, David.
Hey, nice to meet you guys.
Hey, nice to meet you.
Thanks, Serena. All right. So it looks like we have quorum, so I will go ahead and kick this off. It is my pleasure to kick off putting the D and DeFi panel. DeFi has been around for a while. Recent events in the industry have underscored the importance of it. We have a wonderful group of panelists who will explore this topic with us today. David is the Vice President of Strategy and Operations at the DYDX Foundation and leads the foundation's growth strategy, as well as business development, partnership, and operations. He was also a core contributor to several DeFi white papers, published in collaboration with the World Economic Forum and the Wharton Blockchain and Digital Asset Project. Serena has been passionate about improving financial accessibility and inclusion since she was an undergrad. After several stints in Web2 Fintech, the start of the pandemic served as her introduction to the world of Web3. She now leads growth at Uniswap Labs. Stephen was previously the president and COO of the Maker Foundation, the entity behind MakerDAO. Now, as CEO of UDHC, he's looking to use his experience to unite the worlds of DeFi and TradeFi. Zahir started off in crypto nearly 7 years ago and has taken on several roles on the investing side. He started off doing directional trading and contributing research insights to Deribit, and is now general partner at the Split Capital Fund. Moderating the panel is Rich, a blockchain veteran with over 10 years of experience in cryptocurrency. After contributing to several successful blockchain projects, he is now working towards making DeFi more accessible. I'll hand over to you, Rich.
Thank you very much for that introduction, and it's really nice to be here today. Thank you to the Wharton FinTech Conference for asking me to moderate. I hold all of the projects that you mentioned, I hold in high regard personally, so it's going to be a pleasure. And I'm going to go ahead and kick it off with what I think is a relatively high-level question, but one that I'm sure everybody wants to provide some input on. What do you think are the main advantages of DeFi relative to more traditional and centralized institutions, whether that's on the traditional finance side or even just centralized crypto entities. And in no particular order, I'd like to get your thoughts.
Gosh, who wants to start? This is a big question. a good, really good one. I mean, look, I think you're asking this question at like a time that it's really easy to answer it in, maybe. It's like post FTX and Silicon Valley Bank and everything else. Like I just say the word self-custody to start with. It's like, yeah, this idea, your funds, your money, your account, you always have access to it and nobody else is going to touch it in between. Feels like something, with real world consequence. In a way, it's like, even a few years ago and talk about self-custody, at least in the US market, it's like, oh, okay, like theoretically that's nice, but like, what does it really mean? I think some like CFI, TradFi failures kind of help us understand better what the risks are. And then maybe someone else wants to talk about interoperability, but that's where I was going to go with it next.
Thank you for kicking it off. I know it's hard to be the first one in the door sometimes, but anybody else want to add to that?
Yeah, I would mention, sorry, someone else want to?
Yeah, go ahead. No, go ahead.
Perfect. Yeah, I would mention that actually one of the more interesting use cases of not DeFi in particular, but just using blockchain in general, is actually the recent FTX bankruptcy claims, which are kind of starting to go around. And one of the interesting processes that's kind of happening as a result of that is because all of these funds have to be tracked. Take USD deposits, they only take USDC, USDT, that kind of, and because you're taking these non-cash like deposits, it actually makes the bankruptcy process so much cleaner, so much more simple. Understand exactly, how much money they have, where there's a break, where there's, whose funds are where. It's all traceable, and there's no, weird issues that kind of arise as a result. When you compare this to other bankruptcy claims like Lehman Brothers or Poker Stars or Full Tilt, or these processes took years to do, and because this is all on blockchain technology, this is all in decentralized ledger. You're able to do this process in a few weeks, right? So now everyone knows exactly what their claim balance is, and it's having that level of transparency, right? But and making it very, very clear to everyone, exactly what's going on. And I think one of the more interesting, use cases has been through these liquidations, through the processes that we've seen with banks overall in the last couple of weeks. There's a lot of opacity in banks, and we don't have that same problem in crypto, right? So when there's an on-chain liquidation, when problem that arises, everyone in the market can see it all happening at the same time, and we can build risk systems around that. So that's a fantastically beautiful way, very elegant way that everyone has the same information. It's not just a few guys in a room figuring out what exactly is going down with the bank.
Stephen or David, would you guys like to have a go at that question?
Yeah, I mean, I think I agree with Serena and Zahir. To me, ownership and control, self-custody, and transparency are definitely some of the biggest advantages of DeFi over CeFi, especially in light of all the recent events. I think it shows that DeFi protocols were successful and really were able to manage all of the volatility in the market and continue to turn on. In addition to kind of those advantages, a few others to mention. To me, I'm also very excited about kind of permissionless access. These DeFi protocols are global, they're open, they don't discriminate, they're accessible to anyone with an internet connection, regardless of their backgrounds. And so from a financial inclusion standpoint, I think, we're still very early on in that journey, but it really does give kind of a level playing field for people all over the world to be able to participate in a financial system. And then maybe just to reiterate kind of Zahira's point around transparency, again, I think in light of all the activity at SVB and kind of in the banking sector more broadly, I think it just takes a lot of time, frankly, to really understand the risk exposure for banks, where your capital sits, how intermediaries then transfer funds. I think the beauty of having all of these transactions kind of recorded in a public open source database is that you can really audit and see kind of the data in real time. And so the opportunity for real-time risk assessment and understanding information as a user in any system, I think is really powerful for DeFi overall. Steven, over to you.
Yeah, I think what I'll do is just try and encapsulate what's already been said. I don't think there's anything further to extend on, but in essence, there's 2 points of view. There's the advantage from the user's point of view, and that really just boils down to accessibility and self-sovereignty, which I think you can pretty much gather from the rest of the panelists and what they said. But then from DeFi's point of view, there's also a number of advantages, and that being, again, transparency, low barriers to entry, composability. So altogether, it gives you this sort of new ecosystem that has got a lot of benefits that can work in conjunction with traditional institutions, but also shows the sort of juxtaposition and the ability to compare and contrast between the sort of decentralized options and the centralized options. So hopefully I sort of rounded that off decently.
Thank you, everybody, for your thoughts. I heard a couple of you mention transparency and accountability. Let's dig into that a little bit with a question related to governance and some of the various governance models that you think can bring about more transparency and accountability. Obviously, we can look on the blockchain, we can see what's happening there. But sometimes on the operational side, how decisions are made. Does somebody want to kick it off? I know, is it DYDX or DYDX? I can never decide. But I know both you and Uniswap Labs have governance protocols that manage how you deal with decision making. So does one of you want to kick it off and tell us a little bit more about that?
Sure, I'm happy to kick it off. And yeah, it's DYDX. We get a lot of different types of capitalization, but it's meant to look like the derivative. So yeah, I mean, for those of you who aren't familiar with DYDX is one of the largest decentralized exchanges for perpetuals trading. Currently, it's built on the Ethereum blockchain using Starkware as a layer 2, and then Ethereum as a settlement network. The protocol is fully non-custodial. Users retain custody of their funds at all time, but they deposit their funds to a smart contract, and through that, they're able to trade via an order book, these types of products. The DYDX protocol is currently governed by the DYDX DAO and DYDX token holders. Effectively what that means is users earn tokens for using the protocol, and those tokens allow them then to make decisions that impact the ecosystem overall. Our model was forked from another protocol called Aave, who in turn forked kind of their governance system from Compound. I think a lot of the governance systems in kind of ETH land today kind of follow that model, which is a one token, one vote model, which effectively allows people to participate in governance and use their tokens to have their voices heard. I think we're still pretty early on in terms of figuring out what is kind of the right governance model for crypto. Again, I think part of my job, and maybe Serena and Steven definitely has experience with this, is how do you actually mobilize 100,000 pseudonymous token holders to come together and make decisions that grow a protocol or ecosystem. There's a lot of challenges with that. There's different subject matter experts. And so how do you think about constructing a system that is inclusive and represents a lot of different backgrounds and interests, but then how do you also make sure that decisions get made and that the protocol or ecosystem is able to be self-sustaining. So I think there's various experiments, different types of decision-making models, but generally speaking, you've seen kind of this movement towards DAOs and sub-DAOs and functional areas, functional groups in an ecosystem starting to manage different parts of a protocol. I think MakerDAO and kind of their core unit world was really a playbook for the rest of the industry that we at DYDX certainly look at and try to innovate on. But that's I think there's a lot of activities around kind of the DAO governance model, and ultimately some of the trade-offs around decision making, speed of execution, and inclusiveness is an area that all of us are still trying to really figure out in real time. So maybe I'll pause there and see if anyone has any reactions to that.
Thank you, David. Who would like to discuss governance next? I'm sure you all have strong opinions and a lot of experience with the matter.
I think I'll just throw in some my 2 cents here for a second. So there's 2 aspects to it as well that you've got to keep in mind. You can talk about it as a snapshot now, but you have to talk about it in terms of how a DeFi project or protocol actually develops through its arc of decentralization, and how balancing a couple of factors such as control, funding, and community allows you to merge this governance group, this governance process, and also decentralized workforce. So understanding what that arc looks like and how your project matures really takes into consideration the sort of culture of the community. And then generally, if you start including a set of predefined sets of decisions, it allows you to get this process in place that reduces contention. And then as you go through the reduction of contention, you can include different types of voting, iterations. It becomes really a bespoke function that is reflective of the actual underlying protocol itself. So a bit of an abstract answer to that, but it does become a little bit bespoke, where every step of the way has a tooling of functionality, such as contention reduction through preliminary voting, all the way through to what kind of vote you want to see executed on chain and how it's recorded appropriately. And then you've got plutocracy versus one person, one vote, where you can look at all kinds of different quadratic voting ideas. So there's a lot of elements that you look at, but you've got to overlay that on where you are as a protocol, where you are as a project, and then what this means to your community. Because if you lose the culture of the community, the governance process could actually work against you.
Thank you. Thank you, Stephen. Who'd like to go next? Go ahead, Zager.
I don't really have much to say about governance. I think governance overall can be done in a much better manner. Mostly the biggest problem and challenge with governance that it's not linear, that it is linear to how much voting right to how much shares you own. And that's not always done in the best way, because if a VC has the largest allocation towards a project, then you can essentially imagine that they have the sway to do whatever they want in that process. And we've seen this time and again with a few notable protocols. And that they've all caught flack for this, right? Or, essentially like giving out their vote and, delegating their vote out to universities or that kind of thing. And then it becomes this whole process of, then what was even the point of the governance to begin with? There's a very obvious controversy with one major protocol that hasn't turned on a fee switch, and that's mostly because of a regulatory perspective. So it really begs the question of what is the goal with governance. I wrote a piece about this for Deribit Insights. I encourage people to check it out if they're keen on that kind of thing. But I approach this also from the lens that I don't have to think about governance problems outside of just being an active participant and user of the protocol. So I know that I have a bit of a privilege in having this take.
Thank you. And Serena, do you want to round that out? I recall getting
maybe
Uniswap airdrop originally. I was excited about that.
First thing I would say is, and this might be interesting for kind of like the MBA audience, because companies and projects are structured very differently in Web3. Uniswap Labs is different from the Uniswap Foundation and the DAO that runs the protocol, and you need token holders that vote on the protocol and that governance structure. So I work for Labs, which is the like venture funded company that is related to, sits on top of, however you want to put it, the Uniswap Foundation. So I actually don't have like a ton of thoughts, but yes, Uniswap is a great example here, very much to your point of things that have gone really well. And but what I would say is like, stepping back, how cool is it when you were talking about CeFi and DeFi differences? Like, how cool is it to have potentially financial rails and a financial system run on people voting on like how it should be? And there's lots of issues with it, but I'm almost like, you know, back in 1776 and like writing the Constitution, and like, how hard is that? It's like, yeah, it's really hard to get democracy right. It's hard to do it right on the internet. And like, there are things being invented all along. It's like, here was talking about like, you know, so one person can control all the votes. It's like, okay, then people came up with quadratic voting, which is maybe also not perfect, but then there's the next step. You know, it's like, how do we, and like delegating votes is not perfect, but also how cool is it that like Stanford Blockchain Club is like voting on how Uniswap should be like constructed in its next iteration. So I guess I see it as like long-term optimistic, lots to work out, but yeah, I'm not directly related to it, which is just an interesting point about how Web3 is like structured in general too. Lots of
yeah, and I wanted to mention that, you know, the criticism comes as positive criticism. It's fantastic that we're able to look at this and actually see that DAOs are at least voting on something that's substantive, right?
Yeah.
So it'll take a lot of iterations, but we're asking the right questions, and that's what the whole goal is. And everyone involved is asking the right questions. So
yeah, I think maybe to react to that, like I think if you look at kind of the history of political or corporate governance, right, like it takes hundreds of years or, you know, wars or just companies going bankrupt for governance to really evolve over time. And even today, you know, governance in the US versus in Europe or in Asia is just very different. But in the grand scheme of things, there's not a million different models. I think what really excites me is that, you know, you have a petri dish of experiments for governance models that are internet native. And, you know, I think all of us will recognize that they're not perfect today, but you have real capital on the line and open access and people from all over the world, you know, A/B testing these governance models to see what works. I personally don't necessarily believe that there's just going to be one model that rules all for internet native kind of communities and DAOs. But, you know, I think today the metric that I think of is, okay, most DAOs and governance systems have high single digit, maybe participation rates. And if you look at, you know, some of the most liquid democracies, let's say a US presidential election, you get kind of 60, 70% turnout every 4 years, versus like corporate governance, you maybe have proxy companies and high concentration of voters. And, you know, yet the percent of equity holders who show up for a vote is pretty minimal. So I think if we can kind of have that longer term mindset and think through how can we get from single digit to, you know, 20-30% in the next 5 to 10 years, that's already a huge kind of improvement relative to where we are today.
Thank you, David. My follow-up question is related to the regulatory lack of clarity surrounding DAOs, DeFi, Web3, the entire crypto space. To give you an example, recently, Uki DAO, which is, as the name suggests, a decentralized autonomous organization, because they could not find who was in charge, they served them court papers over Twitter. And then recently, a federal judge in the United States here ruled that as long as there is one developer that has any keys to the castle, it is not technically decentralized. And obviously those are ongoing matters of litigation, but I'm sure you guys, each of you in this room, I know you have to deal with this regularly. So I'd like to get your thoughts on how you navigate that.
Well, I'll kick this one off because The way that you also set up the question itself has a lot to unpack. So unfortunately, I've got a lot to say about this, if you don't mind. And the way that you got to think about this is, this comes back to what I call the arc of decentralization. DeFi protocols need to understand where they are on this arc of decentralization, because there's three phases. There's launching the protocol, there's growth, and there's becoming sufficiently decentralized, which everybody knows the concept of decentralization is a little bit sticky. But during this arc, you've got to be very aware of who's controlling the protocol, where the funding is coming from, and really how the community is developing around this protocol. Because if you're aware of these factors, then you can understand how the protocol is positioned in relation to these sort of regulatory guardrails. And that in of itself is not really that easy, because these guardrails are constantly changing, and sometimes they're not very clear at all. And that is why when I think about protocols, when I think about projects, I keep on saying to them that it's equally important to understand where you are in the public policy and regulatory space. It's really difficult, but you've got to give it a go. You've got to get a good sense of where you are with respect to it. Now, when you think of these protocols, they can have a number of routes that they can take when they think of this sort of arc of decentralization. And the first one being launch. When you get that protocol going, it's vital to have a sort of correct corporate structure in place, because it's got to allow you to develop the protocol. It's got to allow you to grow the community. And at the same time, you're going to be very cognizant of how you're going to address liability, tax, and especially labor laws when it comes to the jurisdiction that you're in. And as everybody knows, as far as DeFi is concerned, you've got contributors from all the way around the world. So you've got to think about multiple jurisdictions and what labor law means from that point of view. So when you think of regulation, you think of decentralization, it's really broad. And the single most important thing to emphasize here about decentralization, it's got to be like baked into the fundamental characteristic and the fundamental ethos of the project, is why are you decentralizing? Because decentralized protocols are not efficient. They're robust, but they're not efficient. So the reason needs to be clear, and it cannot under any circumstance be to avoid regulation. Because as soon as you do that, you've really got yourself a core entity, a central sort of follow-on entity that can quite easily be identified and tasked to comply with the law in this manner. So that's just like launch. Then when you get into the phase of growth, this is really all about your community. This is all about saying, how do you grow this community in this growth phase? How do you do it by using network effects? But more importantly, and this is sort of touches on your previous question, how do you incentivize governance? How do you get a decentralized workforce going to emerge from this community? And those two groups are actually pivotal because they're fundamental to your protocol's decentralization. That is really where the concept of your decentralization comes from. And then when you get to that final stage, that point where you think that you are sufficiently decentralized, you should come out with a protocol that is permissionless, it's non-jurisdictional kind of infrastructure that serves as a platform for business to grow on. And then that business that develops on your infrastructure is always going to be kind of represented by a front end or a user interface. And that is the next sort of regulatory touch point to look after investor and consumer protection. It's sort of vital to also keep in mind that if that front end is being used by a company to make money by using your DeFi protocol, it's most likely going to be a regulatory touch point. So when you think about this overall, what a DeFi protocol is trying to do in that final phase is it wants to provide its users with self-sovereignty. So on the one side, you've got a person that is proficient enough to jump on a CLI and engage with protocol directly, but at the same time, you can have a major institution like Citibank creating a front end, a for-profit front end that also uses your DeFi protocol. And ultimately, what you get is you've got this capability which allows regulators to understand the arc, the growth, the maturity level, but also the spectrum of UIs so that they can sort of demarcate clearly where they can enforce regulation and where they don't have to. So I know there's a bit of a wall of words, but at the end of the day, it's kind of a mental model to keep in mind when you think about compliance and regulation at a sort of cross-section like now, but also through the development of the protocol.
Thank you, Stephen. Does anybody else want to chime in? We're at about the halfway point. So I've got as many questions as you want, so we can chat all day if we have the opportunity. But especially at Uniswap and at DYDX, I'm sure you guys think about this often. I don't know if this is your area of expertise, but I'd like to give all three of you an opportunity to speak, to touch on regulation.
Look, we definitely think about it often in that it impacts our, day-to-day operations and functions. I think most of the, at least larger protocols and companies in Web3 are aligned that like we are asking the US government for clearer guidance. We will be able to build better and more effectively with clearer guidance. So, I mean, you could say like, we want regulation, we just want clarity. So I don't think it's the world of, again, even a few years ago of like, don't regulate us, don't regulate. It's like, regulate, but make it clear, what's allowed, what's not allowed. And this is sort of a standard DeFi talking point, but I think it's really valid here that, the rules on what's a commodity and what's a security are set by things, from however many years ago that were supposed to apply to like farming crops and things like that. When it comes to commodities, like we may need new frameworks. We definitely need new frameworks to think about digital assets. We're really inspired by what's happening in the EU with regulation and how their approach has been specifically towards DeFi. So first the ask to like separate CeFi and DeFi, which at the time of FTX failure in the US wasn't clear that regulators in the US were separating between the two. So it's exciting to see that like knowledge is starting to build. And certainly sort of the approach it seems that the EU is taking is kind of set DeFi aside in a ring fence and say, we're going to observe and we're going to like learn about it over the next few years and actively like work alongside the industry to build regulation. And we feel that that's like a really inspiring route to go, and certainly working as actively as we can on the Hill and other places alongside many other projects to kind of try and like spread that education, if that makes sense.
Yeah, I think the only thing I'd add, we also obviously spend a lot of time thinking about the regulatory landscape, and I really like kind of the mental model that Stephen mentioned, which is just, I think the regulatory and compliance framework, there's different things to consider at different stages of a broader protocol and kind of the progressive decentralization of that. I think as an industry, decentralization is just like a really complicated term and gets used to describe everything and kind of nothing. And I think it's just important to remember that it is progressive and it is a journey. I think most topically right now, the risk is that, again, to some people, DeFi, crypto mean the same thing. People really don't differentiate between FTX or Uniswap or DYDX. And I think, the role of working with lawmakers, regulators to really help them understand that DeFi can be a solution and a tool for the objectives of kind of their policy. When good policy is constructed, I think we have to continue to put our best foot forward and continue to engage and educate policymakers globally on what we can do, and then ultimately also continue to build and really have use cases that have impact, right? And that can impact people all over the world. And so I think a lot more work to be done on that side, but we're excited to continue to work with regulators and educate them globally.
Zahir, do you have the input on this question as well?
Nothing material. I think the main thing just being that on the protocol side, for the protocols that I help support, especially the ones that look to decentralization as a very valuable point in their product, the number one thing for them is always, as Stephen mentioned, they're not doing decentralization for no reason. It is a pain. And what most protocols are understanding is that they want to get to the point where it's decentralized enough to not have key man risk, not have the risk of there being some sort of exploit and all of that kind of falling out on one dev, or that there's always that kind of risk that's embedded in a lot of projects. So they want to have it open to the community, but to the point where they can still function and make corporate governance decisions essentially without, constantly needing the community. There's one protocol in mind that is a competitor to Uniswap that has a lot of problems with this kind of thing. And it's a more purely decentralized platform, but it causes a lot of frictions when the founding team has to submit, $5,000 for a company dinner that they had, and then the DAO has to vote on it. It's that's not a fun process to go through.
Thank you for that. There's two topics I want to make sure we get to. One of them is about investment, venture capital grants, and then the second one is about growing the space and what's next. So let's pivot to investment. We've got a lot of young, up and coming entrepreneurs that want to get into this space, and they might be asking themselves, well, how do I get funding? Where does it come from? And what are the right and wrong things to do? Whether you're a grant program or you run a grant program or you're a VC firm, what do you find compelling, and what are you looking for when you're spending your very precious dollars and considering opening your wallet to a young startup in the Web3 scene?
Yeah, I'm happy to take that. I guess I'm probably the closest one to VC investor, but I do more liquid stuff generally speaking. So it's more tokens that exist and projects that don't need venture money. But generally, for the venture investments that we have made in the past, there's a typical framework that we kind of operate with, and it's mainly to understand what is the primary function of the protocol. And obviously, it's going to vary by different venture funds, right? So a venture fund that's interested in doing creator economy, investments, which have maybe a 5, 10, 15-year time horizon versus one that's doing derivatives, right? And trading and that kind of thing, which is maybe a 1-2 year time horizon for that product to hit some sort of product market fit. So there's a very big difference there, but generally speaking, it's, it's the same in any industry. You want to look for the best TAM, the, projects that have the widest scope, but also has a very narrow, kind of flywheel to get users, and also ensure that you're getting that end of day. It has to be a business. It can't just be offering things for free to people. And I think that's kind of been a problem with traditional VC in the past 5 years, where obviously venture firms are very flush with cash, so it makes it very lucrative for them to just start a company and not really have any idea where the company's going to go, but rather to focus on, okay, we still need this to become profitable at some point. We still need this to become at some point a real business. And that's, at the end of the day, what really matters. You don't have to think about those things at the outset, but that's a thought that you need to have once that customer acquisition flywheel needs to start happening at the Series A, B, C level.
Thank you. Who'd like to go next on that topic? Otherwise, we could always go ahead.
Don't think I can add too much from what Zia is saying, other than just taking it from the sort of entrepreneur's perspective. The one piece of advice I would give is make sure you research the investor landscape clearly so you understand what their mandates are and how you could potentially fit into it. Get to a point where you understand how you can contribute towards their portfolio, in terms of, are you providing a diversification, or are you concentrating on something they want to focus within their ambit? Because there's a lot of times where you find that entrepreneurs are just looking for cash, but they're not they're not taking the sort of strategic relationship of the investor into consideration as far as what their mandate is. And that's generally a miss. You end up spending 30 minutes to an hour saying, I get it, but how does that fit in my mandate? And they kind of look at you with a bit of a blank stare going, oh, I didn't think of that. So that's probably the one aspect I'd probably just add.
Thank you very much, Stephen. I know DYDX and Uniswap, I know you guys are a little bit different in that you have grant programs that have a different set of rules and conditions. Do either of you want to speak to that?
Yeah, happy to. Our community of token holders voted to launch the DYDX grants program. In the last 9 months or so, there's been close to $3 million distributed to over 100 teams building projects, tooling, various things for kind of the DYDX ecosystem. I think if you're, a founder, an entrepreneur, trying to, test your product market fit, build some capabilities, going kind of the grants route to focus on a specific research paper or specific problem and try to work with multiple protocols is really a great way to get non-dilutive funding and start to build up your reputation within a product and ecosystem. I think generally speaking, the beta DAO kind of service vertical is still pretty new, but if you think about it, there's 10 billion plus in community treasuries across these protocols, and all these protocols are looking to decentralize and get really smart MBAs and others involved in kind of their ecosystems, building cool things. And so I think the way that I think about kind of selling into a DAO is most akin to B2B sales. Like, it's pretty high touch. You have to know how to navigate kind of the complexities of governance or grants program, get funding from a treasury. But if you figure out how to do that, honestly, it's a great source of funding, and you can build a product around a community and get, frankly, real-time feedback, which is the best kind of advice I think I can give anyone in the audience, is like really focus on building a product that people want and like, and focus on reaching product market fit. There's clearly a lot of noise in the industry, and forking something and adding a new bells and whistle is just not going to cut it anymore. So I definitely encourage you to think about who your target audience is, how can you build a product that people love, and then figure out kind of the rest after that.
Thank you, David. And Serena?
So ditto what David said with the Uniswap Foundation, plug for grants as like a great initial source of funding.
Wonderful. I'm going to go ahead and pivot again on the topic, and it's about what's next. What do we need to do to achieve that next wave of adoption, first-time users, and even the people that understand and know DeFi intimately, but it's just too complex. They just don't really have the time or the energy, and there's a lot of risk involved with self-sovereignty, of course. So what do we have to do to get there?
I can start us off on this one because there's a lot probably, but I've just quickly, as you said, this was like technology, use cases, UX. It was like, so just quickly on each one of them. I think one uncomfortable truth about DeFi is, sometimes the way I put it is like, the technology is not ready for prime time. There is like the Euler hack that just happened, last week or 2 weeks ago. There are moments where you realize like, building on Ethereum, like things are expensive with the gas costs. So there are ways in which like the scalability and security in particular, and those will continue to improve with a lot of like the new, many new things from account abstraction to like sharding that will happen on Ethereum, which is very, very exciting. In the next like 18 months even are going to bring a lot of change in this, but like there is technology that we just need to continue improving. On UX, like I often think, we could talk forever about this, but so many of the even just words that we use in Web3 and in DeFi are like very confusing to people. The concept of like having a wallet and needing that to sign into something is not intuitive. And most projects, you go to their website, it'll say like sign in with your wallet, but there's no place like create a wallet there. So like, how could someone start from scratch when, I've always wondered like, can I send my brother or my cousin to Uniswap today and have them just like get started using it? Like, what would be the barriers? And there are like a million. So, I think just thinking through every single step of the way, how does someone who doesn't know anything about this get started using our products? And then use cases. So this one's really interesting. Use cases, David touched on a little earlier, but I think there's a lot of debate and controversy on it. Like, are there real world use cases? Are there not? To me, it's not really a debate in the sense it's like there are real world use cases. We need to bring DeFi to the places where like it's needed the most, and where we can show. Recently, for example, Uniswap, we came out with a paper, I can send around or whatever, but on FX and how much cheaper it is to do foreign exchange on Uniswap. And that's already happening today. It's not something we have to like invent or create. Like, it's happening. Swaps and currency swaps for stable coins are happening today on Uniswap and other places in DeFi as well. And for a certain subset of users, it is cheaper and it is certainly faster. So it's like, how do we take these places where real world use cases are already happening and really like double down on bringing that to those audiences on a more mass scale?
Thank you very much. Who'd like to chime in next? Gentlemen, if not, I've got another question for you. So
I think it's I think I agree with everything Serena said. I would just add, I think there's just a lot of work to do on kind of the education and awareness side and the user experience side. Like, again, people use email today, Gmail, without understanding how HTTP and SMTP work. And we need to get to a place where people are interacting with digital assets and blockchains without really understanding what's under the hood. Again, I don't think I could convince my parents, anyone older than me, on what I do or how to use any of the products that I use. And there's just a long way to go to make that really accessible. On the education and awareness side, I think it's pretty interesting, especially in light of FTX and a lot of the banking crisis. Like, you'd think this is like DeFi's prime time to shine, right? And in some ways, I'm sure user MAU numbers on Maker, on Uniswap, on DYDX, like we certainly saw like a bump after FTX went under of just like people interested in DeFi. But I would say there was definitely like mean reversion, and frankly, most of, call it like, the benefits just went to Binance and other kind of centralized exchanges. And so, to me, continuing to really educate people on the importance of self-custody and what this technology can uniquely enable. These are inherently like very complicated philosophical questions. Like, I think what it means to be a self-sovereign individual requires like a lot of kind of self-reflection for people. And so I think, just continuing to harp on education, both for individuals and for policymakers, is, really what's a big barrier for kind of mass adoption, and a big focus for all of us for the next few weeks and years.
thank you, David. Stephen and Zahir, I'd like to give you both an opportunity if you choose to answer that question.
Just mine is a bit of an abstract answer here, because in terms of adoption going forward, you've got to sort of step back from DeFi and just look at crypto at large. Fundamentally speaking, what are the primary reasons for people to want to go from the traditional space to the crypto space? It boils down to two things: it's novelty and speculation. I'm saying not completely, just primarily. And then within that, what you find is you've got a lot of sort of synergy value looking for critical value. In other words, when you get on chain and you start using something like Bitcoin or ETH, the fundamental question is, well, where's the intrinsic value coming from? And that debate is obviously open. And everyone has a position on that. And what we're seeing over time is the critical elements of fundamental value being injected into the space. It's going to take time, but that can be boosted to a certain extent if we can find the projects, the protocols that can intersect between TradFi and, or rather, traditional world and the crypto world, that shows where the utility comes from. A very good and a very simple demonstration of this is, imagine a payment rails for stablecoin. You go to Starbucks and you can pay for your coffee using USDC. There are certain functionalities in place, but in comparison to the current payments world, the costs are still too high. So by drumming those down, by improving the technology, you can create a fundamental utility which will bring more intrinsic value on chain and give DeFi the boost that it requires in order to start combining these two worlds together.
Thank you very much, Stephen, and thank you, everybody. We are at time, so I think we're going to need to wrap it up. But very insightful, obviously a lot of expertise and very good thoughts about the Web3 space. I share a lot of them as well. So with that said, are you going to go ahead and shoot? I'm sorry, I can't pronounce it properly. But did you want to wrap it up, or should I? Hey, I think you're muted. Amen.
I think Nitin has some technical difficulties, but thank you all for joining the panel. It was a delightful discussion, and really thank you from Wharton and Wharton Fintech Conference. Thank you so much.
Thank you very much. Have a nice weekend, everybody.
Thanks, everyone.
Thank you. Have a good one.
Test.
Is my audio coming through loud and clear? Check, 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 check.
Hello, panelists. Welcome. Hi, Ashish. How's it going?
Hey, how's it going? Thanks for having me.
Good, good. Of course. Welcome back to campus.
Yeah. One day I'll get back on campus and not have to do these virtual things anymore. That'd be fun.
Yeah, that'd be amazing. Hi, Christy.
Hey guys, how's it going?
Good, thanks. How are you?
Doing good.
Are you in SF or?
No, I'm in New York at the moment,
Oh,
actually.
in New York. Okay.
Oh yeah.
Nice. Awesome.
How's the conference going so far?
Oh, good. So we had an in-person component last night, sort of a VC panel on the reception, which was a lot of work. And today is virtual. This is the third blockchain panel. So we had one panel on regulation with Kevin Werbach. You might remember him. And
yeah, he's great.
One on DeFi the last hour, and this is the third blockchain panel. So very excited. Yeah, we have like 100+ people dialing in, so that's good. Which is also why we're not doing Q&A. But yeah, all good so far.
How's it going, Ashish? Nice to meet you.
Yeah, nice to meet you, Christy. How's everything?
Doing great. Good to be on panel with you.
Yeah. Are you normally based in San Francisco, or are you out in New York full time?
I'm actually moving to Singapore.
Oh wow.
Based out of moved out of the Bay Area and relocated. So yeah, going back.
Singapore is great.
Yeah, Singapore is great. It's becoming the crypto. Hey guys.
Hey, I spent some time in Singapore.
Oh, you did?
For INSEAD.
Oh, that's neat.
Yeah, and I have cousins who live there. I'm from Hong Kong.
Oh wow. Yeah. Well, Hong Kong is now gonna, win it over again.
We'll see. They say that.
All right, we still have Aaron coming and Chia. As you know, Chia is going to be sort of moderating and facilitating, so I'm just going to be here the first few minutes and give a short sort of bio for each of you and then pop out. And then I'll be back at the 45 minutes mark, and first just visually as a reminder of sort of the time, and then around 0.50 or 55 I would start interjecting. But I'm sure Chia is gonna appreciate the signal and start wrapping up. As I just mentioned earlier before you joined, Jacqueline, we're not doing Q&A just because there's a ton of people on the line. It would be a little too confusing. So it's up to the 5 of you. And yeah, it's going to be a good chat. And I just saw earlier today on the Masari newsletter, they were saying the headline was "Never a Boring Week in Crypto." So I think this is a very timely panel and chat. And I'm also glad we have representation from different schools and geographies, East Coast, West Coast, INSEAD. So I think that's exciting, and excited to hear all of
Is there a way to change my intro a little bit? Just because today's my last day at as head of business development for TradeBlock, I'm moving to our parent company, DCG, to join their VC growth team.
Oh, amazing. Congrats.
In case that is more relevant for what MBAs want.
Absolutely. Yeah, if you don't mind popping it in the chat to me real quick, and then I'll try and sort of adjust it.
Sounds good.
Congrats.
Thank you.
Yeah. All right. Only missing Aaron so far. Chia, how are you? Are you in Boston already, or?
Yeah, you hear me?
Oh, nice. Yeah, me too. So I'll probably see you in a few hours.
Okay, amazing. Good to finally see you, Stephen.
Yeah.
Chia, I just met up with Franklin and Dan Moorhead 2 or 3 weeks ago. Yeah.
Oh, amazing. Where did you guys meet?
We worked on a deal for buying your shares of Bitstamp.
Got it. Okay, cool. Yeah, no, that close recently, so that was good.
Well, it was a long process, but it was good to get done.
Yeah.
Welcome, Aaron. Now we're complete. Welcome back to campus virtually.
Thank you. Great to be here.
Perfect. Okay, let me just do one sort of or two preliminary remarks for the panelists, and then we can start getting into intros and kick it off. So as you know, 45, 50 minutes, no Q&A. I'm going to do a quick round of intros. I'll be back around the 45 minutes mark as a reminder of the time, and around the 50 minutes mark, I will start interjecting. We are recording, but if you feel like you're more comfortable, you can share more. When it's not, then you just go ahead and shoot us an email after, and we can sort of scrap the recording, because we really want this to be a very open and frank conversation. And yeah, we're super excited to have you all here. And let me get started with the introduction. All right. Without further ado, hello and welcome to our third blockchain panel for today. My name is Stefan Ries. I'm a dual degree candidate between Wharton and the Harvard Kennedy School of Government, and also serve as community chair of our blockchain club here. I'm thrilled to introduce you to a very exciting panel on riding the Web3 roller coaster, MBA alumni on their experience, in the interesting markets of the past 5-10 years, and strategies to navigate uncertainty. I think this is a very timely topic. Crypto and Web3 have been pretty volatile since the very beginning, but the volatility probably peaked in the past 12 months. Or in the newsletter that I got earlier today, it said, never a boring week in crypto. From very big, scandals and issues such as the Terra Luna implosion and FTX last year in November, to increasing regulatory and enforcement action here in the US. There's a lot of things going on. So there was a question of, how should we make sense of it? And how can we still potentially build a good, sustainable career path in the midst of this volatility and uncertainty? And that's the topic of our panel today. Everyone on the panel today has stood in your shoes. All our panelists are MBA alumni, which I think is exciting as well. So I'm sure their perspectives will be very valuable. So let me first welcome Christy Choi. She attended the Stanford Graduate School of Business and then sort of dropped out to do crypto full-time. Pre-GSB, Christy was an early employee at Binance, where she was the founding director of Binance Labs and led Binance's incubation and investment program. At the time, the world's largest crypto fund, managing more than $1 billion of assets. She is now founder and CEO at AO Labs, building Spacebar, a game as an interactive interface to build a composable Web3 environment. Second, I'm glad we're joined by Jiajing Yang. He's quite a legend in the community, very active, and a prolific writer as well. I would recommend you check out his Substack and his Twitter. He's a lawyer by training originally from the original Cambridge in the UK, and then spent a few years in Southeast Asia, including stints at Rocket Internet, Antler, and Saison Capital, where he focused on fintech investments. After dropping out of HBS, he joined the legendary crypto VC firm Pantera Capital as principal. Third, we have with us today Jacqueline Kwok. She graduated from the INSEAD MBA in the mid-2010s, and she's in a transition actually right now, so I'm sure she's going to talk about that. She's joining the Digital Currency Group's growth team these days, so that's super exciting, and congrats. And she used to be, or she is until today, head of business development at TradeBlock, a leading provider of institutional trading tools for crypto and blockchain assets. She started out as an auditor and then pivoted to private equity in East Asia, and then transitioned into crypto, where she was, among other companies, at Arcana, and she was also head of business development at Securitize, a name that I'm sure many of us are familiar with. Now on to Aaron and Ashish, our very own Wharton MBA graduates who both they actually overlapped, so you might have, met before. So they graduated in the early 2010s from the Wharton MBA program. Aaron is currently serving as VP of Custody at Coinbase. He also has experience as an entrepreneur and CEO of Coinbase Custody most recently. He's also built an edtech startup and grown it and had it acquired within 3 years. He's also a former special ops commander in Israel. Aaron has deep expertise in capital markets and digital assets, which he developed as a leading member of Broadridge's digital assets core team and as an early cryptocurrency investor since 2015. He graduated from Israel's top intelligence special ops unit. He led, large-scale teams and mission-critical projects there. And he holds the Wharton MBA and also did a JD and an interdisciplinary studies dual major at Hebrew University. Plus, he is a former professional concert pianist and composer and an angel investor. So wearing a lot of hats. And finally, Ashish, warm welcome to you as well. He's a former GM of RippleNet at Ripple. He joined Ripple all the way back in 2013, almost straight out of the MBA. So he's been in, the Web3 crypto space quite a bit. He led the development of the Ripple product suite. He's, an industry expert on blockchain, frequent contributor, speaker, and advisor on all crypto topics. He started out as an entrepreneur 15 years ago in Silicon Valley, founding a content management company that was later on sold to Thomson Reuters, became VP of that company's global technology unit in 2005. After leaving Thomson Reuters, he advised and led product design at a number of startups in Silicon Valley, and he was also featured in a Fortune Ledger 40 under 40 in 2018. All of that is to say is, 5 great, super well-qualified human beings who've seen a lot of different phases of the crypto market, a lot of, cycles. So I'm very excited for this conversation and handing it over to Chia to kick us off. Thank you.
Absolutely. Thanks, Stefan, for the kind introduction and to have everyone on this panel. Really excited to dive into everyone's backgrounds, what they've been doing, and learn a little bit more about what could be helpful and what we should be aware of, especially as folks are entering the new job market, which is obviously a very interesting and volatile one, given current situations. So maybe to start off with, I'll pick on a couple of the MBA graduates who we have on the panel, Christy, Ashish. Maybe starting with Christy, could you tell us a little bit more about your journey from MBA into crypto? I think the first question most folks always ask is the MBA experience helpful or a hindrance to the Web3 journey? It's certainly a question I get asked a lot these days. So would love to get your take on that.
Thanks, Chia. I guess I'm like the black sheep in the panel here, since I did not, finish my MBA, and I actually was in crypto. So I was leading investment at Binance, leading Launchpad and a bunch of different initiatives in Binance before my days in Stanford GSB. So I guess I sort of went the other way around, going to GSB, and unfortunately couldn't really finish it. But I guess my motivation for joining MBA was all about, making friends in life. And it was also about onboarding more people, more aspiring students into crypto as well. So it was all about, how I can also help out as someone who've already been in the industry, help people get onboarded and sort of soothe out sort of a negativity that was sort of floating around crypto back in the days. And so I would say the entire journey was very pleasant in general. And I really faced a bunch of different people who were, sort of also interested in getting in crypto versus people who had a lot of, prejudice or their bias towards or in crypto in general. But I guess it also rounded me with a lot of different thoughts around, how crypto blends into the general traditional finance arena. And I guess that gave me a lot of, inspirations on more innovations that could happen on the DeFi space, and how, at the end of the day, everything that we're throwing in crypto is around, experiments on incentive systems. So that also gave me, the inspiration to start my current company as well, which is building a game, but then it's more about, being that placeholder for people to throw different experiments on social, money, and whatnot. So yeah, it definitely helped me think about how I want to move forward with my journey in crypto. And I guess now my classmates are a lot of them have onboarded on crypto. So I guess it magnifies how, the network effect. And I do believe, in not maybe now, right after, when people graduate from MBA, they might not choose crypto be their next journey, but I'm 100% sure that, majority of us might be, somehow related to crypto in the next decade. So, just by, being part of MBA, you're sort of in the frontier of the industry. So yeah, that was my take.
Got it. Yeah, I think I like what you said about, it's a lot about incentives, and as MBAs are very curious generalists, there's a lot to be interested about in the crypto space. Ashish, would really love your view on how you felt the MBA has contributed to your journey so far.
Yeah, absolutely. Well, one, thanks for having me. It's always a pleasure to be part of the Wharton community. I think in undergrad, I had a front seat at the beginning of the internet, and I was in undergrad studying computer science from '96 to 2000. Completely dating myself here, but I knew that I wanted to be part of the internet, and so I moved out to Silicon Valley, and that was a great way to start my career in tech. But then I went to school from 2008 to 2010 at Wharton for my MBA, and I again had a front seat in the financial crisis. Possibly the worst time to be out of a job, but a great learning experience at Wharton, where I learned why the financial system crumbled. And it's really, if two of the largest banks catch a cold, the entire economy can fold. And soon after my MBA, I started learning about Bitcoin, and went to Bitcoin Amsterdam, the only conference in 2012 around crypto, and looked to join a company, and I found the founder of Ripple there, and who's the GSB, Stanford GSB alum. I think Christy, you guys the cohorts, but I think being in MBA school, you learn a lot about fundamental backbones of financial technology and financial systems. So, for example, it's hard to imagine a good experience in crypto without thinking about liquidity. So the ability to trade different tokens or Bitcoin or NFT, starting in how to build liquidity, those are all classes I really think you only get at an experience like Wharton. So I think like those fundamentals, I was really lucky to be part of that. I didn't know that I was going to apply it in crypto for the next 10 years, but that was really like grounding and fundamental in terms of understanding how to build, crypto products and how to build liquidity. And then the network, of course, like we all talk about the Wharton network, but I hired a lot of folks from Wharton to join me at Ripple as we were scaling Ripple over the last 10 years. And now as an investor, I've invested in a lot of folks out of the Wharton program as well, both my colleagues, or my classmates, but then also, Wharton alums from years after they're getting into crypto. So hugely beneficial to my career and my journey in crypto.
Got you. Thanks, Ashish. I think the old joke is always that crypto sometimes replicates the mistake of TradFi all over again, and it's great to have an MBA entering and dealing with some of those issues. Speaking of volatility, I think that's a great segue, I think, to our next question, which is trying to understand a little bit about how to think of all the volatility and news that's happening within the crypto space, and also just generally in tech and the job market these days. But I think Web3 is certainly not for everyone. It's certainly something that requires a test of your appetite for risk. And so I'd love to hand it over to Jacqueline and Aaron, maybe Aaron first, to see how you think a little bit about entering the space, given all the news and noise and FUD that's going on at the moment, and how you react to that.
Great to be here. Hope you guys can hear me well. So I'd say, I've been in crypto as a day job for about a year, but maybe close to 10 in terms of angel investing and just getting deep into the blockchain stack. And I think at the highest of levels, as I think about, MBA journeys and post-MBA career trajectories, I think people might want to step back and reflect on, do they really believe in the sentiment and the prospects of this industry? So this grew from nothing to about 100 million users, and in terms of market cap, we're a little bit over $1 trillion. But if you compare that to traditional asset classes such as cash equities, bonds, etc., it's a fraction. So I think one question to soul search around is, do you believe this is going to get to like $1 billion billion users globally? Do you believe that traditional finance is really going to step in, etc.? And there's ways to take that big question and, you know, decouple it into more manageable sound bites that MBA folks, particularly from Wharton, are uniquely positioned to do. So I think that's I think is a paramount discussion, because honestly, working in this industry is a little bit like being on a raft. There's strong currents every single day, and it could be, you know, draining. You have regulatory uncertainty in certain jurisdictions. You have a lot of competition, emerging technologies. Some bets are playing big time, some are not. Obviously, volatility of the asset class. Somebody mentioned liquidity. I think that has something to do with that as well. So I think, you know, if you step back and you feel like that's something that you would like to venture in, I think it's a pristine opportunity. First, if you look at research for MBAs, I think that where MBAs go right after business school is actually a lagging indicator and not a leading indicator. And so in other words, there is less people that are likely to go into Web3 right now because it's not as hot as it used to be in the last of summers that we had in crypto. And I think that is for a reason. It sometimes feels like you're swimming against the current, but to me, it's been an incredible journey. I think you learn about multiple industries all at the same time because you're deep into tech, but you're also deep into finance. And sometimes I feel like you can even earn a law degree while trying to navigate all the intricacies of what crypto is. So, you know, those are just some general thoughts.
My thoughts are very similar to what Aaron has discussed, and not to repeat what he said, but I think with where the industry has evolved to, you're starting to see a bifurcation of markets, which is the crypto asset, the trading, the liquidity bit of it, and the demand for the technology itself. And the beauty of Web3 and digital assets is that it's something that combines the two, and you can't do one without the other. So it is very interesting, especially seeing how different countries and jurisdiction adapt this technology / asset class. And it's hard to say one way or another, because I think we're all in the US here. The US kind of views it maybe a security, maybe a commodity, maybe we don't actually know. Whereas the technology, there is still a lot of you see large financial institutions adopting it. You see supply chain companies adopting the technology to manage their supply chain, which is a very viable commercial kind of outcome of what this technology aims to bring. And you actually see it happening, but supply chain, I wouldn't say, is the sexiest industry. And so people don't talk about it as much as far as the kind of the market side of the coin.
Got it. No, thank you, Jacqueline, and thank you, Aaron. I think that's actually a great segue to our next question, because we've got a really interesting, diverse panel here. You know, your folks who are on the gaming consumer side, on the infra side, remittance, more on the TradFi kind of intersection, as well as pure play investing. And so I think it's really interesting because I feel we always get a bunch of questions from students who are always trying to discover which are the more interesting spaces to go into. I think that was actually my first question when I was trying to figure out my next role, which is, should I be in NFTs? Should I be on the trading side, or should I just join a centralized exchange, because that has the best overview of everything? And so we really love to get people's opinions, especially today for graduating students, where they think it's most interesting to be involved now.
I would say, echoing what everybody else has said, that given how volatile this industry is, you are a raft in the front lines. So you have to really care about the problem that you're looking to solve and use that as an anchor to kind of grow your career.
I guess.
I'll go next. Go ahead, Christy.
Go ahead, Aaron. Go first.
So two thoughts. First, specifically to answer the question, I feel that wallet technology is just super interesting right now. So you see a lot of startups mushrooming around certain implementations of MPC technology, multi-party computation, and it goes pretty deep into cryptography. So don't feel like you need a PhD in cryptography from Princeton to be able to navigate that. There is tremendously interesting business and product questions that I feel I face every day. And so I feel that's a very interesting market to consider. I'll just mention something that I heard as I was exiting fintech and going into crypto. The ratio of the pace and evolution and intensity is about 10-1. And so 1 year in crypto, and I feel also in terms of personal learnings, is probably around a decade in fintech. So just putting it out there as people consider their career paths, etc. I feel like the learnings you get are just absolutely profound.
Thanks, Aaron. I guess as a person who've been on a centralized exchange, have been, doing investments and now doing being in gaming, it's definitely going to be around it's a very plain answer, but it's definitely going to be around what your passion is and what your background is, and then what you feel most passionate about, right? Because obviously, crypto is still going to be volatile in the next few years, and you won't be able to hold on to it if you're not truly into the specific sector that you are about to get in, even though you're generally in crypto. We've seen a lot of people jumping around different companies because they just couldn't figure out the market fit with the team that they joined. But at the same time, I guess my rationale for jumping into gaming, though I see more of gaming as an interface to basically link all the different products in crypto all together, and sort of as more of an on-ramp for the next billion people, I thought it would. I'm definitely seeing, I guess, more of the gaming people nowadays up and coming together, I guess, with all the innovations that we're seeing in the wallet side, as Aaron said. So if you're interested in, I guess, something that's going to be trendy in the next year or two, I would say gaming is something that I guess a lot of talents and capital is flowing in, but you should definitely, I guess, jump into stuff that you are passionate about and you think you will be able to hold on to it for at least, 5 years, 3 to 5 years. Yeah.
Yeah, I would just say that in my thesis around crypto is that there are 4 main pillars of crypto. So the first one being custody, or as Aaron said, wallet. The second one being, identity. I think that is going to be huge going forward. You can't recreate the financial system in a decentralized way without some identity to adhere to the regulations and so forth. The third one that I already mentioned was liquidity. You need to have movement of tokens between other currencies, and that's what centralized exchanges do today, and decentralized ones as well. And then the last one being tokenization. So tokenization in Christie's context could be NFTs for games, could be fiat currencies in the form of stable coins, with this idea of tokenization. So those are the 4 pillars. All right, what do you want to join? I would say number one, think about the first 10 years of crypto was very general along all those 4 pillars. I think in the future it's going to be very use case specific. So you might have wallets that are for gaming, but you might have other wallets that are for financial technology, others for brands and shopping. But think about specialization in those 4 pillars. And then the last piece I would say is, hey, we all got started with crypto because of the premise of decentralization. And maybe the big winners in the first wave were the centralized entities. But for every centralized entity, so you can take an exchange, there is a decentralized analog. So you take Binance and you have Uniswap on the other side, on the decentralized side. I think that there's going to be a move back to decentralized technology, because if there isn't, then what are we all here for, right? And so I think that is the last sort of area to look at. So I would say specialization is going to be this new wave, and then the last one would be, hey, move back to decentralized. And that might seem scary for a lot of folks getting into crypto, because it's about protocols and it's about smart contracts, but that's where the value is going to get created, and I think that's where the disruption is going to happen in this next wave. Thanks.
Good, thanks, Ashish. Yeah, we ourselves have been investing quite heavily in decentralized companies over the past few months since the bear market. I think very much agree with that thesis as that sector despite its challenges today, will continue to grow in a significant way because, again, that's the, I think, core reason why we're here at the end of the day. And so maybe a question for the rest of the panelists first, besides Ashish, and then maybe we'll come back to Ashish. But I think the vast majority of folks in MBA programs are non-technical, and crypto famously is one of the most technical industries out there, in my opinion. And so we'd love to understand, how you think about the types of roles that should be the focus for new MBAs coming to the job market, where they should be targeting, and any types of experiences and knowledge on a very tactical level that you'd like to see on the CVs and interviews when you see MBA graduates trying to apply to your companies or other companies within the crypto space. Aaron, would you have a view here?
Yes, sure. I actually have a live example of somebody who joined my team just a few months ago, straight out of MBA. So I can speak at a higher level, but then I can give us a few specifics. I'd say, similar to other industries, and for those who spent perhaps a summer in management consulting, there is a core skill set of how to think about analytical problems that comes in handy immediately, and that is irrespective in the industry, and that includes crypto. And so I think an immediate landing could be into corp dev, biz ops type of roles where the critical thinking comes in handy, even though the domain expertise might be a little bit behind. I think the most interesting is probably getting into a product role, which is just a Bible of knowledge and allows to get very deep into a specific element, demonstrate capability, and then grow from there. I think it's almost like the closest to a CEO role as you think about the dimensions and, product strategy is such, such a big beast. To speak about two specific thoughts, I have somebody who recently joined my team, and as we were interviewing, we're probing on analytical capabilities, but that person had zero experience with crypto and not a lot with technology, actually. But the reason that we made that hire was he was able to demonstrate intellectual curiosity. And the person was able to play with protocols, go into Aave, supply liquidity, and really step back and provide some clear thoughts in terms of what is working in the industry and could be better. And I think the good silver lining here is, as part of MBA, you spend a lot of time thinking about markets, addressable markets, segmentation, pricing, stuff like that. That's something that actually many of the technologists in crypto don't have strong command of. And that could be very synergetic. So for a recent grad, if you can demonstrate you're serious about the space, take the time, go into protocols, read a little bit, play with it, and then you can demonstrate, you can take a question and package it in a way that's very compelling, understand what are the next segments, what are the pain points, what are the competition elements, and what do you think that specific company can win, you have an edge.
Got it. Thanks a lot, Aaron. Christy, Jacqueline, any pointers from you?
Yes, two things to supplement what Aaron said. A different way to phrase what he just said is the ability to tell the story of what this technology is aiming to solve, because what folks are actually looking to do is being able to drive broader adoption for this technology, for this asset class. So if you can demonstrate that you have the ability to distill fairly complex technology into something that a regular person can understand, then I think that creates your kind of moat for you as a future employee at a potentially Web3 firm, or if you're starting a business. The second thing is to actually read the Bitcoin white paper. I learned a lot from going right to the source. It's not as intimidating as one might think a white paper to be. And I highly, highly recommend that for those that are interested in this industry.
Yeah, I mean, Jacqueline and Aaron just nailed it. But I guess to add, I guess, I think, the general MBA admission process, highly stresses on analytical skills and how you synthesize it. And I think, those skills are still pretty much in like very needs in every single company in crypto. A lot of people come in with, different ideas, and it's all about how you realize that into real product and how you deliver that to people and customers. And I think, even though, the MBAs may not be the most technical people in the room, but then all these very technical people always need these non-technical people who are, good at storytelling, who are good at building the network. Because, I think crypto is all about, building alliances of people who believe in the same thesis. And so if you're able to, I guess, persuade those people into your product, I think that's another great plus that you can probably, 100x value add to the entire team. So not just, I guess, just product side, but I do see a lot of, I guess, it all comes down to what your prior experience at MBA was. But I've seen a lot of great investors as well who've, I guess, has product experiences become, great investors who back, great teams, and just like, I guess, Chia here. So yeah, I think it's there's lots of new routes as much as you, I guess, seek. And yeah, I'm sure there's a lot of technical teams out there also looking for the skill set that you guys only want. So yeah.
Got it. Thanks a lot, Christy. And last but not least, Ashish, I think you've mentioned that you've hired quite a few MBAs for Ripple. So would really love to understand your take on it, especially on the tactical things, if there are things that you tend to look out for in interviews as just a general fit.
Yeah, I mean, I love the answer that my fellow panelists already answered it, but I would say because I think the crypto is going to go into more use case specific verticals, whether it be gaming or finance or whatever. There's this role called product marketing, and I think MBAs are perfect for it. And the reason I believe that's going to be super, super important going forward is, for us, I think Ripple, we were sort of humming along until we really nailed our go-to-market. And product marketing really is in charge of that go-to-market. And so I would just add that in the future here, go-to-market is going to be very, very important. You can't just build for everyone. You have to build for, a specific, initial target. You can expand from there. But I think MBAs are really good for product marketing. So I'll look at that, especially if you don't have a technical background. I think it's a combination of a lot of really good skill sets. I would just say the one thing I do look for, I think is really important with the crypto is someone that's going to have conviction to stick in this industry for the long term. And I don't think the volatility is gone. I mean, I think we'll still see a lot of that over the next decade. And what I've seen is interviewing and making sure folks are really joining for the right reasons. And I think if you're joining right now, you're probably joining for the right reasons. But that has a big impact on tenure. And you get folks that are really building for the long term and not sort of just it's trendy right now, so let's get into it, but you'll be gone in the next sign of adversity. So I think that is super important to think about.
Got it. No, thanks a lot, everyone. I think maybe a couple of things I'll throw onto that is I really resonate with Christy's point and Jacqueline's point on really understanding, and trying to dive deep into some of what you can see in the ecosystem. I think I got my job really because I was looking through a lot of the protocol docs and just being able to describe it in a simpler way. And compared to a lot of previous VC roles, the information is 100x more public compared to, for example, trying to understand banking backend to make a fintech investment. And so that, I think, represents a really amazing and easy to access opportunity to just look at what's out there because people are writing documentation for it and simplify that for the average non-technical person or average user that are interested to learn more. And I think that's also why you see a fair bit, but not a lot of great content on crypto there, which I think MBA students can fill a great role there. So Moving on to maybe our next question, which is on the negative side of things. We've talked a bit about things that folks should be doing if they're trying to break into crypto. Would love to understand if you've seen in your interviews, in your general conversations with MBA students, if there have been any types of mistakes in folks trying to break into Web3, any kind of, for example, traditional mental models that they're bringing over to Web3, which might not be helpful. I think resilience and kind of understanding why you're interested in space is certainly one of that. Would love to understand if there are others that you may have observed in the market. Maybe I'll call on Aaron again.
So let's step back. So biggest mistakes. I think I mentioned before the raft element. So not for the faint of heart. If a person is considering this path but can get significantly discouraged because Bitcoin all of a sudden dropped from 28 to 15, not a good place. There is strong good days, there is other bad days. I think if you go back to historicals over a decade and you split 365 days a year, there's about 10-15 days of profound growth, and then maybe 300 and some that you finish in the red. So from a psychological element of a first post MBA job, that's something that people might want to consider. If I could add a second, I'd say really think of the value of a specific project or a company you contemplate joining into. So technology would be cool, no doubt. That's great. I spoke with an investor recently and I asked, when do you think we would get into mass adoption, etc.? And the honest answer came, this is traditional finance executive, we need to demonstrate use case value. Like if you take a look at HTTPS and the value that they generated to mankind, that's probably what, 50 trillion, 60 trillion? It's a protocol. I think us collectively as industry leaders need to think of, okay, we're building new things, that's great. What is the demonstrable value that it would bring to people? How would that change people's lives? The technology is super cool, I get that. How would it make a difference? So that's something that I would consider.
Got it. Okay. No, I think that's a great point. I think part of the jobs of, for a lot of people, especially if you're business leaders here or wanting to be a business leader, is really being able to articulate clearly or be able to talk to technical teams who are trying to find use cases and be able to force a clear articulation of the value that you're bringing, even if that's something that you're necessarily co-developing with technical teams. I'm trying to understand at the moment. So I think that makes a ton of sense. Would love to understand if Ashish, from your interviews that you've had, have you seen any types of main reasons why you found to decline candidates besides kind of conviction in the space?
Yeah, I mean, I would say like a couple of things that maybe like turnoffs are if you look at their resume and they bounced around year 1 year here, 1 year here, 1 year here. That's usually a turnoff for me because listen, if you can't stick it out for a couple of years, and I get there's always reasons why you have to bail on a company, but man, like the amount of ups and downs you're gonna face in crypto is nothing compared to probably what you faced in another Web2 startup or another company. And so you need to like be okay with the risk. I thrive on it, but like others have to as well. Because there's nothing worse than actually hiring someone and ramping them up in crypto and then having them bounce right as they were being productive. That is so painful to a startup, especially in the crypto space. So I would say that's number one. The second thing is like, can they or do they really understand why decentralization matters? Like really that's going to have a pretty big impact on how they think about products, how they think about go-to-market, how they think about value creation in crypto. So the best article to read, if you're thinking about joining the space, is, in my opinion, is Chris Dixon's article. Just Google why decentralization matters, and I think it's a really good, gut check yourself. Does this really, really like resonate with me? And it sort of should ground a lot of your decisions as you join a new crypto company in terms of strategy and direction.
I wanted to add upon like Aaron's point previously, that I see a lot of like MBAs obviously try to get into crypto when it's hot, when everyone just talks about it, right? And then that's probably when, it's peak of the market. And then, all of a sudden people just don't consider crypto to be their next career plan when there's bear market, when actually that's the best time to join the industry, because then you'll probably experience the next run in a couple of years. And that's when you should be actually shipping and building the product, right? So I guess that's one big mistake I think a lot of people make when they're breaking into Web3. Now is probably the best time to, get into the market if you're interested. And then I guess the other thing, a lot of the MBAs or I guess peers that I see breaking into Web3 is that because most people are non-technical, and because I guess a lot of the new innovations that are happening in crypto could be very technical, you only understand what's going on in the surface level. And that makes you just echo whatever is going on in the market. And I guess just following whatever the hype is at that very moment, and not really thinking about, I guess, another level deeper, and really think about what is the core fundamental needs, or what is the core technology that enables those needs. At the same time, think about like what's missing in order to really push forward the product to another level. Because I mean, there could be a lot of hype going on about a specific protocol, about a specific product in that particular day, but then none of the products out there is perfect at the moment. So it's always about, thinking deeper, unwrapping the hype, and then going a little deeper about what exactly is this about. And that includes, thinking about, like, can we make this product a little bit more decentralized? Can we really think about, the actual needs for this product and whatnot? And so I guess, going a little deeper than what people talk about on crypto Twitter will just make you, a bit ahead of a lot of people, because we're still in a very infant industry, and there's just a ton by going a little deeper than what we tweet about.
Got it. No, thank you so much, Chrissy. I think the joke in crypto, when I decided to join Pantera, at least, which was not that while ago, was that unlike any other industry, you could be an expert in something really within a matter of weeks or months globally, simply because no one has actually bothered to spend time in it, because everything is just moving so fast. And so it's a really interesting opportunity to really ramp up super quickly and make a name for yourself in specific areas, just because of how nascent the space is. So I definitely resonate a lot with that. So maybe our last question, as we're running onto time, which I think is a really interesting question to learn from the panelists here, is really what is the biggest surprise or unintuitive learning you've had when working in Web3, especially compared to maybe some of the previous traditional experiences that we've all had? I think maybe to give an example to go first, as a previous VC, I think we think a lot about blitz scaling. We think a lot about being able to acquire users very quickly, and then figuring out the business model. That's certainly a playbook that traditional VCs, including myself, have used from time to time. And one of the issues with crypto, I think that really needs to be considered, is the idea of moats in products in Web3, given how composable and accessible and permissionless everything is. And so that's certainly been one of the topics which seems extremely unintuitive, where you can have plenty of products that gain an abnormal market share within crypto, and yet really struggle to think about the business model, which again, I think is an opportunity for, generalist MBAs to be able to come in and figure something out here. But would be very interested to see, as you've made that change, what are some of the unintuitive things that you've learned since? Jacqueline, I would love to get your thoughts on that.
I wouldn't call it unintuitive, but I think I underestimated how quickly things change within this industry. It truly is lightning speed. We're here talking about everybody needs a custody platform, and then all of a sudden all these different types of custody solutions come out, and it's just a never ending learning curve, which is exciting to me because it's interesting, right? And so I wouldn't call it counterintuitive. It's very fast moving, much faster than I thought. And I thought it was going to be very fast.
Got it. No, thank you. I guess, Aaron, do you have any thoughts on that? Obviously, Coinbase custody is one of the best. I think we actually use it. So,
thank you very much. JK, completely agree. I'd say maybe one observation about Web3 and then one specific MBA Web3 observation and a call for action. So for the first, one thing I'll call out is the diversity of backgrounds that I see of people coming into this industry. So we have former musicians on staff, we have cryptographers and math, we have marketing, and then we have like just really random backgrounds of people that are driven by sheer passion and feel that they can make a difference. Those of us who have a chance to tour the world, and especially if you go to places such as South America, Africa, etc., you can see how traditional finance can come against people, unfortunately, where people for transfers of funds, etc., sometimes pay 20, 30, 35% of commissions and interest. And unfortunately, those are the ones that need that the most. And so it is the sense of mission that brought me to this industry. And I think that is something that can really echo against multiple different backgrounds. The specific call to action in the MBA one. So I recently had a chance to teach some MBAs around crypto, and top school and great experiences. Just as a proxy to understand level of depth, I asked 5 questions, and the first one was like, do you know who Satoshi Nakamoto is? And then the last one was, did you have a chance to supply liquidity into a liquidity pool? And it was by show of hands, so this is not scientific. But for the first question, we got almost like 98%. By the time I asked, do you own an NFT? It dropped to sub 10%. For the liquidity pool, I think it was one hand, and I'm not even sure. And I guess the call to action, and this maybe dovetails into some of the other insights that we as a panel had a chance to discuss. If people are serious about this, take a week, take 2 weeks, open an account. I'm not going to say where, but don't just go into centralized exchanges. Open an account that lets you play with Web3, play with protocols, supply liquidity, try to pertain in governance, see how it works, make some mistakes. I think that is perhaps the best indication of how you would feel if you were to work in this full time.
I'll say what Aaron won't say. Open a MetaMask account. Is maybe what he would say.
The other thing I would just add is I didn't realize, I guess working in Silicon Valley, long before crypto, we don't think of compliance, regulatory, lawyers as being front and center. As an industry, we need to spend more time educating regulators. We need to spend more time, talking about real world use cases that we're developing as an industry. Because right now, and I guess I didn't know this over the last decade, but right now, the large narrative that is out there, and I'm not just talking about the United States, I'm hearing this across the globe, is that crypto is for things like FTX. And there's what's getting washed out are all these amazing use cases. Afghanis getting paid in stable coins as the only way that they can receive funds from international companies and vendors. Like, that's transformative, but that is not what the regulators are hearing right now. And that is counterintuitive to anyone that's been in tech for the last decade. So I would say that is one thing to think about in terms of spending more time on, because in crypto, there's no escaping it right now.
Got it. Thank you so much for everyone and their thoughts here. I would definitely echo, I think, last few sentiments, especially on the fact that I think one great sign that you're a good fit for crypto is if you've messed around, made a ton of money, lost even more money, and are still interested in space. I think that's always a good sign, and certainly how I've gotten into the space myself. So thank you so much, everyone, for all the thoughts. I think they're super useful for anyone who's looking to enter the space, looking to understand how to approach the space and really navigate all of the uncertainties that's happening so far. So really appreciate it. Thank you so much for all of this. And I'll hand it over to our dear host, Stephen.
Yeah, thanks, Chia. No, this was great. Thanks so much for taking the time, everybody. Let's keep in touch. I hope to see you soon in Philly on campus, or in Boston or in New York City. And yeah, stay connected to Wharton Fintech. We also have a great podcast. Check it out if you haven't. Or maybe we will also request you guys to join us for the podcast as speakers soon. So yeah, thanks so much. See you soon. Bye.
Thank you.
Hi, Martin.
Hi, Shubi. How are you?
I'm good. How are you?
Nice to meet you.
Hello, I'm fine. Thanks.
Oh, was that me? Was that you or me?
I don't think it was me.
Oh, no.
Maybe you said Shubi and it thought Siri, if you have an iPhone.
Okay. Well, hopefully, yeah, that sounds the case. How's the conference going so far?
Going good, almost. So this is the last blockchain panel. Before that, we have had a panel on regulation in the morning, then a panel on DeFi, and then a panel of MBAs who were basically telling their journey of how they are riding the crypto wave. And it was basically for the new MBAs like me to decide if Web3 is the sector that we should be indexing on or not. So this is the last panel. We have one more fireside chat with Stani and Ben from Parafy Capital, and that would be it. But going great otherwise.
Awesome. So how many people will be dialed in?
Around 150. They'll
Nice.
be listening. So they won't be on Zoom, but they would be. This is streaming on other platforms.
Amazing. I'm just going to go on mute in the background if that's okay.
Yeah, that's fine. Hi, Asad.
Hello. Hey, Martin.
Hey, it's good to see you again.
Great to see you as well.
Yeah. So
Happy Friday to you both.
Say again?
I was just saying happy Friday.
Yeah, I just got back from Lisbon. I'm based in London at the moment, and I was at a emissions trading association conference for carbon.
Very nice. Yeah.
Yeah.
It's a hot topic. It's a hot topic, man, right now.
It's a lot going on for sure. Where are you based?
Yeah. I'm based in Virginia, just outside Washington, D.C.
Nice.
Yeah. Are you from London originally, or?
No, I grew up in New York.
Cool.
I've lived here for the last 7 years. Yeah.
Hey, Luke.
Hi, Luke.
Hey, how's it going?
All good.
Happy Friday.
Back at you.
Mr. Meow. Hello, sir.
Going on?
Hi,
Hello,
Kevin.
Kevin.
We'll just wait for Kirti to join and then we can kick off the session.
Shubi, you want me to stop at 45 past the hour, right?
We can go on till 50 past hour.
Perfect.
If you want, I can send you a reminder at 45.
Sure, I'll try to keep everybody in line. These are nice individuals. I think they'll make it easy on me.
Okay, Kirti is here with us as well.
Hello.
Hi.
Hello.
Now that we have the quorum, I would like to start with the introductions and then I'll hand it over to you, Asad, to moderate the panel. Hi, everyone. I'm Shubhi Agarwal, one of the co-chairs for Wharton Fintech Conference. Welcome to the third edition of the conference. We are really excited to have you all on this panel. Today, we have an amazing panel of operators who are going to talk about the crypto revolution and its impact on transforming the traditional industries and institutions. Joining us today is Kevin Miao, who is the partner and head of credit at Block Tower. Prior to Block Tower, he was director of operations at CapChase and ran a structured trading desk at Citigroup. Next is Martin Kessler, who is the head of business development and global markets at Flow Carbon and has recently joined the company. Before joining Flow Carbon, Martin has spent 24 years in investment banking and brings in a ton of experience with him. Next, we have Kirti Modgal, who is the head of product at Onyx JP Morgan. Onyx Digital Assets is the firm's premier blockchain platform for tokenized assets and digital asset exchange, which she was instrumental in helping launch. She has also been a part of JP Morgan's blockchain program since 2018. Luke Schimmel, who works on the institutional business development team at Ava Labs, the primary development company for the Avalanche public blockchain. Before Ava Labs, he worked at digital asset brokerage FalconX and then at Maple, a leading DeFi protocol tackling on-chain capital markets. And last but not the least, we have Asad Khan, who is joining us from Centrifuge and is responsible for protocol partnerships at Centrifuge, where he focuses on the integration of real-world assets and DeFi capital markets. Asad will be moderating the panel today. So without further ado, I would hand it over to Asad.
Thank you so much, Shubi. Happy Friday to the audience. I'm really, really excited to be closing out a very good Friday at the Wharton Fintech Conference. I'm really excited to have this panel on. Everybody here is near and dear to my heart. If they're not partners of Centrifuge today, they will be tomorrow. And I'm really excited to have them here and talk about what they're doing. These guys are working on some really, really cool stuff. The name of the panel is Applications that are Revolutionizing Industries. And of course, there's nothing that crypto is revolutionizing more than finance, changing the way we think about markets, changing the way we trade, changing the way we exchange markets and money and move things around. And this group is really kind of at the leading edge of that. We've got the introductions out of the way, so no boring resume conversations. We're going to keep the conversation kind of fun. But I want to turn it over to you guys. Just go down the list here. I'll call you out by name. And I want to know, like, what does crypto mean to you? It's big space. Like, what are you and your team working on? What excites you? What keeps you up at night? I want, like, what does this mean to you? Why are you here today? What's keeping you in the industry? Let's start with Kirti.
Ooh, first up. Okay. Well, I'm glad you picked the bank person to go first. I mean, it's funny because I was just like rereading that article that Matt Levine dropped at the end of last year, the crypto story. I like often find myself going back to it along with some of the other white papers
Good one.
like picked up over the years. And in it, he describes crypto not just as like cryptocurrencies that are the incentive mechanisms that various protocols release to, incentivize miners and validators, but also like everything that's come of it in aggregate. So the underlying protocols themselves, all the development happening on top of these blockchain networks, these various smart contracts that have come together to allow for, for various DeFi applications or NFTs or what have you, all the layer 2s, all the ZKPs, all this insane innovation that's gone on in the last, over 10 years now, 15 years now, in this space that has just started with that launch of the Bitcoin white paper. And so I think when I think of crypto, I think of all of it in aggregate, obviously diving into any specific space. And so for us, a lot of it comes down to thinking about, JP Morgan's client set, JP Morgan's businesses, where those core problems exist and how the underlying tech blockchain itself can help address some of those problems. So that often lands us in the space of tokenized assets, on-chain payments, digital identity. But yeah, to me, I think of it, all in all in aggregate and various implementations of the tech having obviously different impacts to what you're addressing.
I love it. You might work at a bank, Kirti, but I think the way you started this off is great. I won't hold it against you. Luke, why don't you share your side of it?
Yeah, sure thing. And for me, it kind of is perfectly encapsulated by the kind of number one use case and real world asset tokenization example that we have in crypto, which is the stablecoin. And when I think back to kind of my experience really becoming a DeFi power user and like getting in the weeds on some of this stuff and starting to be really, committed to doing a lot of my personal banking and financing on these public permissionless blockchains, it really came about in 2020 with kind of the prominence of USDC and kind of Circle's push into the marketplace. And what you have with the stablecoin, and I think this is really, it sets the stage for a lot of the other more complex assets that we're trying to tokenize now, is a dynamic version of your dollar bill that you can, plug in to all sorts of different protocols to do trading on Uniswap, to do, borrowing and lending on Aave and Compound and things like this, with something that you are self-custodying and you have full ownership over. And that really just opens up it really opens up Pandora's box of bringing capital structures and bringing different types of assets on chain, and kind of gaining from the efficiencies and the transparencies of these public permissionless environments that we know and love.
I love that. It's a great way of describing it. And yeah, stablecoins, we'll come back to that one. Martin, why don't you kick us off next?
Absolutely. And thank you for having me. I think Shubi may have given it away by saying I've been on Wall Street for 24 years, so I feel like the elder of this group, and I love that because I can maybe kind of attack your question from a slightly different direction. So I really, have been obviously very crypto aware for most of my career, but I would say in terms of really becoming excited about it, has been truly in the real world asset use context and tokenization. And hopefully we'll get a chance to talk about this a little bit more at another point in the panel. But when I look at a market like the carbon markets, and I look at the intersection of climate, technology, and finance, what has really fascinated me about that juncture is the climate and the carbon markets is one of the newest financial markets we have, specifically the voluntary carbon markets. We're not dealing with how do we handle, tens of decades of data and how do we integrate that into a tech forward world. We're creating the new world today. And the idea that we can do that with a blockchain, with tokenization, with stable coins, and also dramatically increase the reach of those markets to individuals that may have never otherwise been able to access those types of products is absolutely fascinating to me, and it gives me a wonderful arc of my own career to really just jump right into this and see what we can do to be constructive to that effort.
Yeah, carbon markets are really, really cool example of where blockchain is kind of going to market, so to speak, right? But before we get there, Kevin, I'd love to hear your perspective as well.
Yeah, happy to. So yeah, I mean, there's definitely a lot of things that I want to say, but I'll keep it fairly short and maybe higher level, which is, you know, I found myself at Citi where I was running like a structured credit trading desk, basically just running on a hamster wheel. And you can kind of see going forward, you know, these people who have been there for decades, kind of just playing the war of attrition game and like doing the traditional finance thing. And I always found finance to be such a compelling mix of so many things that I cared about: behavioral, like psychology, right? Like economics, mathematics, business. And I found that so compelling, but I just didn't see myself wanting to run that hamster wheel and do what these people did for their entire lives. And quite frankly, even if I did, I wouldn't make nearly as much money. So what's the point, right? And so when it came to this ecosystem, I think I initially came in because it was an opportunity to take those same interests, take my skill sets and say, all right, wait a second, I can apply it in this different context. But what drove me was also just being part of a movement, right? Like one of my favorite VCs, Frank Rotman at QED, he kind of described crypto when he like really dug into it as like mass civil disobedience. It's effectively like a bunch of people coming in and just saying, well, the system, the way that it works, right? What we were doing at Citi, it's working okay, but it's not working for everybody, and it's not working as well as it should, right? And to change it from the inside is such a painful and almost impossible process. But I think for those of us, you know, certainly on this panel, but then also who are really thinking about how these worlds will intersect, how this technology will, you know, transform the way that we transfer value, both in the real world, but also in the, you know, digital native world. Like that's a once in a generation opportunity that I would never have been able to be a part of if I had just like been another cog in the machine. And that's the exciting part about being in this industry. That's why I'm in it. And I think ultimately it's a once in a lifetime, once in a generation opportunity to take all the things that I was doing before, be like that I was super deeply interested in, but to actually feel like I'm part of a larger mission, which is not something that I ever felt when I was working in traditional finance.
I love that. It's an amazing way to put it, right? I think, you know, everyone on this panel has had a background in TradFi or is still there today in like the big banks, right? But we've all been pulled into this space because of the innovation potential here. And I think that's like a reoccurring thread that, you know, this really is the bridge from how we go from the old world to the new world and pull them to closer together. And Kevin, we're definitely going to dig in a little more because I think your perspective in the trenches is really interesting, right? But before we get there, I want to get like the state of the market, right? So Luke and Kirti, you know, Luke, you're selling institutions every day at Avalanche, an amazing network that's been like blowing up, right? Kirti, you are the institution everyone wants to sell to. I want to understand like what the state of the market is, right? For 3 years now, maybe even longer, we've been hearing, you know, the institutions are coming. And I got to be honest, I'm still asking myself, right? Like, where the hell are they, right? So I'd love to get them to understand, you know, how you guys view it from your side. Luke, why don't you go first?
Yeah, sure. And spoiler alert, the institutions are in fact coming. They're just coming slowly and, you know, one foot in front of the other and taking their sweet time doing it. But even just kind of the last year plus that I've been in this space, the developments and just the people doing their homework who, you know, are pretty senior at these firms, who are really putting their career on the line and really, you know, putting their foot in the sand and saying, you know, this is going to be something that we're going to pursue and push forward, kind of despite what's going on with the broader macro tape, despite what's going on with the regulatory landscape. This is something that we see as truly impactful and innovative for our business. I'll say, you know, particularly to Avalanche, we're seeing a ton of traction and interest with some of our subnet architecture. And a lot of the kind of enterprises and institutions who are taking a look at Avalanche now are pretty interested in deploying in an environment that's an application specific blockchain where they control all the customizations of their execution environment. They can, select their own gas token or spin up their own token if they like, to kind of drive the network, explore things like gasless transactions, have permissioning around validators, permissioning around users, implement a number of different KYC tools into their chain directly, as well as, implement some privacy tooling around transaction data and keeping sensitive stuff kind of off chain. And a lot of these people are converts from, the kind of private and enterprise blockchains that had been kind of the talk of the town in the 2017 to 2019 vintage. And we're really seeing that the past few years have opened a lot of people's eyes to the power of public permissionless environments. And the beauty of the subnet is you can build it and deploy it with all of this kind of privacy and permissioning built in, with the optionality preserved to open up and really get those benefits down the road whenever you're ready. If the regulatory landscape changes, things like this, whenever that green light comes, you have that optionality there. So everyone's doing their homework. A lot of times, I think, because these institutions just keep everything under wraps and have so many, NDAs and stuff like this in place, it kind of gets taken for granted. But things are definitely progressing at an encouraging pace, I would say.
Thanks, Luke. And Assad, the institution is here. Just kidding.
It's right here in front of us. That's right.
No, but I will say, having been within JP Morgan's blockchain program since 2018, I've kind of had this like unique vantage point of being able to see how the conversation itself, like with our clients, with our competitors, with like, the other big banks of the world, has changed very drastically, internally, but again, also with that ecosystem, in the sense that, like, as Luke mentioned, in 2018, 2019, the question was very much, what even is this technology? Like, what are we actually doing? Half the conversations I had, I was like still trying to differentiate between like, this is what a cryptocurrency is, and like, this is what like a smart contract is that automates a trade, like very different things and have different implications for when you're thinking about utilizing them in whatever capacity you might be. So in any case, the conversation has definitely elevated to a point where I think, there has been that expertise built up at various institutions. There's a lot more comfort in terms of thinking about utilizing the tech and thinking about like the various different use cases. I will say, like, on the thread of, like, for instance, the platform that we run at JP Morgan, we launched back in December of 2020. It is a permission platform, runs on Quorum, so very, very similar to running an application on or running on the Ethereum network, but still in like a permissioned ecosystem. And so I will say the conversation about comfort with interacting with blockchains and comfort with interacting in a completely public and permissionless ecosystem, those are two separate things. And I think part of the reason why they're still very like bifurcated is because the regulatory environment has changed to be pretty unfavorable, especially in the US. And so, but that said, I don't think it's like all bad news, right? I think you still need institutions learning and understanding like what it actually takes to issue a tokenized asset or hold it or record it on your balance sheet or account for it in your risk management systems. Like, these are all concerns and considerations that you take regardless of what type of network you're operating on. And I think if you're able to build that up in a permissioned ecosystem, like, cool, you're just that much better positioned for when, I believe, like, things will completely converge to more public and open infrastructure. So that being said, like, agree that the institutions are still coming, but very slowly and stepwise, so as not to like piss off all the US regulators as many already have. And I think the other thing that is being unpacked a bit more, or has been over the last couple of years, but is coming more into like center stage now, I think, is all those prototypes and proof of concepts around, be it tokenizing real estate or tokenizing whatever else. I'll talk about what we've done. We've tokenized treasuries, we've tokenized many funds. All of that like experimentation has now led to the ability to say, like, we have applications that have, you know, billions of dollars of transacted value running through it. And that gives what you're doing that much more credibility, so that when an institution is coming on board, it's not just, I'm here to use new tech, but I'm here to use the new tech that's actually going to solve my problems and open up my ability to access liquidity or participate in a new market or solve a problem for my client. So I know everyone always likes to say inflection point. People probably said that like 1 million times, especially in the year 2021. But maybe it's like inflection period, right? Like we're like in this place where the learnings are starting to materialize into like actual action and actual like volume and onboarding and all that fun stuff.
Yeah, actually, I love the way you said that. And I think I will say, hearing someone from JP Morgan talk about the public, open, permissionless world, maybe being the world of the future, I think like publicly acknowledging that, that's a significant step forward from where we were a few years ago, right? That would have been a much harder thing to say and get away with. So, and then Luke, like the way you're talking about the private permission growth and the involvement in that now, where subnets are, like, that's growing pains, right? It's an industry where there's traditional players, incumbents, legacy players that are trying to adapt to new technology. And of course, we're not going to get it right in the first try, but it's a path to growing and learning and like ultimately becoming more fluid, right? And then Kevin, turning it to you now, right? You're someone that's really like working on the stuff. You've moved your fund on chain. You can say that like confidently and surely. No one can claim that there's anything else going on there. That's pretty impressive, I think, right? So I think the question to you is not what do you think is going to come, but like, what are the lessons you've learned spending the better part of the last year doing that? Like, how do you think about how those lessons then, where you started and where you are now?
Yeah. Man, again, there's definitely a lot there. I mean, the first thing I would say is we launched this fund, like not to move it on chain. Like we launched it to be on chain from the get-go. Like we will be the first structured credit hedge fund that lives end-to-end on chain. Like the moment that the technology allows us to do that, like that's the direction that we're already going, and we're already way ahead of everyone else. But the reason that we're way ahead of everyone else is probably because the technology is really hard to use, right? There's not really a lot of reasons to use it today, in particular on the Ethereum mainnet, which is oftentimes congested, challenging to like access from a custodial perspective and on an off-ramp perspective, right? For us, we buy assets in the traditional real world. We settle bonds via DTCC, the traditional centralized like ledger clearing system. What we do is we securitize the assets into effectively a CLO, which is a fund in and of itself through, your platform, right? Centrifuge. And it's that, like, you can see the promise, right? The promise is that in order to issue a CLO in a traditional sense off of my desk at Citigroup before, you'd have to be be able to get in the door in the first place, right? You'd have to have the relationship, you'd have to have the scale. And then you would go and you talk to the desk. It's again, very relationship driven. You pay 75 basis points to originate a deal. You pay the lawyers an egregious amount of money. And then you bring in, all these counterparties that are really there to just like shift money from one account to another pursuant to a set of rules. And that's exactly what Centrifuge's platform does, right? That's what we're already doing. But in order to access that, right, and to access that power when you have stable coins or programmable money and smart contract on the other side, we've got to do simple things, right? Like, it's already been alluded to, like the fund auditing, right? The accounting side of this, like actually custodying the tokens, which today, we do through a platform called Fireblocks, which we think gives us really the most safe experience that we can possibly have. But two things, about Fireblocks in particular, right? One of them is it's still a fairly challenging and daunting and time-consuming piece of this, and that's not acceptable to traditional institutions, right? And then the second thing is, from a regulatory front, we don't even know if that's a qualified custodian. We're an RIA, right? And so, and that's getting a little bit into the nuance, but like that's some of the, immediate challenges that we have to deal with. But I think we put ourselves in a great position because we're actually dealing with these things, right? We're learning, we're trying to figure out how we can build solutions to this, whether with partners, whether ourselves, or whatever else it is. But it's both sides, right? There's clear problems that need to be solved today. But the promise is also very, very clear, right? When it comes to what we're doing on chain, we can do almost everything instantaneously, basically, from minting money with MakerDAO to off-ramping it or transferring it across like different types of wallets, the cash flow transformations, the distributions to note holders. It's really only that we have to run two systems in parallel because we're still stuck to this broken traditional system. And then every time we move into that system, like we are also limited by T+2 settle, or the ability for traditional, just like the limitations of the traditional system as well. So I think we sit at an interesting place where we see the limitations of both, but I think it's important for everybody in crypto to also be honest about that, because if you're not honest about the limitations of the technology that you're using, you're probably not going to fix any problems. If you're not fixing any problems, you're building for nobody. It's worthless in the end anyways. So hot take, I guess, but
we'll put a pin in that. We'll come back to talk about the tech maybe more generally across all the speakers today. But Martin, I want to turn to you now, right? We talked about like tokenizing repo and tokenizing US treasuries, tokenizing CLOs, right? Bringing institutions from the permission world into the kind of like the public permission world, right? But you live in a marketplace today, and like the carbon credit, like refi movement, which is, the financial infrastructure doesn't really exist for that today. It's kind of new markets being created, new participants. How does that impact the way that you imagine like the go-to-market? Like, what's it like working in a niche market, then bringing crypto there?
Yeah, I mean, it's on the one hand an incredibly exciting opportunity, but for a lot of the reasons that Kevin just sort of explained, as well as Krithi, about some of the challenges with these parallel systems. A lot of work is going to have to be done. And, one way I would think about answering that question, Assad, is, maybe just take a very brief step back and just think about the size of the carbon market that is laying in front of us. And that in and of itself speaks to the tremendous opportunity and role that crypto has to play in addressing that market need. There was recently a statistic I heard, and I'll get it largely right, that if we are the world has a budget of about 250 million gigatons of carbon before we kind of hit the tipping point, and we're sort of exceeding that by about 50 million a year. So is our break even 5 years, 6 years, 7 years? If technology improves, like clearly that gets pushed out, but there's a lot of CO2 removal which needs to happen. And even if companies just reduce emissions through their own operations, it's not sufficient, which is why you need markets like the voluntary carbon market to actually encourage other activities and actors to reduce that opportunity set. And if we look today at the various markets that are available, the voluntary carbon market has grown from about 50 million bucks a few years ago to about $2 billion today, and it's forecasted to grow to about, different estimates range, but on the low end 10 billion, on the high end 40 billion by 2030. You can see just how much activity is needed to help solve that problem. And if we look at some of the ability for actors, whether they're retail actors or even large corporate actors, to access that market, these are custody accounts. They're complicated to access unless you're a professional player. It's not simple for people who want to contribute to this movement to actually access the strategies and the products that are necessary to do that. So when we think about the role of tokenization in terms of driving that demand, importantly, driving the transparency and just driving the access to capital, you can start to quickly see how the relevance of crypto complementing traditional finance tools is absolutely essential if we're going to reach the scale that we want to do. And we've been really fortunate that this journey on tokenization of flow carbon has been at the heart of what we have been focused on. And we're really encouraged that a number of the professional partners, the authorities that are effectively issue carbon credits, are in the dialogue, and that's really essential to bring credibility to the market.
It's an amazing way of putting it. Finance is literally, not to get too philosophical here, but it's literally about like pulling value from the future and bringing it forward. And then here you are talking about actually using finance to buy time for future selves, right? Yeah, I love those conversations. I want a general question now to the panel, right? I'll let you guys fight over the mic yourselves, but like, is the tech ready? I mean, kind of Kevin mentioned it, Luke, you're selling me on subnets, and I respect it, but is it ready for institutional adoption? Are we ready for like that type of scale and volume? What do you guys think?
I think it's getting pretty close. And frankly, with a lot of the stuff we're looking at, a lot of the innovation that needs to happen, it's not a lot of times not at the software level, it's at the paper level, it's on the legal side, particularly when you're thinking about the tokenization of real world assets. And I think what Martin just said really resonated with me, because when I look at tokenization projects and different people who are tackling different markets, a lot of the issues that we run into is, number one, is there an adverse selection problem here? Like, are people going to say, okay, this specific fund of this private equity firm is being tokenized because they need more liquidity, they need more demand here, and it might not necessarily be the most attractive investment opportunity to the legacy players who already have access. So they want to open this up and kind of push a democratization of finance type narrative. Number two, it's the regulatory and compliance piece. And number three, it's like I was kind of alluding to, just the demand side in general. Like, is there a market to be made here? And kind of when you think about where you're seeing a lot of traction, where I'm seeing a lot of traction in the real world asset space, it's in emerging markets where, similar to the carbon markets and kind of these newer types of opportunities, there aren't traditional finance rails that people are super reliant on, or are on par with what we have in the US. So you're seeing protocols like Goldfinch and a lot of kind of copycats out there tackling different regions from LATAM to Southeast Asia, to kind of EMEA and kind of everything in between, where you don't have to deal with the US regulators looking at, is this a security necessarily? And the market is very receptive to this type of technological innovation. So I think the tech is there. And then, when we're looking at securities and the US in particular, it's the legal stuff that's really the holdup, in my opinion.
So I agree with a lot of what you said around the regulatory angle, a lot of the hard work being in like the legal documentation, and the fact that what we go after first is the spaces, be it like jurisdictionally or like asset class wise, where there isn't the infrastructure in place today. And so by providing one that standardizes assets and allows you to trade and settle much more effectively than you can today, it's going to be the key areas for adoption. But my caveat is, I think the question about adoption is sometimes a little bit difficult for me to quantify in my mind, because it's like, to what extent, to what order, right? Like, if I think about like, is the tech ready for institutional adoption to the same effect of like how a JP Morgan or a Goldman Sachs or whatever is trading across all of their different asset classes today, across all of their different markets, then very much no, I don't think it's quite there. I don't think we're in a state to like, conduct the next several, however many like IPOs on chain and what have you. And I think that's the case for a number of different reasons. But to exactly what you were saying, I think there's certain markets that are probably more ripe for this innovation for us to go after as well. So that caveat aside, I think some of the areas that still need quite a bit of work are, one, privacy, 100%, especially in getting to a public permissionless sort of ecosystem, on-chain privacy, being able to, ensure that, like, again, if like a JP Morgan's trading with a Goldman Sachs and you're able to like look at the ledger and validate that transaction is true, you're not actually able to see the details of that transaction, or you're not, at the very least, it's not just like pseudonymous trades that you could actually figure out a way to understand like who's trading with one another, but actually true privacy where you don't have you don't have that ability to assess who's doing what, I think is huge for institutions in bringing on large amounts of volume. I think the other piece that I probably am not like the best person to speak to this, but I know it is something that we're going to have to like properly address, is it comes down to like volume and scalability. Obviously, there's so many like L2s out there trying to address this. I know Avalanche also, there's like a lot of like documentation out there around the scale, but again, it's for me, it's pairing like the types of transaction volumes that flow through traditional markets today with what the tech can offer and support. I'm just not sure those two things have fully, kind of like aligned as of yet. And then also, sorry, the last thing I will say is for fully like permissionless like trading and transacting and volumes, I think the other thing to figure out, which a lot of companies, like as Kevin mentioned, like Fireblocks and obviously like Coinbase, Anchorage, all of them, but like the custody angle ties very closely to both the privacy and scalability angles as well, right? And so I think that's a piece that we'll have to figure out too. And then, oh, sorry, one more thing, just because like retail adoption of like various digital asset use cases is weirdly like near and dear to my heart. I think in order to truly get there, like self-custodial wallets also, I think, have quite a bit of room to grow in terms of getting there from a tech perspective to actually attract the type of adoption that I think we all want to see, to say, yes, check the box, like this thing has been adopted. Sorry, I said 2 things and I extended to 4, but hopefully.
Yeah. I mean, even just echoing off of that, though, I think I think I couldn't agree more. Like my personal view is the tech is very far away. It's simply not scalable enough. The privacy issue is something that needs to be figured out. Self-custodial wallets are something that, I mean, for me, it's difficult to look at our use case as an institution and say that it's easy to trust this technology. It's extremely difficult. But I think the reason for optimism in this space is that you're building on a single, like in an open ecosystem, right? This is open source code. You're standing on top of the shoulders of giants, right? So all of these individual things, if you were thinking, like if I were building a company around, how am I going to solve all these problems? I've got to sequence all of these things in the right way, keep my company alive in the interim so that I can hire the people that I need to develop the technology. It's always going to take longer than you think, but that's not how this development cycle works in our space, right? Like zero knowledge proof technology is being worked on by many people. Account extraction might go live on Ethereum mainnet, like from the Ethereum Foundation itself, right? Which solves some elements of the self-custodial wallet problem, right? The beauty of it is you just have to pick a lane here, right? You have to take for granted to some extent, you have to take a bet that other people are working on the parts that are near and dear to their heart, that they're expertly, situated or adept to solve those types of problems. But the incentive is there, right? And the movement is there. And that's the really exciting part about, I think, being in this space. But I think, yeah, if as a user of the technology today, and granted, we use the technology that rests on top of Ethereum mainnet for a variety of different reasons. But that is there's a lot of reason for optimism in the public space. And in fact, I think there's more in the public blockchain space than there is in the private blockchain space, because that's if you think about, Onyx, for example, I don't want to speak for Kirti, but they do have to sequence this stuff, right? They have, they might be able to look at partners and draw from, that technology, which they have. They've forked Aave, they've forked Uniswap, they work with many partners on, as far as I understand, you still have to be very, very thoughtful about what's the next problem that you tackle. Whereas for us, I think we just have to pick what problem we're uniquely situated to bet on and to fix, and believe and just watch what else is happening in the ecosystem. And I think the pace of development will surprise people over the next couple of years, because this particular use case is starting to hit the mainstream, right? Very few people were talking about real world assets being tokenized on blockchains until really the last year or so, despite other, a lot of projects and vanity projects in the space. So yeah, that's kind of my 2 cents. I definitely want to, be measured about where the technology is today and be honest, but there's a reason that I'm here. Like, there's a reason that all of us are doing this, because I think like you got to be in the water when you're catching a wave. Like, and a lot of people are still on the beach. Like, we're the ones in the water. Like, when this wave comes, and we believe it will, like, you have to be there to capture it.
Yeah, I completely agree with that. I think a lot of times those things that I just cited are cited like outside of the ecosystem, are cited as reasons to not engage with crypto or not engage with blockchains or not build, or why institutional adoption can't come. And to exactly Kevin's point, like, it shouldn't be seen like that. These are just, things that we'll have to overcome, and areas of potential for new companies, new ideas, new projects to come fill those gaps so that we can get there. But none of it should be seen, I think, as like insurmountable. It's just like taking, a look back and saying, okay, this is where we're at, this is where we need to go, and like, who are going to be those building blocks that fill the pieces. And also, thank you for plugging our initiative, Project Guardian. That was a step towards figuring out identity on public blockchains, which will be a huge, huge thing for getting institutions to buy in.
This space is like really interesting because it's, you guys are hitting on so many points where there's so much experimentation going on still, even today, right? We're a decade down the line, maybe even longer, depending on how you look at where this really started, right? And we're still in this very early stage, very R&D heavy, but then the R&D looks so different than what it looked like previously, right? Everything's in production, it's all in the open, it's all live, it's all working on composable networks. You have a partner the minute you step into the Ethereum ecosystem, for example. But then we're now making this mindset change to like product delivery, or like, delivery to real customers, real markets, right? I think that's a really underappreciated aspect of the industry and where we are today. And when I think about institutions, that's kind of what I think about as well, right? We spent so much time delivering for our industry, the crypto industry as it has existed for the last 5 years. The institutions require a very different thing, right? They require very different needs. You guys here know it better than most, right? I guess the question I want to ask next, again, it's back to everybody, right? As we're getting to like the last half of this conversation, what are the areas you think are really pushing the boundaries the most, right? Martin, you talked about carbon credits. Kevin, you talked about CLOs, which is a fascinating topic, I think, right? Where are the areas, whether it's technical or it's an industry or it's a business vertical, or if it's a legal or regulatory issue, like where are the things that are pushing the conversation most, and you think maybe will be something that changes over the next, in 2023, right? Martin, you want to jump in?
Yeah, I'm trying to think about the best way to to answer that. I'm gonna give two maybe slightly non-traditional examples, but these are very real world life cases, as in their conversations I've just had in the past week. We spoke to what I would consider to be one of the most well-known, longest living insurance companies in the United States, hundreds of billions under management. And, when we're trying to probe in terms of pockets of liquidity, we spent a fair bit of time talking about the tokenization of carbon credits, but we're also very much focused on catalyzing early stage development financing to carbon projects. And we're also very much thoughtful about the applications of blockchain to finance, to catalyzing those types of opportunities. And as you can imagine, we have to navigate a pretty big web of networks within traditional financial players to understand where those pockets lie, because there's a lot of liquidity and it all has to come into the system to solve this problem. What's really heartening is when you look at some institutions on the cover and you assume that maybe they're not ready for this, and then you find out they have tokenization accounts opened in Cayman and they're investing in digital blockchain companies, and they're coming to people like us to say, hey, we're ready, help us help you, right? And like, help us think about how to structure these transactions. Very heartwarming. So I do think there is a readiness, and some of the people have spoken about, and once that institutional capital starts to test waters in places like the carbon markets, in tokenized format or in some form of blockchain finance, it's there. And then on the flip side, just to give another example, and maybe I'm sure Kevin and Luke can appreciate this, just given their day-to-day, we can talk to a very large bank that takes 18 months to do a blockchain enabled financing in the investment grade bond market on 3 different private networks, and they're ripping their hair out trying to figure out how they got there. But yet the excitement to kind of actually figure this out and actually spend the time to try and get to the next level, that's great as well. So I would just say that, who's pushing the envelope? I think some of the unexpected players are pushing the envelope, but they need assistance from us to get there.
Luke.
Yeah. And I'm going to kind of tackle this from a Avalanche specific viewpoint and vantage point, though I think a lot of the themes will kind of resonate with the broader Ethereum ecosystem. And I think we're very spiritually aligned with a lot of the developments going on over there. But when I think about what we want to do at Avalanche and what kind of differentiates us, it's the strength of our tech plus the strength of our commercial offering and kind of our business team. So we recently inked Amazon's first foundational partnership with a blockchain company with AWS. And so we have a lot of support from them on the infrastructure side with validator deployment, running nodes, stuff like this, for anyone in their kind of network and anyone in our network to come in and get $100,000 worth of AWS credits to come in and deploy, with one click validator deployment, moving towards down the road, on the AWS offering, one click subnet deployment. That's kind of the vision we're gunning towards. And when I think about a couple of the subnets that have really stood out, on the DeFi side, traditional DeFi, we have Dexalot, which is a central limit order book that owns their own execution environment, and everything is kind of optimized for their trading purposes. And I think when you take a look at what kind of happened with FTX and just the traditional kind of CeFi rails and trading infrastructure and kind of the market structure of crypto more broadly and where we're at, I think those kinds of applications are going to be massive, and you're going to see just a ton of trading and lending volume and all of this activity, this surge of activity coming on chain, and the broader ecosystem being able to reap the benefits of that, whether it's the market makers, especially with a central limit order book and the kind of efficiencies there versus the AMM model that most DEXs have kind of been relying on to date. I'll also plug our Intain Markets subnet. So this is a securitization marketplace that really opens up structured finance deals to lower ticket sizes, lower deal sizes. And on the administrative side, the cost savings are pretty staggering, upwards of 50% a lot of times in terms of the fund admin stuff that gets automated away. And I'm also going to plug our gaming team, because with Avalanche Consensus and kind of the scalability and the TPS and really the time to finality that comes with Avalanche Consensus, which is the third most ever novel consensus mechanism in all of crypto behind Nakamoto and Classical. To me, it really lends itself towards financial services use cases, but also to gaming. And we've had a ton of traction on that side. So we recently announced a subnet for TSM, which is, I believe, the largest esports kind of organization on the planet. And they're utilizing a subnet to basically build out their Blitz platform, bring a lot of their gaming competitions on chain, and really reward their users with digital collectibles that are going to be worth something. And then you also have kind of the account abstraction piece there, where we've white labeled our core wallet product for those users to interact with the subnet and basically do so in a way where they can interact with a credit card, with a debit card, with an email address, stuff like this, where they don't have to kind of worry about the typical MetaMask wallet setup or self-custody type of experience. It's a little more just kind of watered down for this mass audience. So I think things like that. And then when you think about the composability and the ability for Avalanche Wharton messaging to allow these different ecosystems and chains to really talk to one another and, share Oracle data feeds, really have that kind of interoperability that way. And I think you're seeing a lot of similar stuff with Ethereum, with Layer 0, Axelar, a lot of the cross communication stuff that's been super topical. So all that stuff gets me really excited.
I think that's actually a great overview of like some of the stuff in the space. We've got a few minutes left, but it's Friday, so I want to make it a little fun. So I'm going to ask for your big macro hot take in 2023. But before you get started, I did a Twitter space on a Friday like a few weeks ago, and it involved like legal and regulatory stuff. So you can't mention regulatory and legal because I refuse to do that on another Friday. But macro hot take for 2023, got to give it to me in like 30 seconds or less. What do you guys got?
I think we melt up in a big way in the next few weeks. There's not a lot on the macro calendar, but I think we put in new lows after that, unfortunately.
Great. Love that. Kirti, what do you got? JP Morgan coin, it's already here. I don't know. What else is going to happen?
It's already here. Well, we're on a path to open up to third-party tokenization platforms, connecting in, being able to deploy on JP Morgan.
Exciting.
So hopefully by the end of the year, there's orders of magnitude more than what I said. What did I say? 500 billion? Orders of magnitude more than that transacting through our platform. But I don't really feel like that's a hot take. That's just like me delivering on our roadmap. So I don't know, hot take. Could there be like a total like switch up in the game? And by the end of the year, we're all sitting here like, wow, the first part of this year was so like dire. And now look at where we are, full switch. I don't know.
Optimistic. I love that. Kevin,
Optimism.
give it to me. What's your hot take, Kevin?
Man, I think what's my hot take? Jeez.
Dogecoin to the moon, right?
Nah, to be honest, I don't really give a shit. I don't want to swear. I was about to swear. I don't really think or care about where crypto prices are trading at any point in time, ever. And I know that's bizarre coming from someone who works at a crypto hedge fund. I would say, I think for us, there's going to be a real bifurcation in the people who are thinking about tokenization in this space, like in 2023. There are many people who come into this space thinking about it as if I will tokenize this asset and I will achieve greater distribution. I will find people who didn't exist before to purchase these types of assets. My own experience, that's not how it works. And so I think ultimately there's going to be a wide bifurcation between those who are just like, I want to tokenize assets. I don't think about the customer experience of who's actually buying the tokenized assets. And then those who, as you alluded to, like, as the industry starts to change and has like a customer centric view of development, which means like I need to go and figure out what the customers actually want. Right now, like the customers are the JP Morgans of the world, or the prospective customers are those guys in the world. Very little like broad discussion or interpretation from DeFi to TradFi. In fact, they run in parallel tracks philosophically in many cases. Our explicit goal at Block Tower Credit is to merge those two worlds together, both by building consensus from a behavioral perspective, but also building the technological tools to allow it just to lower friction. I think we and alongside you guys, right, at Centrifuge are spearheading one side of that, right? And I think that's going to be a bigger bifurcation than most people think when it comes to tokenizing real world assets in general.
Yeah. Your liquid assets are liquid for a reason, right? But Martin, your hot take. What's your hot take?
I got to stay on the environment, otherwise I'm not being true to what I'm passionate about. But here's what I would say. To that. I know people are aware last summer when the Inflation Reduction Act came through, that it was important. But I actually think as we hit the end of 2023, people will start to feel a little bit in the day-to-day life the impact of that capital injection into the United States to help, improve our environmental responsibility. And lots of the grant money that's being put out for proposal will start to get awarded. You'll start hearing a lot more about green hydrogen hubs. You're going to hear a lot more about direct air capture technology. And I can't wait to kind of, I don't think we'll be the Chat GPT level in terms of how that came on and sort of entered the public discourse. but it's going to be really heartwarming if we get to the end of the year that people start talking about it a little bit more in their day to day. So I think that's going to creep into our consciousness increasingly throughout the year.
I love it. I love it. I'm going to hand it back over to Shubi. It's the end of our panel. We could talk about this for hours, but it's a really exciting group here. Big thank you to the panelists. Thank you to the audience for tuning in. Happy Friday to everyone, and see you guys next year. Back to you, Shubi.
Yeah, all right. Amazing panel. I would like to express my sincere gratitude to all our distinguished panelists here for their valuable contributions. Your insights have been truly inspiring, and undoubtedly it will shape the minds of many MBAs listening to this panel, as well as the professionals who are curious about Web3. So thank you again for being a part of this event, and we hope that you remain connected with Wharton Fintech and Wharton in the future as well. Thank you.
Thank you.
Thank you.
Thanks, everybody.
Hello.
Hi, Danny. How are you?
Good, good. And you?
I'm good.
Nice.
Where are you joining from? London?
No, I'm actually in Boston at the moment. So
Nice.
yeah.
But you're based out of London, right?
Yeah, yeah.
Okay. Thank you so much for joining the conference again. We called you last year as well, and you were gracious enough to accept the invitation this year too. So really excited for it.
Yeah, and happy to participate.
Thank you. We'll wait for Ben to join, and then I'll start with the introduction for both you and Ben, and then Ben can take it over and
Yeah.
moderate.
Sounds good. Is it 30 minutes or 60?
It's 60 minutes, 50
Yeah.
minutes actually.
50. Okay, cool.
Hi, Ben.
Hey there. How you doing?
Good. How are you?
Doing well. Hey, Stani, long
Hey,
time.
Ben. Long time as well, yeah.
This conversation will be a good chance just for us to catch up.
Yeah, that is true.
Are there any topics that you are, want to cover in particular? Any no-fly zones?
Yeah, I think in terms of the topics, what's definitely interesting is what's happening with Aave in general, but also what's coming up in terms of the Go stablecoin. We can talk about the institutional side as well. There's the Aave ARC market and also the JPM project. We could touch base upon also the Lens protocol and Web3 social, and maybe a bit of like scalability and all the typical
topics. Yeah. Should
Yeah.
we? How much do you think? How much is it helpful for us to go into the backstory, your background, kind of the founding of Aave? Is that helpful
Yeah.
context, do you think, for everyone as well?
I think so. Yeah,
Okay.
I think so.
Okay. Yeah, I mean, I assume most people will know of Aave who are listening.
Yeah.
But for those that, and I think we're also like, yeah. So let's maybe start with the story, and then we can kind of talk a little bit about all the items you discussed, and then I sent over some other bullets just around just like more general topics that we can also cover.
Yeah.
But feel free to guide the conversation. I'll obviously moderate, but if you want to take things another direction, feel free to do so.
Yep, sounds good. Sounds good.
We're the last slot, I think, of today.
Yeah.
So people are probably, it's like 4 p.m. on a Friday, the end of a 2-day conference. So,
But the most exciting.
but the
times.
most exciting, yeah, we're the
Sure.
encore.
Yeah.
What's the amount of people you have usually participating in into the event?
So we had an in-person event yesterday where there were around 100 people, and right now
Nice.
there will be around 200 people who will be listening to this conversation. And
Nice.
eventually more, like there are around 250, 300 registrations, so they will eventually listen to the recording later on. But right now there will be 200 people listening.
Great.
I think we can kick off in 1 minute. So Ben, I'll start with short introductions for both you and Stani, and then I'll hand it over to you to moderate.
Okay. Thanks. Yeah, that sounds great.
All right, I think we can start. Good afternoon, everyone. For those joining right now, I'm Shubhi, one of the co-chairs from the Wharton Fintech Conference team. Welcome to the 3rd edition of the conference. I am delighted and honored to be welcoming Stani Kuleshov and Ben Foreman for our last and final fireside chat of the day. Stani is a thought leader in the world of decentralized finance and Web3 social, and the founder and CEO of the Aave Companies, a technology company that builds protocols, applications, and tools that incorporate decentralization, blockchain technology, and token-based economies. The Aave Companies is known for creating the Aave protocol, one of the most widely used decentralized liquidity protocols in the world. The Aave protocol allows users to supply and borrow cryptographic assets without intermediaries. The Aave Companies also launched Lens protocol, the open source decentralized social media protocol. Lens enables users to own and manage their data and social profile, and features built-in developer tools to create social media applications and services. Stani, a proponent of Web3 technology, is joining us today from Boston, but based out of London. And he regularly speaks at industry and business conferences about the benefits of blockchain and decentralized technologies to users, creators, and developers. He's also a passionate NFT collector and an active angel investor. Ben Foreman today will be moderating this fireside, and he is the founder and managing partner of Parafy Capital. Parafy is a leading investment firm focused on blockchain and digital asset markets, and an early pioneer in the decentralized finance industry. Parafy is one of the largest investors in digital assets and one of the most active users of DeFi protocols across the ecosystem. I'm very excited to announce that Mr. Foreman is also a former UPenn alum, so we're really glad to have you back. Once again, we are super humbled to have you both joining us, and now I'll hand it over to you, Ben.
Yeah, thanks, Shubhi, and Stani, it's really great to be here. I was thinking back to the first time we met, and I think it was in early 2019 in San Francisco during Blockchain Week, when Aave at the time was called ETHLend, or it was kind of making the transition, and was a protocol that maybe had 5 or 10 million of TVL. It was kind of just getting its legs. And now, over the past 3 years, I guess it's felt like longer, Aave has grown into really this juggernaut across, lending, across social media. There's a stable coin. There is permissioned infrastructure. It's really just become like this very, very important piece of DeFi and the blockchain space. But maybe just to start kind of going back to the beginning, would love to, if you could just share really the story around like how you came to start Aave, like why you decided it was a really important thing that you wanted to spend your life doing.
Thanks, Ben, and super glad to catch up now as well at the same time. So I still remember the day we met quite well, because it was 2019 where we basically had the ETH short for Ethereum lending, one of the first DeFi primitives already, and at the same time we had the first version of the Aave protocol in testnet, and I remember introducing and walking you through the whole protocol and how it works, and at that time specifically was memorable because I think it was still a bear market at that point. So we're kind of in the same situation at this moment, or maybe like how we call it is more of a builder market. But yeah, so I mean, I've those who don't know, so I grew up in Finland, Helsinki, which is very remote location for where I'm living today, for example, in England, London. And something that is interesting when I grew up is that I was very excited about the internet and computers very early in my life, and it provided this interesting access to information and things you couldn't find, for example, in your local libraries or within your local communities. And I was super excited about being able to connect with people across globally, but also at the same time play computer games with people I recently met online, and also buy things from different parts of the world. And for me, that was quite fascinating, because in some ways where internet kind of connected people and made information accessible, in my later studies when I was in university in Helsinki, I basically started to look more into blockchain. And I think something that made me realize relatively quickly is that blockchain and especially Ethereum and Ethereum virtual machine being able to create programmable applications that are either immutable, so it's very difficult to change, or governed by communities, could be a very interesting ways to build kind of like a financial access. And it was very fascinating because I've always loved the idea that it really doesn't matter where you're based and where you come from, but you have the same equal financial opportunity or social opportunity for equal social participation. And coming from Finland, where when I was growing up, every school in that country, for example, everyone has the same equal access. You just need to read a lot to get into a good school. But the fact that you have that access and it's granted to everyone was something that I kind of like grew up with and was part of my DNA. And I started to do first pretty much like a proof of concepts end of 2016, beginning of 2017, under the name of ETH. So it was I never anticipated that it's going to end up being a startup itself. It was just a bunch of smart contracts that we deployed into the Ethereum network. And what happened is actually that a lot of people within the community valued what we built and valued what I created. And some kind of a community started to come around on ETH. And from there, at some point I realized that especially as Web3 was growing as a movement, I realized that maybe there is something more into it than a simple proof of concept or experimentation. maybe this could be a way to bring universal access to financial transactions across globally, and that's was something that really inspired me to continue building. And then a bit later, I would say that's the first version of ETHLend became reality, and later Aave, and later we met, and later Aave got substantial market share in decentralized finance, but also became an evidence that decentralized finance can be very resilient infrastructure, resilient financial infrastructure that could be beneficial for everyone. So that's the short story for what how we came here.
And that's, it's interesting because, I think it'd be helpful to maybe just outline what Aave does at its core, just at least the lending protocol, lending and borrowing protocol. My assumption is that the majority of people listening have heard of Aave, and at least a large chunk have used it. But I want to make sure that we kind of come back to really what it does, because I think one of the common gripes in today's bear market is that crypto, there are no use cases in crypto. It hasn't created anything of value that's actually kind of tangibly useful. And I think Aave is one of the many examples of that kind of the counterfactual to that. So would love to, if you could just kind of outline, like at its core, like what do the smart contracts of Aave actually do?
Yeah, so Aave is it's a set of smart contracts that has certain type of policies. And those policies are, for example, the way it works from the user perspective is that a user can supply cryptographic assets and earn interest yield on those cryptographic assets, and they can be used as a collateral to borrow other assets to finance certain type of a goal. So that goal can be, for example, paying for tuition, mortgage, or some other opportunity. And the policies that are in the smart contracts are governed by a decentralized organization, a DAO. And the policies can be, for example, what are the interest rate curves or loan to value ratios. So for example, how much you can borrow against your cryptographic assets, or for example, what could be other type of risk parameters. And the exciting part here is that the way Aave protocol and many of the DeFi protocols work is that it's not really a peer-to-peer relationship. It's actually a peer-to-contract. So these protocols are running autonomously on the blockchain. In case of Aave, it's deployed on multiple blockchains. So it's on Ethereum, Polygon, Avalanche, and so-called layer 2s that are scalability networks for Ethereum. That's, for example, Arbitrum and Optimism and Metis. So interestingly, we as the traders, we can't really go and change the policies or risk parameters or the code base itself of Aave. It actually has a formal governance process. And that means that the Aave token holders come together and create different kinds of proposals, but also vote on them. So there's a proposal can be something like changing or improving the code base or adjusting the risk parameters. And there might be even 400 voters directly participating, and also even more if we count the delegators itself. So you don't necessarily need to actively participate in the Aave governance. You might delegate to one of the more active members, which is quite typical. And it's basically a set of rules on how you can actually earn with your assets. And the beauty of the system is that it doesn't do anything else. And once it doesn't do anything else, it doesn't have any other functionalities or purposes. And we also think of it as if it will be so-called public good. So as the protocol matures, it should be accessible to everyone and part of a open source financial infrastructure, and hopefully something that is valuable, efficient, transparent, and will be part of what future of finance looks like. So it's pretty much the way the protocol is used usually is through a wallet interface or some of these interfaces that have integrated the protocol itself.
Yeah, well, one of the things that kind of captured my imagination with Aave is my background was in lending and credit markets, and I recall just kind of how complicated it was to for companies to get access to secured credit, where to perfect a lien in collateral was a complex, legally cumbersome process, and then the documentation around the legal document, the legalese, for a credit agreement could be hundreds of pages long, confusing, and not simple. And so what's interesting with Aave is there's no actual underwriting process or people to fill out forms. If you own a digital asset, you can immediately borrow against it 24/7, wherever you are in the world with an internet connection, you can access credit. There's no legal docs to sign. And also the loans that are made are perpetual loans. There's no maturity as long as you have the collateral and you maintain compliance with the covenants on the network. You can borrow into perpetuity, and the rate will change. But I just found it to be incredibly elegant and simple, and a lot better. I'm curious, as you think about the growth, and I think Aave maybe got to at peak 20 billion of capital supplied. Is that roughly right?
Yeah.
So as you think about kind of the growth in Aave, it seems like largely it's been kind of retail crypto users and crypto native funds that have deposited capital to earn a yield, and then on the other side of the market, people that have deposit collateral to borrow against it. But how do you kind of think about that core lending borrowing protocol growing, another 10x or 100x from here? What are the big unlocks, whether it's institutions coming in or new collateral types that you see kind of on the horizon?
Yeah, that is interesting. So, and I think what's very exciting about Aave is that within the protocol, you basically have a lot of things that normally in more traditional finance, it's actually codified into the smart contract. So all these policies or rules, they can, and how basically what happens, for example, when your collateral value goes down and liquidation start, all those things can be codified. So in some ways, those rules are executing by nature and providing the kind of a best execution performance in that way. So I definitely see kind of when you compare from more traditional financial perspective, what's the innovation in Aave? And some of the reasons that why the protocol itself has been getting a lot of traction and DeFi in general. And by the way, I think DeFi is very open-ended. So as with any open source space, and you have the ability to create anything and build anything, and which is amazing because it means that any part of the world has the democratic access to contribute and innovate, and reduce cost and inefficiencies to the users. But something that is very valuable for many of these users is that you have that execution and environment that really guarantees the same result that it promises, regardless of the backgrounds of the users, locations, and their other potential elements. But it also provides the aspect of transparency. So with that execution and transparency, since you can actually see every single transaction, not only on the Aave protocol, but actually in the whole public blockchain, it means that you really don't need to trust a system, but since it has a formal governance process, or certain things can't be even governed because they're immutable, and you can see everything that is happening, it really creates an execution environment where you can quantify risk and reward more accurately. And that leads to not only the reduction of cost, but less actual need of trusting the system. And I think that's one of the reasons why DeFi has peaked quite a lot. And in terms of the usage, I would say that I personally vision that something like Aave protocol, or some of these resilient DeFi protocols that are designed for wider adoption, for the people to use and function well and take account risk and reward, will be used the same way as we use today. Many of the internet protocols that has been built in the early beginning of the internet, the IP protocol, HTTP protocol, and many of these that we're using on a day-to-day basis without actually giving them much of attention anymore, because they work as we expect. But I think more and more there's excitement actually around more savvier institutions that are not just only thinking about crypto, but actually thinking about decentralized finance as a better execution and environment with counterparties. So that is something I think where some of the adoption will go. But also, I think the crypto space is very wide. So something that we've seen over the past year is that many of the users that are using DeFi have come here from the centralized finance part. So they really don't like the idea anymore of giving their funds and the custody of their funds to a centralized exchange or some sort of centralized lender that promises yield, but operates in a black box model. But they actually want that transparency and want that guaranteed execution and non-custodial access. So I see DeFi growing towards taking a lot of the parts of the centralized finance, but also I see a lot of path towards more institutions. And maybe the even future path could be that DeFi, as a software, it becomes kind of like an infrastructure, and then you have various service providers that are already in the centralized and traditional finance that are plugging into the DeFi ecosystem. So I think that might be the way to see how these protocols will grow.
Yeah, that's really fascinating because I think one of the things like we've tracked is if you look at kind of the URL that people use to access a Uniswap, it's going to uniswap.exchange or Aave's kind of front end. The percentage of the smart contract interactions that are comprised by retail users going through these web front ends is kind of diminishing over time. And I think like what you described around Aave really being this like more core base level infrastructure that different institutions or consumer fintech companies are plugging into, where users are really interacting with like a more of a Web 2 interface. And then that fintech company is tapping into kind of smart contracts for those efficiencies. My sense is that is kind of how really things are starting to scale in a more meaningful way, We actually internally call it kind of DeFi mullets. So fintech on the front, DeFi in the back. Because the reality is like using DeFi isn't that easy. I think it's for people that want to tinker around with technology or understand, finance and the utilization curves on Aave to understand what rate they're going to earn. It's probably a more limited group. Most people, I think, just want to, know that their money is safe and earn money and just go about their everyday life. But the other thing that kind of stood out with what you said was, over the past year, you've obviously seen a number of very publicly visible failures in crypto. Everything from FTX to Celsius to Voyager to Three Arrows Capital to BlockFi and others. And many of these, I think, were a function of lenders that were basically centralized lenders operating as companies that took in crypto collateral and lent against it, similar as Aave. And over that past year, these companies kind of struggled. Many of them are in bankruptcy due to poor risk management. And Aave, on the other hand, hasn't experienced any defaults or any principal losses given defaults. And if you were to kind of crystallize one that's, I think, incredibly impressive, right? That code could outperform humans from a risk management standpoint. But in light of that, why don't you think? What do you think is really the reason why DeFi has survived this earthquake, but still hasn't? We're still sitting at lending and borrowing levels so much lower than they were before these events. Like, why hasn't DeFi kind of captured more attention? Why hasn't Aave drawn in more lenders and borrowers in light of the fact that it's performed so well?
Yeah, I mean, the biggest difference between those entities and Aave is that they're businesses and Aave is a protocol. So as a protocol, you aren't really actively looking to grow the business, but basically you're looking to provide a solution, an infrastructure, and that can be adopted, earlier or over time, I would say. And those entities, for example, what they were doing is that they were building financial businesses where the idea was to provide certain promise to the users, that their customers, in a very unclear way. So I think what the Aave protocol and DeFi, and as I mentioned, DeFi is open-ended. So I'm mainly talking about the protocols that are, and communities that are building towards scale. What the aim actually is to reduce the challenges that we have, or actually make them impossible to happen in the same way. So the fact that you can, in a non-custodial way, interact with these protocols is fascinating, because you really don't create that custodial risk. Obviously, it will mean that as an entity, you might want to find some other way to secure your funds, and that can be done in a very native non-custodial way. Or I could imagine in the future, qualified custodians are using DeFi infrastructure and being that middle, that basically a way of safely storing funds and operating and with the DeFi protocols for their customers. And obviously the other thing is the transparency I mentioned. So because everything is public, you can actually build better systems, but also because these protocols are governed by the community, so they have a DAO in the background, and that means that there isn't only one person that is deciding, or a team that is deciding about different kinds of risk and reward mechanisms, but actually hundreds of people that care about the future financial infrastructure, they're contributing either by governing or by building software or improving or providing some sort of risk services to the DAO and to the community. And I think that has been very important part also of managing risk and building more resilient systems. And something that for me that has been very unexpected outcome is that how these communities have been able to manage risk. So when I started to build, the very first versions of Aave, I was always thinking that risk management requires pretty much experienced risk managers, but actually it's the diversity of knowledge and understanding in different profiles that create good risk management. You need risk professionals for sure, but you also need more than that. You need a transparent system that looks like an aquarium where everyone can actually come and look into what kind of risk the system has and adjust these parameters and policies according to what could be their expectations or based on their modeling. And when you have a system that is transparent, it also means that you can build better risk mitigation tools, because what DeFi does as well is that it democratizes the access to build those tools, because anyone can actually create a business that provides risk management services for these entities. And what might work for one community could be also replicated to another community with certain type of that's why we see a lot of community members actually being active not only on one DeFi community, but might be even in 2 or 3 as well, which is quite exciting. So I think the transparency and the fact that these decisions are made with a large group of people really is helpful for managing risk versus something that is closed by few people that are paid to manage a risk. That's why I see like a DeFi system has more incentives aligned across the whole community.
Yeah, that's really interesting. I know during like certain periods of kind of market turbulence, the Aave community has voted to disable certain collateral types or reduce the borrowing caps on certain for certain assets and in real time, and to protect the network. And those participants that are voting on these risk management decisions, also to your point, are the owners of the network. So there's kind of very strong alignment and responsiveness from a risk management standpoint. And the other thing that you said that stood out is just the transparency of these systems. Is they're totally open. You can literally go borrower by borrower, lender by lender, and see every single position, every collateral ratio, understand all the liquidation points. And again, I can't help but compare it to just the traditional financial system, where if you go back to Lehman Brothers, their last 10Q filing before they went bankrupt, and you kind of dig into the GAAP financial statements, and there's very limited transparency into what risk they had, which counterparties they were dealing with. There's pages of footnotes and details, but also a lot of just numbers that don't provide enough kind of clarity or granularity. Whereas on chain, it's a stark contrast. You know every single agent in the system and their economic position, and you get that information every 12 seconds that Ethereum produces a block. So versus versus every 90 days, right? In traditional finance. So I wonder, like, sometimes I wonder if the financial system, if the financial crisis in 08-09 would have transpired in the same way if we had a different underlying infrastructure that was, open source and transparent in the same way that crypto is. But I guess I want to talk about the future of Aave and all the different things you're working on. But maybe before we go that direction, I think it'd be helpful just to get your thoughts on the current market environment. you're a veteran, kind of tenured crypto founder. You've seen a lot. You've been in the space for a very long time through multiple bear markets and multiple bull markets. And I'm just curious, kind of like, as you look ahead, what do you see as the major inflection points on the horizon for the space?
Yeah, I mean, it's definitely is interesting time now because not just in crypto, but in general, if you think about the macroeconomical state at this moment, and it seems that kind of like a finance is affecting every single industry at this point, and there's a lot of uncertainty. But something that is fascinating is that I usually tend to look into blockchain space and Web3 more from the innovation and problem solving perspective. So I do believe that today, for example, we have much more infrastructure built than, for example, a few years ago. So when we look at DeFi, for example, we've solved ways to obtain and preserve capital, also exchange value from different assets that the users are interested in doing. So having stable value on chain as well. And obviously payments is something that we're still have to solve, but we already have a quite decent decentralized financial infrastructure that's pretty much could be valuable to financial systems across the globe. And we have many of these systems are also governed by decentralized organizations, DAOs, and some of them are very, very widely decentralized. And what is now interesting to also see that we're going to have more non-financial applications. So it's the time when something that is non-financial is being built widely by using the blockchain technology. And that's going to be exciting because it's going to show that it's not only about finance, but you could use the technology to increase different kinds of participation that is not economical, could be social participation. And I think during this kind of times, what's important is to actually build, because usually technology is seen at its best when the markets are in a better place. So people don't tend to look at tech when things are looking good at the markets. But then again, like when everything is looking better, we tend to celebrate more what's being built and how these systems work. And I'm talking about technology in general, regardless like whether it's blockchain, AI, or something else. And I think it's quite interesting. We're living in a world where there's a lot of changes, but it's nothing new to the human nature. We've saw like humans saw basically what internet effectively did with a lot of businesses. What a record player did for music industry 100 years ago. And that's actually a very interesting example, because when the record player was invented, a lot of the musicians didn't like the record player itself, because they were thinking that they will be playing less music and having less gigs. But what it actually did that for them, they got more distribution, because people who couldn't listen to them nearby could actually listen to their records. So in some cases, there's misconception about the benefits of the technology itself. And it just takes time to mature and build those bridges to kind of like a more wider audience. But once that happens, people become less excited about blockchain, but it's going to be everywhere in some way that the user doesn't necessarily see. And I think that's where we should go towards.
Yeah, that's fascinating. What has it been difficult, I guess, as a founder during a bear market to continue to stay focused on building and motivate a team and community to build around you?
I think I think during bear markets, it's slightly a bit easier because there's kind of like a noise and additional activity that usually happens when you have peaks of technology. And it basically means that when there's less things happening, there's less things that are taking your attention. So I think it's been, from that perspective, easier, but obviously it's also harder because you usually have peers that aren't in the space, or might be even in the space, but they might not believe in the technology, or losing faith, or just getting frustrated that when certain things get built, or how long it takes to get adoption. But I think it's a patience game in some ways, and the way to move faster is educate everyone around us, and then the second thing is to build something that really is valuable for users. And when it comes to building something valuable, something that is interesting to think about is that we don't live in a crypto bubble. So, or we do, but we have to build things that are beyond that. So whenever we are trying to build, let's say, new solutions that are based on blockchain or Web3, we have to think about what is the actual end positive result and how it helps the society. And I think if you think about, if you start building from that vision and objective, you're able to get a lot of people behind of your idea, and not just the crypto crowd or the DeFi crowd, but kind of like a more wider audience.
Absolutely, yeah. So, okay, so let's talk a little bit about Aave and kind of what the next 1 to 2 to 3 years look like, and the different things that you're excited about. Maybe we can start with Go, the stablecoin. Tell us a bit about Go as a new kind of decentralized stablecoin.
Yeah, Go is decentralized over collateralized stablecoin, and it has some interesting innovative features. But one main thing about Go is that it's basically backed by the assets that are within the Aave markets. And down the line, the idea is that because Go as a infrastructure, it has so-called facilitators. So that's the first facilitator, but down the line that you could also mint Go against real-world assets and other type of ideas is where Go will go towards. But also in some ways, the idea with Go is to also think about the payments infrastructure, because as I mentioned, like we solve a lot of things in DeFi today and have a very working and resilient infrastructure. But something that we don't have is, for example, what Bitcoin tried to solve in the beginning, which is basically being able to settle transactions between peers. And Bitcoin has become more of a store of value, but now with Ethereum virtual machine, and you can actually build programmable payment infrastructure. And I think that's where Go has a lot of opportunity, especially because inflation is something that is really hurting a lot of users across globally, and especially in jurisdictions like Argentina, as an example, where the inflation might be 100%, meaning that's whatever from 50 to 100%, meaning if you look at the purchasing power of a pay you have 1 year later, you might have half of the value or even less, which is kind of a very sad problem to have, but also very global problem at this point. And thinking kind of like a more broader vision over the years, I personally think that the Aave protocol and the infrastructure should become a very stable public good, meaning that the protocol works well, it's resilient, it provides accessibility to everyone, but at the same time, also the idea of governance minimizes. So there becomes less of a need to govern the protocol. So certain things become more, I would say that resilient for also governance, not just governance attacks, but in general, that we're able to build some of these functions in a way where you don't necessarily need people to come and adjust parameters, but there's some sort of mechanics that are actually doing that for those users and the protocol. So what I think about the protocol itself is that it should become just this kind of like a public good that just serves everyone and somehow like bakes into the human right of people, where they have accessibility to finance and access to financial opportunities. And I think that then we're in a good spot. So, but that's like years to come, and the protocol itself has to prove that it works over the years, and then we're in a good position.
So in terms of getting like the big banks and big, getting banks, governments, large financial institutions to use Aave, I think one of the challenges has been regulatory compliance. So can you talk a little bit about kind of permissioned pools or how you're kind of overcoming that as a hurdle?
Yeah, I mean, end of the day, the Aave protocol is a software, so it can be deployed as in a customized way or with some modifications, and it's open source, so anyone can fork it and deploy for their usage. And one of the markets that has been deployed is the Aave Arc market, which effectively is the same type of the Aave protocol that exists there now. But the biggest difference is that the access to the market is permissioned by these entities that can actually allow list or deny list addresses. And this is interesting because some of these institutions, they actually want to bake in some of the compliance rules, for example, into the software itself on a protocol level, and that's where it's very convenient. So Aave Arc market has been interesting experimentation, and there has been a peak of 30 million worth of value lock in the contracts. It's still very experimentational, and it's done together with Fireblocks that manages the access of the market, but also the onboarding. We also saw recently JP Morgan deploying the Arc market into another public blockchain network, where they used their tokenized deposits as a way of supplying into the Aave protocol. So that was the first time ever JPM used a public blockchain, but also a DeFi protocol, and that's where Aave Arc type of the solution was used. So I'm very excited about this model, and that could be one way to get more institutional adoption by creating a marketplace where you can have counterparties that basically are listed through this one specific entity or multiple specific entities that could be also custodians in the future. And I think that's an interesting path to explore a bit further as well.
So in practice, on the permission side with Aave Arc, does that look like, you could have one marketplace that's permissionless, the Aave that exists today, that anyone with a wallet can access, borrow, lend. Then you may have another market where there's an off-chain entity that takes institutions through KYC, AML, provides them with some sort of credentials on chain that allows them to then interact with contracts. And you may have a pool of just institutional KYC, AML borrowers and lenders. And then the other thing you were describing with JP Morgan, I believe, was that the FX trade in Singaporean dollar?
Yeah.
Yeah. So in that case, that was almost like a bilateral transaction between between two counterparties. So it seems like in that case, it was almost like a bespoke kind of deployment of the Aave Arc contracts for that specific transaction between those two groups. So are those kind of like some of the different flavors that you see of the way this could be used?
Yeah, exactly. So what's fascinating is that you can create a separate market, add permissions that are based on some sort of verifiable credentials, and have counterparties to register into that market. And what it allows and enables is that you can have institutional peers in that market that are actually using a transparent infrastructure to execute their transactions, but also there's guaranteed execution based on the smart contracts. You can also delegate even the risk management to the Aave DAO. That could be very fascinating, and that's the case with the main Aave Arc market. And I think it's quite fascinating because you can automatize also liquidations as well, and even select who could be those peers or entities that could perform liquidations. So I think it's very exciting way to create kind of like a more private instance of the Aave protocol for a more institutional use case and for specific counterparties that you maybe want to have transparency, but also you want to have guaranteed execution. It just feels like a good solution for everyone who is participating in that market, and maybe it increases the appetite to do business with counterparties that you normally might not be, you normally would not be doing if you don't have that guaranteed execution and transparency.
Yeah, no, definitely. I mean, I think if you were to do what the Monetary Authority of Singapore and JP Morgan did in kind of traditional finance today, there'd be a web of different custodians, broker-dealers, intermediaries, bank accounts, long settlement time, lots of legal costs and latency, and more counterparty risk. So it is, I think, it's fascinating. So I've been told that we're kind of approaching the end of the conversation, and I think we've kind of just scraped the surface of a number of things. We didn't even get a chance to cover Lens, but I guess one question, it's a broader question, but kind of putting you on the spot. Like, what's your kind of most, I would say, contrarian view or prediction about what we see in crypto over the next, say a year?
Yeah, that's a good. that's definitely putting on the spot. I think in general, like, I mean, we tend to. I think something that is moving very quickly at this point is the scalability aspect. So not just the kind of like optimistic rollups, but also we've seen a lot of progression with the zero knowledge proofs and using a way of actually creating a EVM, Ethereum virtual machine, that is based on zero knowledge proofs. And I think that has been something that is being built faster than I've expected. So if this technology holds pretty well, and I think it's going to be pretty much battle tested in the next upcoming months, I would say we can reach pretty much infinite scalability when it comes to the blockchain. It actually changes the way we use blockchains itself, because we can verify a lot of data and settle a lot of that transactioning into the Ethereum as well. So I think, like, if that will work in the next few months, we're going to have a lot of exciting applications, and that actually maybe means that blockchain itself and Web3 becomes the most fascinating place to be at that time, because we will see innovation that is going to be the fastest and most progressive than ever we've saw in Web3. So if you think that things are going moving very rapidly in Web3, it's gonna just increase from here. So that's probably my view for now.
No, I think that's a great place to end. They say crypto moves in dog years in terms of the amount of activity that just gets compressed into short periods of time. So, Stani, this was amazing. Thank you so much for sharing, your story and kind of your views on the space. Really appreciate it.
Thank you so much, Ben. Thanks for having me here.
And before you wrap up, I would like to express my sincere gratitude to both of you for your valuable contributions to our panel today. Your insights have been truly inspiring, and especially for the MBAs and professionals who are curious about Web3, this panel will be really helpful. So thank you once again for being a part of the Wharton FinTech Conference events, and we hope that you remain connected with Wharton and Wharton FinTech in future as well. Thank you.
Thank you very much.
Thank you so much.
Bye.